no point of the denial that the economic situation is not looking good, and the prospect is for a few months of the pressure at least. But everyone knows that this is the cost of keeping country safe and defending their sovereignty. And it was clear that the Iranian society Sorry, could you hear me?
Can I ask you as well, when you gather, I can. Can I ask, when you gather with your friends or you meet with your family, do you get the sense that there is a solid view inside the country about who exactly is in charge? Because I want to ask you how this US announcement is going to be received in Tehran, but I also get the sense that the leadership structure at the moment inside your country is incredibly fractured. Who's in charge?
At least something that has been very much proved. I am as a political scientist, I'm saying that something that was very much clearly proved that was the political resilience of the Iranian political system. So the governance structure was working since February 28th. That in the highest ranking of the political system, there was an assassination. And you know that the huge numbers of the Iranian commanders were also assassinated. But the country was running to some extent well, and there was no disruption in any form of the public services in Iran. At the moment, it's clear that the political system has revived to some extent to the pre-war order. The leadership, the new generational shift of the leadership has happened, and the new leader now is in the power based on the constitution. And also the president, head of parliament, and head of judiciary. The three branches of the power are working as normal. And you know, with regards to the war time, there is the National Security Council that is in charge of the integrated decision-making in such a situation. So it has been
So Syed, we have about a minute left. So let me ask you this. With that in mind, we have about a minute left. I need to know quickly, who do Iranians blame for the economic crisis on the ground there? Is it Washington or is it their own government?
Before war, there was, of course, a controversy amongst the Iranians, whether or not there was a chance for having a peaceful deal with the US or not. But now, it's almost a kind of the political consensus or public consensus that there is no such a chance for having a peaceful deal with President Trump. As everyone is saying and witnessing what is happening around us, there is no such a US ally anymore. President Trump has betrayed even American traditional allies rather than us. So everyone has come to such a conclusion.
Syed, we'll have to leave it there. Appreciate the conversation this morning. I hope we can speak again soon. Thanks for watching.
Be there for the opening bell.
Right here.
Squawk on the Street, CNBC.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
As the Asia Trading Day begins, join me for Squawk Box Asia. We're live across the region covering what you need to know from here and around the world that would shape the business day. Join me for Squawk Box Asia, only on CNBC.
From the markets to the courts, kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
For this edition of the CNBC Conversation, I'm joined here in Milan, Italy, by the Prada Group CEO, Andrea Guerra.
There is fashion waves, there is political waves, but then there is reality. The reality says that younger generation are looking at you, not just to what you say, but how do you behave. The way you are behaving in the society, you are behaving with your own people and suppliers and stakeholders, and how you are behaving towards the planet are the three things that are part of our inner mission. So we are here to allow everything inside our group to be connected smoothly and positively towards planet, society, and our own people.
Prada Group CEO Andrea Guerra sits down for the CNBC Conversation.
Welcome to Europe Early Edition with me, Ritika Gupta. Let's get into US Treasury Secretary Scott Bessent sanctions on anyone doing business with the regime and suggesting China won't be exempt.
We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
France and the UK pledged to step up support for Ukraine, offering air defense missiles and access to classified technology. Prime Minister Andy Burnham says everything must be done to push Russia back.
The clear message to Putin should be that Ukraine will never give up territory that Russia cannot win on the battlefield.
We need at least 300 Patriot missiles for the winter and for the cold month. Every missile means lives to be saved.
Scott Bessent insists the Treasury will stick to its auction schedule even amid its buybacks. Germany's finance chief pinning the blame for the spike in global yields on the Iran war. Good morning and welcome to the show. Let's get into our top story. Iran has vowed to respond with measures of its own after US Treasury Secretary Scott Bessent unveiled a plan to isolate Tehran's economy, threatening secondary sanctions on its enablers. The plan, dubbed Operation Economic Outcast, did not specify a date for Iran's trading partners to comply or which countries will be targeted. Dan Murphy joins us now for more. Dan, the US launching this Operation Economic Outcast against Iran and those countries helping Iran, but it seems to be more of a warning shot for now. We don't even have names of the countries that it could be targeting.
That's right. And Ritika, good morning. We went live to the United States and live to Iran this morning, trying to gauge the reaction to what was announced in the last 24 hours out of the White House. The Trump administration threatening secondary sanctions against the countries, the banks and the companies keeping Iran connected to the global economy. And as you just explained there, Treasury Secretary Scott Bessent calling this campaign Operation Economic Outcast and also describing it as the single greatest financial offensive ever marshaled against an adversary. Now, this plan basically targets the buyers and transporters of Iranian oil, along with exchange houses, free trade zones, things like airlines and shipping registries, for example, and the digital asset networks that are used to move Iranian money. Bessent saying overnight that foreign institutions facilitating those transactions could be cut off from the US dollar system if they don't comply. Here's Scott Bessent speaking earlier.
Those who stand with the United States will reap the rewards of our partnership. Those who tether themselves to the Iranian regime should expect to share in the isolation of a withering regime. Teams from Treasury, State, and the U.S. military are now meeting with their global counterparts to tell them that the United States expects action.
Scott Bessent speaking there. And while the Treasury is now threatening to sanction dozens of Iranian-linked targets, the broader threat against some major trading partners has not yet been fully implemented. So this announcement overnight, I guess you could say, was kind of long on intent, but short on detail, at least for now. Washington is going to give individual countries some timelines to end activities identified by the US, with Bessent also warning overnight that the clock has just started ticking. But you really do get the sense that we need more information on exactly how this new economic pressure campaign is going to unfold. Now, what's also interesting is that Iran has dismissed this threat almost immediately. The parliamentary speaker, Mohammad Ghalibaf, saying overnight, Americans know that no one buys their bombast, and the United States is not in an economic position to further restrict its relations with other countries. Of course, we've also heard from Iran's economy minister just a short time ago. He also weighed in. Take a listen.
Naturally, they want to carry out an economic terrorist attack against us. We have our own tools as well. We know how to play the game too. This time they should no longer think that we will remain on the defensive and only defend ourselves. They should also expect an attack from our side. As I said, the unipolar world is over. As you saw, 2 of the world's major countries did not accept these new sanctions and this new plan and refused to go along with them. We are almost certain that many other countries, either officially or unofficially, will not accept them either, and God willing, they will fail.
The Treasury Secretary overnight was quick to single out countries like the UAE, for example, which have already moved in line with the US position and cut off their trade and economic ties to the regime. But you also really get the sense now that China is going to be the critical test. Beijing has rejected unilateral US sanctions in the past, and while the Treasury Secretary also insists that Chinese banks and companies will not be exempt, we have also heard from China's foreign ministry saying it is going to be business as usual on the ground. So the question now is really whether Washington is going to enforce these threats against major economic partners, whether the president has the political capital to do so ahead of the midterm elections and ahead of what is a very highly anticipated meeting with President Xi as well. And at a broader level at the moment too, the question now is whether more of this financial pressure can actually produce the kind of breakthrough that the administration wants, the kind of breakthrough diplomatically that nearly 6 months of war has not. So we're watching and waiting to see exactly how this unfolds and, of course, how the Iranians respond as well. All eyes on the markets too. We've seen oil basically selling off into this announcement. Oil also lower through the course of the US session and trading mostly flat as we track into the European trading day. Ritika, it's back over to you.
All right, thank you so much for the update, Dan Murphy. Now, the latest salvo has raised questions about whether the US will go after Tehran's top trading partner, China, currently the leading importer of Iranian crude oil. In a press conference yesterday, the US Treasury Secretary suggested that China would not be exempt.
Every country, every entity should know that they should be prepared to face U.S. sanctions. And no one is above this. We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
Elaine Yu joins us now. Elaine, what has Beijing's response been to this? And of course, it comes ahead of a highly anticipated meeting between President Trump and Xi Jinping.
That's right, Ritika. So Beijing's response so far is it will do what's necessary to protect its interest. The U.S. blacklisted 60 individuals, entities, and vessels, including some in mainland China and Hong Kong. And as you and Dan was saying earlier, the U.S. also threatened secondary sanctions, but it stopped short of sanctioning major Chinese banks, which would have been the much bigger escalation. So China's Foreign Ministry spokesperson Lin Jian said that China will closely watch relevant developments and do what is necessary to protect their legitimate rights and interests, and also said that sanctions and pressure will only escalate tensions. And the question is how far Washington will actually go just weeks before President Trump and President Xi are due to meet in the U.S. in late September. Now, Beijing's support for Tehran beyond rhetoric in the last few months has actually been quite restrained. And we were talking to Dan Wang of Eurasia Group earlier, and she said that sanctioning a major Chinese bank would be a red line for Beijing. This is not like sanctioning a teapot independent refinery. This could challenge China's financial connection to the world and also put major devaluation pressure on the RMB if a major Chinese bank is kicked out of the SWIFT system. And so Dan Wang said that China won't likely defend Iran against the West because it cares more about the dollar access. And publicly, China has pushed back against U.S. unilateral sanctions on Chinese refineries, but Wang also pointed out that privately, actually, Chinese banks have been trying to comply with them. So as you mentioned earlier, China is Iran's biggest crude oil buyer. Last year, these purchases averaged about 1.4 million barrels per day, but this number has fallen since the U.S. renewed its blockade on Iran's ships. And this month, in August, that number has dropped to a provisional 534,000 barrels per day. So if you look at Sinopec, for example, this is a Chinese refiner that's also the world's biggest. It has relied on the Middle East on half of its crude oil imports, but the company has said that it will continue to diversify its oil imports away from Gulf sources to Brazil and also Africa and other places. But it's really the Chinese independent refiners that are not the big state companies are the main buyers of sanctioned Iranian oil. They're attracted by the steep discounts there, and they've been long labeled as shipments from Malaysia, and more recently reports suggest that these shipments have been branded as being from Indonesia now and are being settled in the Chinese currency. So there could be backdoors to this trade as well. But of course, we'll have to see what Washington's next step is, because we know what Beijing's red line is, and this is coming ahead of their meeting as well. But this is obviously going to be something that the two presidents will be talking about, President Xi and President Trump, when they meet. But there are a long list of other high-stakes concerns as well, whether it's Taiwan or tech export control. So we'll see how this Iran pressure campaign will figure into all these already very delicate and charged U.S.-China negotiations. Back to you.
All right, thank you so much, Elaine. Let's get more now with Guntram Wolf, Senior Fellow at Bruegel. Guntram, welcome to the show. Let's first start off with your reaction to the so-called D-Day, economic D-Day launched against Iran, as well as the Operation Economic Outcast, which they failed short to actually single out any countries in. So how much economic pressure is this actually going to apply onto Iran?
Yeah, I mean, so there used to be a time when Europe and the United States together did sanctions against Iran, and that was so effective that in the end Iran had to halve in and actually accept a deal in which large parts of the nuclear program were actually monitored and partly dismantled. Now, this is, I would say, a time in which China's role in the global economy was still much, much smaller. And so the crucial question here is, if the US now does this set of sanctions unilaterally against Iran, will Iran find ways of circumventing and basically staying connected to the world. And I would say China, yes, might comply with the sanctions officially, but I'm pretty confident that China will let ways happen of still getting Iranian oil and funding that oil through backdoor channels. And if that is necessary, and if it's necessary to use sort of the Russian ruble as an intermediary, or to use any other currency and any other intermediary, I'm pretty sure they will find ways. China's economic weight and military weight is just too big at this point that they will just simply take orders from the United States.
So is China then ultimately the make or break of this strategy then? You know, if China continues circumventing and buying that Iranian oil, and also does the fact that the US thus far, I mean, it's avoided sanctioning Chinese banks. I mean, if that was to happen, how big could this get? Because I imagine it would be there'd be some sort of blowback from China in response to this.
Yeah, I mean, China is, in the sense, absolutely critical, not only because it is a major importer of Iranian oil, but it is critical really because it is a fully independent economic and military power, and therefore it can position itself clearly and 100% in opposition to what the US president wants to do. And so in that sense, a lot of countries around the world will look at China and will look at what China is actually doing. And I think that, again, I think China will want to avoid losing direct access to the US dollar system. But then, you know, they might just call the bluff, because ultimately we've been in that game in the trade war, and I think the US has tried to isolate China economically. And, you know, if you stop giving access to Chinese banks to the US dollar financial system, you are effectively also undermining China's ability to trade with the world. And in the end, of course, the US had to carve in. Why? Well, basically because everybody in the US needs Chinese products, right? So the leverage that China has on the United States is very big, and I very much doubt that in the end this can be pulled through to the end by the United States.
So Iran so far seems to be brushing off these latest threats, but their Iran's rial has fallen sharply. So how much economic pain can Tehran still continue to endure at this point?
Yeah, I mean, it's difficult to say. I mean, of course, there will be some short-term economic costs, but Iran will find ways around and will find ways to continue selling its oil. And of course, it is a totalitarian regime that can also suppress any opposition domestically. What I would really want to emphasize here is that the United States should at least have engaged with its European allies in defining sanctions and collaborating with European allies on that, because at the end of the day, just threatening secondary sanctions on Europe, I mean, it's not only a very brutal way of trying to get allies. I think one could have really collaborated proactively, because we share the same goal that the Iranian regime is unpleasant. But it's also, frankly speaking, a security risk at some level also for the Europeans. The Iranians have already said that they are willing to retaliate with all means against anyone cooperating with the United States on this. So it brings Europeans, again, in a very difficult position. We are bullied from the United States, and nobody has consulted with us about the economic and security consequences for our continent.
I want to switch gears to Ukraine, because Britain and France, they've pledged stronger military support for Ukraine after a meeting of the Coalition of the Willing in Kyiv yesterday. The two nations committed to providing support, including access to classified technology and faster deliveries of air defense missiles. Speaking at a press conference in Kyiv, marking the country's 35th year of independence, leaders of the Coalition of the Willing threw their support behind Ukraine.
The clear message to Putin should be that Ukraine will never give up territory that Russia cannot win on the battlefield, and negotiations must start from the line of contact. On that basis, we should keep pressing Russia to agree to a full and unconditional ceasefire now and work with the US on that effort.
We should also be mindful that Russia will try to escalate against European countries in order to deter them from assisting Ukraine. And I want here to reiterate my solidarity vis-à-vis all the colleagues being targeted or having been targeted during the past few weeks. And it's clear that NATO countries will be targeted and the provocations will multiply.
We need to make sure that the winter package of air defense will be in Ukraine, and we need winter package of Patriot missiles, and we need, and that we hope that we will have this package. We need at least 300 Patriot missiles for the winter and for the cold month. Every missile means lives to be saved, and so please continue this work through Pearl, through bilateral, our dialogue, and different decisions.
So, Gunter, I want to get your thoughts on this now. I mean, yesterday was Ukraine's Independence Day. We've heard European leaders come out in support of Kyiv. Where do things stand 4.5 years later? What's the latest state of play? And I guess, how close do you think we are really to some sort of pathway to durable peace?
Yeah, I mean, I think we are overall in a situation where Ukraine has effectively managed to put a lot of pressure on Moscow. So we see the burning warehouses, we see access to Crimea increasingly restricted. We see access to the front line of supplies being targeted. So Ukraine's deep pressure campaign, deep behind the front, is very effective and is bringing the war to the Russians and is putting a lot of pressure on Vladimir Putin, a lot of pressure on his military. At the same time, Putin has still major capabilities and continues to actually have major capabilities, inflicting a lot of pain on Ukraine. I mean, there's lots of ballistic missiles, there's lots of deep strike drones, glide bombs that can reach deep into Ukraine. And so the economic cost, the cost in terms of the winter coming up, disrupted heating, disrupted electricity systems for Ukraine is big. And so I would say the pledge of support for air defense as well as for deep strike capabilities by the Europeans is an extremely important signal to both Zelensky as well as to Putin. And so I would say this brings some sort of a negotiation closer, because basically Putin has to understand that he cannot win this war. He can inflict pain, but he actually will get a lot of pain himself. And so it's really now about making that message crystal clear to Vladimir Putin, so that he sits down at the negotiating table and actually agrees on a ceasefire at the current front line.
Right, so you mentioned there the pressure that both Russia's under as well as Vladimir Putin, but the US is also a key factor in this. So how much leverage do you think President Trump really has over Vladimir Putin at this point? And given the US is also dealing with the Iran war, does that make Washington more or less capable, I guess, of pressuring Moscow at this point?
Well, I would say in terms of the objective ability of the US, these abilities have gone down massively because of the Iran war. I mean, lots of Patriot missiles, lots of ammunition have just been burned through in the Iran war, and they are not available anymore, and they cannot be produced just overnight. Some of this will take years actually to be reproduced. And so US leverage over Vladimir Putin in that sense, I would say, has gone down. Now, then the second point I would make is I frankly don't know where the US president stance in his view on Putin and Putin's war of aggression. I certainly think that the president has lots of other things on his mind and has to think a lot about Iran and should think a lot about Iran. But I frankly don't know whether he sympathizes with President Putin or whether he clearly sees Putin as what he is, a dictator who aggresses a neighboring country.
Right, we'll have to leave it there. Thank you so much, Guntram Wolf, Senior Fellow at Bruegel. Now, coming up on the show, President Trump ramps up pressure on Canada as the trade war with the US escalates. We'll have the latest next.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
Crypto FC on The Score.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Welcome back, everyone. Let's get a quick check of your markets over here in Europe. We're seeing futures moving moderately to the upside. Stocks 50 futures up now, almost 0.3% higher. Let's take a look at how Asian markets are currently trading, and it seems now also flipping over into the green. You see the Nikkei 225 index up some 0.4% higher. Along with the Kospi, the Hang Seng index, though, the outlier there, still remaining in the red. This comes after yesterday. We saw that global sell-off in chip stocks. So some of that now we're seeing abating. If we take a look at how the US gets set to open, we're seeing pretty much flat, a mixed picture there. We're seeing NASDAQ futures, though, pushing to the upside again as this sort of global chip stock sell-off seems to abate. Investors will be watching out for PCE data in July today, earnings from NVIDIA tomorrow, and, of course, Kevin Walsh facing that test at Jackson Hole on Friday. Let's go over from equities over to bonds and take a look at the yield picture. We've been focusing in on the rise in yields. Then, of course, Scott Bessent coming out with the surprise buyback plan. I mean, yields yesterday we saw declining. This is on a CNBC report, actually, that the Treasury could use a general account to fund buybacks. This morning we see yields rising again, that 10-year yield at 4.7%. Now, President Trump has threatened to double top-line tariffs on Canadian auto imports to 50% from January 1st next year. In a Truth Social post on Monday, Trump accused Canada of ripping off the United States of America for a year. The president also lashed out at Ontario Premier Doug Ford in response to his threats to escalate the standoff by cutting America's access to electricity and critical minerals, writing, "Someone should get these clowns to fall in line, or the consequences for Canada will be far worse." The US is reportedly preparing an additional 7.5% tariff on China ahead of Chinese President Xi Jinping's state visit next month, according to Bloomberg. The move is said to be over alleged excess manufacturing capacity and would take the overall levy to around 20%, a ceiling that Beijing has previously signaled it would not retaliate against. Presidents Trump and Xi will meet at the White House on September 24. And coming up on the show, reading the tea leaves, investors look for any further detail on Scott Bessent's bond market intervention. Stay with us.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
Combat sports icon Ronda Rousey. She's conquered the UFC, dominated the WWE, and now she's sounding off on both.
It's extremely oversaturated right now. There's too many fights.
San Francisco 49ers owner Jed York. He sat down with us to explain how he turned the team around and the critical lesson he learned. Plus, influencer Jesse Rydell, also known as Jesser, explains his simple ingredient for online success. This is CNBC Sport on the Record.
Never miss a moment.
Cybersecurity fundamentally needs to change. Every organization needs to up-level its cybersecurity practices.
Non-technical people can create a website, can write code. The same thing will happen in financial services.
If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. It's totally individualized because we know today cancer is a disease of DNA.
From the markets to the courts, kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports afternoons on Saturday and Sunday, only on CNBC.
You're watching Europe Early Edition. I'm Ritika Gupta. Let's get into your headlines. U.S. Treasury Secretary Scott Bessent cracks down on Iran, threatening severe sanctions on anyone doing business with the regime and suggesting China won't be exempt.
We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
France and the UK pledged to step up support for Ukraine, offering air defense missiles and access to classified technology. Prime Minister Andy Burnham says everything must be done to push Russia back.
The clear message to Putin should be that Ukraine will never give up territory that Russia cannot win on the battlefield.
We need at least 300 Patriot missiles for the winter and for the cold months. Every missile means lives to be saved.
And Scott Bessent insists the Treasury will stick to its auction schedule, even amid its buybacks. Germany's finance chief pinning the blame for the spike in global yields on the Iran war. Scott Bessent said the U.S. Treasury will stick to its planned auctions of long-dated bonds, even after he announced an operation that would at least double buybacks of those same securities to at least $4 billion per operation. That expanded buyback program is expected to begin on September 10th for 10 and 20-year durations, according to Reuters. But that's just a drop in the ocean compared to the nearly $740 billion in debt the Treasury expects to offer to investors this quarter. It also isn't clear how Bessent plans to pay for the move. The Treasury isn't the Fed, it can't print its own money. One way would be to borrow at shorter durations, and the other would be to use the Treasury's own funds, as sources have told CNBC. Bessent has built the Treasury's general account to nearly $1 trillion. He could run that down a little with bond purchases and still have some time to replenish it before any potential debt ceiling impasse down the line. Of course, that would entail selling even more bonds. And the move is coming under scrutiny. Stanley Druckenmiller penning an op-ed in the Wall Street Journal, warning that rising rates are a sign of trouble ahead and that artificially suppressing it only heightens the danger. In the article, Bessent's former mentor writes that governments defending prices against fundamentals always lose, saying the US shouldn't put itself on the wrong side of that trade. Meanwhile, a note out of Citadel has warned that tighter monetary policy may be in order as a solution to the debt problem is not repeated intervention, but harder choices on fiscal policy and central banks willing to get ahead of inflation. Also signaling uncertainty, the gold price, which is on course for its best month this century. And the unease is spreading across the Atlantic. Germany's Finance Minister Lars Klingbeil's laying the blame for rising yields firmly at America's door, telling reporters they are a consequence of global uncertainty brought about by the war that Donald Trump started in Iran. German borrowing costs are currently trading around a 15-year high. Let's get more now with Bill Dinning, the CIO of Waverton Investment Management. Bill, thanks so much for joining us. And first start off with this news that Bessent is still planning to stick with the regular debt auction schedule even as they increase these long-dated bond buybacks. I mean, does that make sense from a market perspective?
Well, I certainly think this has thrown a bit of a sort of spanner in the works. I think it's understandable why they want to keep long-end yields down, but whether or not this is the right way to do it, as Druckenmiller said in his article, whether this is the right way to do it, it remains to be seen. It's also curious because, Bessent's effectively intervening in the market here, whereas Kevin Warsh, the Fed chair, has basically said that he doesn't want to be doing that sort of thing. He says that he wants there to be that he doesn't want the Fed giving forward guidance to the market, and now Bessent's coming in to intervene directly. It's a curious hodgepodge policy at the moment.
So what do you make of this intervention in general as well? Because Bessent seems to be signaling that buybacks could become a more permanent feature of Treasury debt management. How should investors be thinking about this? And particularly as we already saw the reaction in yields was quite short-lived in terms of them falling, then we saw them spiking back up again.
Yes, well, I think that's reflecting the fact that I think the market's quite rightly rather sceptical about this. The Treasury does do some intervention, particularly on the so-called off-the-run bonds, where they're trying to provide some liquidity to the market in that instance. But to actually sort of have a stated policy of trying to keep long-end yields down by buying a few of them, that doesn't seem, the Treasury market is huge. Between the Federal Reserve already owns literally trillions of dollars worth of Treasuries, thanks to its past QE programs, particularly the one in COVID just 6 years ago. So adding sort of $4 billion to that, which is what Bessent's done originally, it isn't necessarily, I think, going to be particularly persuasive to the market. And generally, the market does push back at this sort of thing. If there's an intervention, whether it's in the Treasury market or whether it's in a currency market, the market for years has basically said, okay, you're intervening, well, let's push the price against you and see how much you've got. So it's slightly strange that he's done this, in my opinion.
Yeah, and there's questions again about how he's going to fund the buybacks as well. I mean, a bigger overarching question, though, is whether the Treasury is still kind of saying its feet. I mean, does that lose?
Well, I think we've got to be careful about going that far. The Treasury market is still the dominant price setter for what interest rates are globally, and the 10-year bond yield is the most important financial market price in the world, and that's not going to change because of this. But I certainly think that this kind of intervention is a little bit different to what we've had previously. i.e. that generally it's been led by the Federal Reserve, generally through QE or some version of quantitative easing. This is slightly different. Although going back to the point I made earlier about what Kevin Warsh wants, Warsh, as Fed chair, has said that he thinks the Treasury should be more involved in things like quantitative easing if that happens again in the future. So there's a lot of moving parts here, but I think the market is trying to adjust to not just the Bessent move, but I think the market's also trying to adjust to how is Kevin Warsh approaching monetary policy. So I think his speech on Friday at Jackson Hole is going to be particularly important.
That's where I wanted to go. I mean, of course, it does put some burden there on Kevin Warsh ahead of that speech at Jackson Hole. What are you expecting, and how do you think he can temper some of this?
Well, I'm not sure it'd be very interesting to see what he says about this, given, as I said, he sort of said at his first press conference after the first meeting he chaired of the Federal Open Market Committee that he wasn't going to give forward guidance, that he was making the point that if whether it's forward guidance or whether it's this kind of intervention, if you're influencing market prices very directly as a policymaker, you're not going to get the same information that you should be getting from those market prices. The market prices should be telling policymakers what markets are thinking about what the risks are, whether it be to inflation, whether it be risks to growth. And if you're intervening very directly to influence that price, whether it's jawboning through forward guidance or whether it's actually buying treasuries, which is what the Treasury's doing, I think that sort of runs counter to what Walsh has said he wants to do. So it'll be interesting to see how he approaches that, and I think he's got an opportunity also to talk a little bit more, perhaps philosophically, about how he's approaching the Fed's dual mandate. He's historically, when he was last on the Fed as a governor, he was very hawkish on inflation. So it'd be interesting. The speech should be very interesting.
So, Bill, I mean, let's also talk about the spillover into Europe, because we've heard Germany's finance ministers laying the blame for the rise in yields firmly on the US and the war in Iran. So how is that complicating the picture, and how is that impacting your view of, the US versus the rest of the world?
Well, indeed, and I think we shouldn't forget that behind the scenes here, the uncertainty of what's happening in Iran and how it's going to influence energy prices is obviously having a big impact, particularly on this side of the Atlantic. If you just look at when bond yields started to move up at the end of February, it was coincident with the beginning of the bombing campaign against Iran. But the impact on energy prices had a much bigger impact here in the UK and in Europe, and I think that that's going to continue to be the case. If there's another jump in energy prices, that's going to be particularly negative on this side of the Atlantic. We saw that in March, and I think we'd see it again. So I think the Iranian conflict in the background is something that, again, has an important role to play. Ultimately, the outlook for inflation is absolutely critical to how markets price bond yields, probably more important than how many bonds Bessent's willing to buy.
So how are you looking then at European versus US Treasuries? What's more compelling to you at the moment?
Well, we actually do think there's some value in the gilt market. Gilts have sold off a little bit. Gilts have underperformed treasuries a little bit this year, or they're not perhaps by as much as you might think from some of the commentary. Both sides of gilts and treasuries are both up about 0.6% since the beginning of the year in terms of their yield on a 10-year duration. We do think the gilt market's got some appeal, and the treasury market likewise. And if you look at the index-linked market, index-linked 10-year index-linked treasuries are yielding about a real yield of about 2.2%. That in our judgment is certainly attractive. So, and government bonds do have an important role to play in diversified portfolios. They, despite all the noise in the background, if there's a wobble in growth or there's a concern about some crisis in the world, then it's very likely that government bond yields would respond by going down in that circumstance. So government bonds have still got an important role to play, and certainly treasuries and gilts certainly are still playing that role in our view.
You think the 60-40s are still a good playbook then in your view, or?
Well, depends what's in the 40. So the government bond market certainly has a role to play in, so 60% in equities, 40s in other things. Certainly government bonds have a role to play here. When gilt yields and treasury yields were sort of less than 1%, then perhaps there was a lot of risk in those government bond markets. There's less risk when the yields are 5 or over 5. So I think the government bond bit of the 40% has certainly got a role to play. But you talked about gold doing well so far this month in particular. I think gold and one or two other alternatives also have an important role to play as well in a diversified portfolio.
All right, we'll have to leave it there. Thank you so much, Bill Denning, the CIO at Waverton Investment Management. Now, on a programming note, don't miss our comprehensive coverage of Jackson Hole starting this Wednesday. And let's take a check of your markets over here in Europe. Stocks 50 futures moving to the upside, up some 0.3%. Let's see how Asian markets are currently trading. We're also seeing mostly green there across your screen. It's the outlier is the Hang Seng Index off some 0.2%. The Kospi up some 0.3%. This is as we see some of that sell-off in global chip stocks starting to abate somewhat. Now let's see how Wall Street gets set to open. Pretty much flat there, not much in focus. Investors probably just waiting to watch out for some PCE data for July coming out today. Earnings from Nvidia tomorrow and Jackson Hole on Friday. So a little bit of muted action there. Although you do see the NASDAQ futures are outperforming there again as we see some of that sell-off in the chip stocks abating, the NASDAQ clawing back some gains. Now, sticking with tech, Bitcoin has crossed that $80,000 threshold for the first time since mid-May. That's as renewed inflows into spot Bitcoin ETFs and improving risk appetite extended the cryptocurrency's recent rally. Bitcoin started tracking higher last week as it surged over 20% in 3 days for its biggest 3-day gain going back to 2023. Aura is reportedly considering to go public as early as next month, and the move could value the smart ring maker at over $16 billion. That is according to Bloomberg, which says the company is planning to raise up to $3 billion in the listing. Aura said earlier in May it filed confidentially, adding it expected to generate nearly €2 billion in revenue in 2026. Power equipment rental company Aggreko has filed for a US IPO 5 years after it was delisted from the London Stock Exchange. The Glasgow-based company, whose technology is used in solar energy products and data centers, amongst others, is backed by TDR Capital and I2 Capital and has reported a revenue of $1.9 billion in the first half. Coming up on the show, warming temperatures across Europe are threatening the future of one of France's most famous exports. So we'll bring you more right after the break.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giammatteo, only on CNBC.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
China is the world's second largest consumer market behind the US. In 2025, the country's total retail sales of consumer goods exceeded about 50 trillion yuan, or about $7.2 trillion, up by 3.7% year-on-year. With a population of 1.4 billion people, the market has long been a cash cow for global brands. But today, success is no longer a given, with some Western brands struggling and even scaling back operations in the country.
When you think about live streaming and social media, the hottest new thing is going to bubble up overnight and you have to have it the next day.
The number one thing that you will see is how little loyalty Chinese consumers are because of the brands and how fast they innovate and how quickly they push things out. Consumers are very used to being hit by new concepts, new designs.
So what does it take to win in China?
Extreme heat and droughts have put European agriculture under strain, and the impact is being felt in one of France's most famous exports, champagne. Of course, grapes are now ripening faster, with workers rushing to harvest almost 2 weeks earlier than usual to preserve those yields. Jenny Reeld filed this report.
This year's champagne harvest will be the earliest on record and potentially the least fruitful. Extreme heat and drought have pushed the grape-picking harvest forward by almost 2 weeks across the famed French region. And timing isn't the only concern. Sweltering heat is accelerating ripening, making grapes sweeter and narrowing the picking window. That's a problem for champagne, which relies on a slow maturation process for its signature crisp taste. Some winemakers, desperate to diversify revenue, are leaning into tourism instead, now a profitable and growing part of the industry. But the macro picture isn't much better. Producers shipped more than 260 million bottles last year. However, weakening demand and global uncertainty have driven prices in the investable wine market down around 25% between 2022 and 2025, according to fine wine online marketplace Livex. But it isn't bad news for everyone. Rising temperatures are making England's chalky soil viable for sparkling wine. Champagne house Tattinger has already bought land in Kent to produce it. Wine production across the UK surged by 55% between 2024 and 2025, totaling more than 16.5 million bottles, according to official data. One UK-based winery told CNBC the growing season is also moving earlier in the year in England, but remains long enough to make the future of sparkling wine in the UK exciting. Climate change is the biggest threat facing champagne's future in France. But across the channel, England may be an unlikely winner. Jenny Reed, CNBC Business News.
And this summer's extreme heat is expected to reduce the European Union's GDP by about 1%. That's according to a research carried out by a Triodos Bank. Hans Stegman, the chief economist at Triodos, joins us now to discuss the economic impact of extreme heat on our infrastructure. Hans, thanks so much for joining. First of all, talk about your report there. You've said that it could effectively, this heat, wipe out the EU's 2026 expected growth. And of course, also saying that around 1% of GDP this year could be knocked off.
Yeah, there are a few channels. I think one was already before, so it's agriculture. So we see losses in harvests everywhere. The second one is in logistics. Waterways are extreme drought means that it's more difficult to transport stuff by boat. And the third one is energy. So energy, hydro energy, but also nuclear energy, cooling water is limited. So we see the problems there. And the last one is labor productivity, because higher temperatures means in general that people are less productive. And that together means, and it differs very much per country, but on average 1% GDP is wiped off.
So Hans, I mean, you talked about wheat productivity. Europe already has pretty stagnating wheat productivity as it is. I mean, is this going to drag on the future of European and competitiveness? And you've also highlighted France, I mean, to be appearing as one of the hardest hit. What is that down to?
Yeah, well, we must always separate the temporary effects and the longer term effects. And what we see here, of course, because the heat is going so fast, so climate change is speeding up so much that it takes a lot of time to adapt. So, and some things can change, like champagne production can go to England, but also different crops, different yields. So you can, all different waterways, different energy systems, that adaptation takes time. Also, in terms of labor productivity, installing air conditioners, etc., means that you can adapt, but it takes time and it comes at a cost. Climate change and what we see here is not unique for Europe, because we see the same in the US and everywhere in the world. But adaptation takes time, and it doesn't bode well for the future, because in the end it means that production of everything will cost more and will lead to less economic activity.
So we'll get back to the climate change aspect of that in a moment, but in terms of the inflation impacts, the broader impacts of this, of both the food and energy, how significant could this impact be on food prices, given the hit to agriculture, livestock production? And then we're also seeing Europe seeing higher electricity demand because of the cooling needed. So talk to me about the wider impacts of this.
Yeah, well, we should not overestimate, but also not underestimate those facts. So it's a few 10.2, 0.3. So it's not like percentage points of inflation, but it adds, of course. So in terms of energy, to the problems we already have in Europe and in general. If you take France, because France is, I think, the most hit also by the heat this summer. It adds to the problems they have, not only with inflation and with stagnant growth, but also to the government budget, which is also in trouble, of course, already for some time. So this period of this hot summer is more or less adding to the problems that are already there in Europe, instead of being the only problem. And if you should have enough capacity as an economy, or enough adaptation capacity as a government, you can overcome much of these problems in the longer term. But because it's going so fast, and we've seen it this year also, a lot of the wildfires in Europe, it of course hits the economy quite drastically this year.
So how should the ECB respond to this, given you mentioned the quite quick changes that we see both in food and energy prices, and also the impact then as well on weakening growth? I mean, how is that complicating the picture for them? Is it something they can look through at this stage?
I think they can look through it rather comfortably. I think the bigger problems, like the war in Iran and US, and the energy crisis that we still have a little bit, I think that's what they're watching quite closely. I think in terms of this, the food prices and the energy, or the heat consequences for energy, they are a minor concern, I think, for the ECB. But in the longer run, and also the ECB has some reports on it, I think they are worried of climate-driven inflation in the longer run. So it is a thing that the ECB should watch for, but I think it will not be decisive for decisions in the shorter
So Hans, quick one before we go, when it comes to the climate change policies. I mean, there is this big argument that net zero is too expensive, and it risks making European businesses less competitive. But you've actually argued that there's climate solutions that can actually save money. So talk to me about those.
No, I think it's very clear, and that's also what we try to show in the report, that those arguments that that climate mitigation is too expensive and that we should be competitive, etc., is not working in times when we see that climate change is already hitting the economy. So we are in a kind of a doom loop of having more economic activity, adding more carbon emissions, and in the end intensifying the climate problems, not in the long run but in the shorter run. So what we should do, of course, apart from mitigation, is invest in adaptation rather quickly, but don't expect that we can adapt to everything, because adaptation comes at a cost, and some things cannot be adapted.
Sorry to interrupt you, Hans. We're running out of time. Thank you so much, Hans, for joining us. Thanks for watching. Squawk Box Europe is up next.
breaking news, market moves. Scott Wapner from the NYSE, Closing Bell, weekdays streaming on CNBC Plus.
Fast Money is America's post-game show.
Near all-time highs against the S&P.
We want to arm people with the information to make great decisions.
Valuations matter in a higher interest rate environment.
Fast Money, CNBC, streaming on CNBC Plus.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have two small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
There were definitely a few times when there was no money in the bank.
Before Careem became one of the defining startup stories of the Middle East, Mudassir Sheikha was trying to keep it alive from one funding round to the next. He'd left a safe consulting job, and he and his co-founder had each invested $50,000 of their own money into the company. In the early days, Careem wasn't an app that magically matched riders and drivers. It was the founders calling drivers themselves in the early hours of the morning.
It was radically basic. All we had was a website.
And 7 years later, Uber, the rival Careem spent years fighting, agreed to buy the company in a landmark deal for the region.
To do a deal with our biggest rival, the company that we thought was trying to kill us, was just very, very difficult for the organization.
Very warm welcome to Squawk Box Europe with Ben Boulos and myself, Steve Sedgwick. These are your headlines. US Treasury Secretary Scott Bessent cracking down on Iran, threatening severe sanctions on anyone doing business with the regime and suggesting China won't be exempt.
We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
Scott Bessent insists the Treasury will stick to its auction schedule, even amid its buybacks. Germany's finance chief pinning the blame for the spike in global yields on the Iran war. Bitcoin passes $80,000 for the first time since mid-May, following a 20% rally last week, as renewed inflows into spot Bitcoin ETFs boost the cryptocurrency.
Very good morning to you. There is a rich history of sanctions against Iran. If you go onto Wikipedia or you go into other sources as well, there is a huge page looking at various issues over various years, going back to the Iranian Revolution, going back to 1979. So the question is, good morning to you, what difference will more sanctions make now? Will they be very different sanctions? Will they be tighter sanctions on a global basis than we've seen previously? Because Iran has now vowed to respond with measures of its own after US Treasury Secretary Scott Bessent unveiled a plan to isolate Tehran's economy, threatening secondary sanctions on its enablers. The plan, dubbed Operation Economic Outcast, did not specify a date for Iran's trading partners to comply or which countries will be targeted. Dan joins us with more now. Dan, I just briefly said that sanctions have been around a very long time on Iran. Now the United States is saying there'll be some form of economic asphyxiation on Tehran, on Iran as well. That would require a global effort, or certainly global coercion, or certainly buy-in from global partners as well. How's this going to work?
Well, it's going to be very closely watched, Steve. Good morning to you. I think the announcement overnight was, of course, highly anticipated. Of course, post that really big piece that the Treasury Secretary put in the Financial Times yesterday. But while it was highly anticipated, it was kind of long on threats and short on detail. The Trump administration stepping up its campaign to cut Iran off from the global economy. It's threatening secondary sanctions against the countries, the banks and the companies that continue to do business with Tehran. And the Treasury Secretary Scott Bessent has called this Operation Economic Outcast, as you've just said, basically targeting everything from Iranian oil sales to digital asset networks. And the Treasury Secretary says foreign financial institutions could ultimately be cut off from the US dollar system if they don't comply. Here's the Treasury Secretary speaking earlier.
Those who stand with the United States will reap the rewards of our partnership. Those who tether themselves to the Iranian regime should expect to share in the isolation of a withering regime. Teams from Treasury, State, and the U.S. military are now meeting with their global counterparts to tell them that the United States expects action.
Scott Bessent speaking earlier. And while the US has sanctioned dozens of Iran-linked targets, the broader threat against major trading partners has not yet been fully implemented. Washington says individual countries will be given timelines to end their identified activities. In fact, the Treasury Secretary even said that President Trump will be picking up the phone to speak with world leaders about ensuring that they can get on side with what the US is trying to achieve here. And Bessent also singled out the UAE in particular as an early example, suggesting that its decision to cut trade with Iran followed US engagement and could be replicated elsewhere. Of course, the elephant in the room is really China. China remains the biggest test here for the administration. Beijing has rejected this US threat. Bessent still insisting that Chinese banks and companies will not be exempt. And then, of course, whether or not we will see any kind of movement inside China here to comply with what the US wants remains to be seen. Trump already using quite a lot of domestic political capital on this. How much more he has to use with President Xi ahead of that highly anticipated meeting remains to be seen. At the same time as well, Iran also dismissing this campaign. The parliamentary speaker Mohammad Ghalibaf saying no one believes the American bluster, he called it, and he also claimed that Iran's trading partners had said that they would ignore these warnings. It's a claim that CNBC has not independently verified, but the response from Iran in the last couple of hours has effectively been, look, we have seen this movie before and nothing changes on the ground. Iran's economy minister also weighing in. He says Tehran is prepared and is also warning that its response may not be purely defensive. Listen to this.
Naturally, they want to carry out an economic terrorist attack against us. We have our own tools as well. We know how to play the game too. This time they should no longer think that we will remain on the defensive and only defend ourselves. They should also expect an attack from our side. As I said, the unipolar world is over. As you saw, 2 of the world's major countries did not accept these new sanctions and this new plan and refused to go along with them. We were almost certain that many other countries, either officially or unofficially, will not accept them either, and God willing, they will fail.
Iran's economy minister there. And despite this new emphasis on economic pressure, the US Defense Secretary Pete Hegseth also said something interesting last night. He suggested that military strikes in the Strait of Hormuz or around Iran remain on the table here. That is despite this escalation in the economic rhetoric and the threats being leveled against America's allies if they do not comply with what the administration wants to achieve on the Iran file. So again, this is going to be very interesting to watch. The devil is in the detail. Markets seemingly trading through this though right now. We saw oil prices staying mostly muted through the course of the Asia session and flat as we track into the European Open as well.
Okay, excellent work. Thank you very much indeed for that, as ever, and thank you for explaining all of those details. Let's get to Sir Richard Dalton, who's former British ambassador to Iran. Sir, thank you very much indeed for joining us today. Look, in terms of what is different now, as opposed to previous sanctions efforts from the West and others to isolate Iran, what do you think the difference will be, Richard?
Additional bureaucratic resources and political determination in Washington and a wider range of target countries. Secondly, of course, a weaker Iran with its economy, its exchange rates, its oil sales, all in very deep difficulty. You've already identified the key points about how this is going to play out. But an additional detail, of course, is whether in the face of immiseration and even greater hardship, the Iranian people will remain quiet or will seek to overthrow their government in order to try and get a settlement with the United States.
Richard, that last point is absolutely pivotal. Do you think that actually there will be domestic uprisings again? We saw them at the start of the year. We have seen less since this conflict began, of course, as well. But actually, do you think there would be a credible opposition that could emerge from this?
I think it's unlikely. You can't rule out rats over bread, but in historical analogy, it tends to be when circumstances start to improve that major revolutions begin, rather when circumstances are at their lowest, when people are concentrating on their survival and that of their children. So it would be extremely difficult to foment an uprising from outside, as we saw in February this year with the failed Israeli and United States attempts to do just that. And of course, this level of aggression against the Iranian people is going to induce many people to say, well, it's a bad government, but we've got to work with it.
Richard, given the economic straits that Iran finds itself in, its oil exports collapsing, the real hitting a record low, inflation soaring, are you in touch with people there? And do you can you give us any sense of how it's playing out on the ground?
I've got very few contacts who are able to speak to somebody like me who's distrusted by the regime for his past diplomatic activities. What few contacts I have suggest to me that people are just hunkering down and hoping for better days.
Do you think there's any risk that actually this attempt to strangulate Iran with economic force could backfire and actually spark up a further military retaliation? For example, would the Iranian regime start attacking some of its neighbours in the region who comply with America's ultimatum?
Yes, that's possible. Of course, they would get hammered in return by those countries and by the United States, so they would certainly pause before doing that because they wish to retain their very considerable missile arsenals against further existential threats from the United States and Israel, although that doesn't look likely at the moment. It might transpire. But there's another factor, of course, which is how great is the United States' influence over Iran's trading partners. And that comes down to two things. First, do the governments that the United States will be addressing have full control over their trading communities? And the answer is no, particularly with the neighboring countries that ring Iran, where trade is very much in the hands of small operators who can use unofficial channels. And secondly, there's already a big movement to use alternative currencies or baskets of currencies for international transactions. We know that the proportion of world trade that is expressed in US dollars has declined recent years as a result of the United States' frequent use against Iran and other countries of its power in the dollar financial world to exclude certain nations and certain banks for political purposes. And that flight from using the dollar is surely going to increase with this very wide-scale campaign that the United States now is saying that it's going to conduct. So the impacts on the United States are not 100% positive in its conflict with Iran. There's some negatives for the United States too, and we may find that the United States writ is not as observed as Washington would like it to be.
Richard, if they called on you and said, look, as a former British ambassador to Iran, help us find a route out of this, what is the roadmap to achieve, if not full-on peace, at least a massive de-escalation? Can you see any path out of this all?
Well, yes, theoretically, it's the June Memorandum of Understanding and sincere fulfillment by both sides of the commitments in there. That is still a valid basis. Some economic relief for Iran in return for an internationally accepted regime for managing the Straits of Hormuz and an eventual negotiation process to restore international monitoring of Iran's nuclear activities. It's easy to say that, but of course distrust is total. Iran believes the United States sabotaged the June agreement by trying to evade the arrangements set up for the first 60 days under which Iran would manage the Straits of Hormuz. The United States did that by trying to set up the southern route closer to the Arabian shores of the Gulf. And of course, the United States believes that in the course of its negotiations, Iran has shown bad faith. So climbing out of that pit is very hard. It has to be done with the assistance of the regional mediators, but they've been extremely quiet of late. Their efforts have obviously failed, but their role is going to be crucial in future.
Yeah, Richard, and just very briefly at the end here, you talked about the regional players as well, the likes of Saudi, Turkey, Qatar, and others as well. Clearly, they want a resumption of normal trade flows and perhaps more normal, rather than totally normal, relations with Iran and of course, with the US as well. Do you not think they need to play a bigger role in ending this conflict?
Well, they have in the background, but of course, the United States doesn't always listen to Saudi Arabia and UAE and the other countries that want a negotiated outcome as soon as possible, nor does the United States listen to its allies and its many trading partners around the world, and least of all China, of course, who's saying very sensibly the right thing about sanctions being an unwieldy and uncertain tool and worsening the atmosphere, and political means being the right way to settle this conflict. The United States is set on determining that Iran will surrender. The historical precedent suggests that that's far-fetched and they're not going to achieve that, but maybe they are hoping that they will soften Iran's terms for an eventual negotiation, and maybe round about the year anniversary of the American-Israeli aggression next year, we'll see some progress towards talks.
Richard, thank you very much. Really good to get your thoughts and a great conversation this morning. Richard Dalton, former British ambassador to Iran. Stick around, still to come on the show. Investors look for any further detail on Scott Bessent's bond market intervention. We'll bring you the very latest. Plus, President Trump ramps up the pressure on Canada as the trade war with the US escalates. And we'll get a check on the health of the German economy with the president of IFO. Don't miss that conversation. It's at 9:15 London time.
On a $100,000 US margin loan, Interactive Brokers charges just 5.14%. Do you know how much your broker charges? Fidelity and Schwab charge over 2 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,100, or much more if you're trading big bucks.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange, and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
Closing Bell, weekdays streaming on CNBC Plus.
So it is a big week for the markets, plenty for investors to digest, and Wall Street started the week on the back foot for the most part. The S&P 500, the Nasdaq Composite decisively closing in negative territory at the end of the Monday session. The Dow, the outperformer there, closing about 0.25% higher. The downward pull on the other indices came largely from chip, memory and other AI infrastructure stocks. We saw Nvidia have the 7th straight day of declines. Remember, we get Nvidia's latest results on Wednesday. Investors perhaps positioning ahead of that. Of course, you've still got the factors, the intensifying geopolitical tensions, the war with Iran, the trade war with Canada, also seeming to weigh on equities. We saw a little bit of relief in the oil price, down around about 2% on the day, and a bit of easing on the US Treasury yields as well. So that was the picture on Wall Street at the end of the Monday session. Let's cast an eye ahead and see what's being anticipated for today, and a slightly more positive calling for the futures there, pointing to an uptick on all of the 3 main benchmarks. I mentioned we've got Nvidia's results, big market moment on Wednesday. We've got the latest PCE inflation data on Wednesday as well. That's all, of course, tomorrow. And then markets looking ahead to Kevin Walsh's speech at Jackson Hole, the gathering there of central bank officials. So the other thing we've got today actually is some consumer confidence data. So plenty, as I say, for the markets to respond and react to. How is that all positioning things for the start of the trading day here in Europe? Well, another board of green to be found there this after a day in which most of the European equity markets closed the session lower. The pan-European stock 600 ending Monday just the thinnest of whiskers above the flat line, but the key bourses, regional bourses, the DAX, the CAC, the MIB, all closing lower. The FTSE 100, the outperformer yesterday, closing about 1/3% higher, but a stronger performance being called for Tuesday. Let's see if things pan out as we are now 40 minutes away from the European market open. And as things stand, this is the current picture on Asian equities. Slight improvement as the session has worn on. It's just the Hang Seng out of those four on the board at the moment that is in negative territory. The others improving. Of course, the same concerns we've mentioned affecting US and European markets playing out there, but seeming to shrug those off. Steve.
In the meantime, what a rally. Bitcoin has now crossed $80,000 mark for the first time since mid-May as renewed inflows into spot Bitcoin ETFs and improving risk appetite extended the cryptocurrency's recent rally. Bitcoin started tracking higher last week as it surged over 20% in 3 days for its biggest 3-day gain since 2023. Institutional demand has also returned, with ETFs attracting almost $2 billion in net inflows last week, their largest weekly haul since October. Shares of the Chinese electric vehicle maker XPeng are sliding 8.8% easier as we speak after the company issued a weaker than expected forecast for third quarter deliveries. Losses widened compared with a year ago to 1.4 billion yuan. XPeng also revealed its robotics business has secured a valuation of over $6 billion in its funding round.
Let's stay with that theme of robotics because a report from Bullhound Capital has said global labour shortages are driving unprecedented investment in robotics. It adds that the winners of the next phase of robotics won't be the companies that build the most advanced devices, but those that are able to get robots installed and running consistently. Irina Kerker is analyst at Bullhound Capital and joins us now. Irina, just explain, flesh that out a little in more detail. What does that look like, robots being installed and running consistently, and in which sectors?
So what that means is that what we want to see is not robots that do, flashy theatrical performances, that do backflips, that break dance, but robots that are actually useful in a day-to-day setting or on the factory floor, that you can actually use reliably in a manufacturing line, boxing and unboxing, like for retailers. So something that will be useful and, more importantly, reliable. Something that will not hallucinate when put on the spot in an unfamiliar environment.
There'll be people watching this who may be thinking they've got either themselves or their family or their friends are in jobs that could feasibly be replaced by robotics. Is there the potential for human labour to be completely displaced in some instances?
I mean, robotics currently is not at a point where it can fully substitute a human. We've seen that across industries. It is currently still in a point where a lot of strides need to be made in order for it to be universally skilled in ways that a human would be. It is definitely true that it will change jobs and it will change the labor market in many ways. And that's the point where policymakers will have to step in. But I imagine the future will be more one of collaboration between humans and robots and just a shift in how we think of labor and skilled labor.
For as long as I've been working and covering business and finance, there has been talk of ageing populations in some countries and the impact that has on holding back economic growth. Could this be a solution to that, where if there is a labour shortage, these robots could step in and fill the void?
Definitely, and that is one of the key points we make in our report, that due to the labor shortages, like you said, aging populations, skilled laborers retiring, there is a structural demand for automation and physical AI. So even if there will be no further technological advancements in the field in the next few years, there will still be a drive for automation due to the reasons you just mentioned.
Irina, really fascinating, but are there really labour shortages? Or just people who don't want to work in manufacturing? Because I look at China, which is the place where we're seeing most advances in robotics, and one could argue the US as well, but let's just say China for the sake of this as well. Unemployment is now up to 5.2%, which is up from the most recent 5% figure in June. Youth unemployment, excluding students, it jumped to 17.9% due to a record influx of 12.7 million summer university graduates. Is there really labour shortages that's causing this, or is it the fact that robots don't take a salary, they don't take tea breaks, they don't take toilet breaks, they don't have sick days as well. I mean, they're much more useful for a lot of for companies rather than actual real live employees.
There's definitely a mix of things, and a very important niche for robotics will be jobs that are particularly dangerous for humans or particularly repetitive or tedious. So there will definitely be a point where robotics are also helping in these areas where humans might not prefer to do these jobs due to different reasons, but I think that will just then allow people to reskill or upskill into different fields or domains in which they might find more fulfillment.
Yeah, look, I've no doubt that things are moving very quickly. You talked about the backflips and the races and all that, and all the gimmicky stuff, but it does look extraordinary. But if we do see this kind of progress from a multitude of companies, and we can say Tesla's making its advances, Unitary, etc., etc. What about the investment case? Because as I just read funny enough, with XPeng just before, as brilliant as EV technology is becoming and the reliability issues are being solved, the fact is it's a hard investment case at the moment due to the costs involved and due to the competitive pressure. What is the investment case for humanoid or even more widely robotics, given the competitive pressures?
So what we look at as investors, we look at companies that are solving the deployment problem, companies that are actually able to commercially deploy today and bring value to their customer. And many of the robots that you have mentioned that do backflips and show incredible feats of athleticism, most of them, about 70%, are actually just deployed to university labs or research centers for data harvesting. So they're not actually currently used commercially.
And who's leading the way? Because when we look at the agility and the extraordinary feats of robotics, like you were saying, the backflips and so on, it looks like China's leading the way. Is that the case when it comes to the more, I suppose, pedestrian robotics that humdrum that need to be applied in factories and the like? Is it China or is somewhere else leading?
So there's definitely different poles that are leading in different areas in robotics. China is in the lead when it comes to hardware and the supply chain. The US is doing incredible strides in the intelligence layer of robotics and physical AI. But I think Europe has a huge advantage at the manufacturing level because of the manufacturing base that it historically has, and also of the huge talent that it can tap into.
Hang on, Europe has an advantage.
I would say
I haven't heard those words with technology for a long time. Can you just say it one more time? Why have we got the advantage? Because of manufacturing base?
Yeah, I would say so, because Europe historically has a very strong manufacturing base, which brings a lot of potential for vertical integration of robotics. So you have a lot of manufacturing centers in Europe that can be automated.
Wow! I'm really happy, because I haven't heard anyone say Europe has an advantage over something in manufacturing for a long time. That's great to hear. Lovely place to leave this interview. Thank you. Irina Kierka, who is analyst at Bullhound Capital. Thank you very much indeed. European equity futures look like this as we go to break, mildly in the green at the start of trading.
Combat sports icon Ronda Rousey. She's conquered the UFC, dominated the WWE, and now she's sounding off on both.
It's extremely oversaturated right now. There's too many fights.
San Francisco 49ers owner Jed York. He sat down with us to explain how he turned the team around and the critical lesson he learned. Plus, influencer Jesse Rydell, also known as Jesser, explains his simple ingredient for online success. This is CNBC Sport on the Record.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Lunch, streaming on CNBC+. Never miss a moment.
Cybersecurity fundamentally needs to change. Every organization needs to up-level its cybersecurity practices.
Non-technical people can create a website, can write code. The same thing will happen in financial services.
If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. It's totally individualized because we know today cancer is a disease of DNA.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
A very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. US Treasury Secretary Scott Bessent cracking down on Iran, threatening severe sanctions on anyone doing business with the regime, and suggesting China will not be exempt.
We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
And again, the US Treasury Secretary insisting the Treasury itself will stick to its auction schedule, even amid its buybacks. Germany's finance chief pinning the blame for the spike in global yields on the Iran war. Plus, Bitcoin, huge rally continuing, passing $80,000 for the first time since mid-May, following a 20% rally last week as renewed inflows into spot Bitcoin ETFs boost the cryptocurrency.
Britain and France have pledged stronger military support for Ukraine after a meeting of the Coalition of the Willing in Kyiv yesterday. The two nations committed to providing support, including access to classified technology and faster deliveries of air defence missiles. Speaking at a press conference in Kyiv, marking the country's 35th year of independence, leaders from the Coalition of the Willing threw their support behind Ukraine.
The clear message to Putin should be that Ukraine will never give up territory that Russia cannot win on the battlefield, and negotiations must start from the line of contact. On that basis, we should keep pressing Russia to agree to a full and unconditional ceasefire now and work with the US on that effort.
We should also be mindful that Russia will try to escalate against European countries in order to deter them from assisting Ukraine, and I want here to reiterate my solidarity vis-à-vis all the colleagues being targeted or having been targeted during the past few weeks. And it's clear that NATO countries will be targeted and provocations will multiply.
We need to make sure that the winter package of air defense will be in Ukraine, and we need winter package of Patriot missiles, and we need, and that we hope that we will have this package. We need at least 300 Patriot missiles for the winter, and for the cold month. Every missile means lives to be saved, and so please continue this work through Pearl, through bilateral, our dialogue, and different decisions.
The UK Prime Minister Andy Burnham says he is planning to travel to New York next month around the UN General Assembly. Speaking to UK broadcasters while in Kyiv, Mr Burnham said he would likely join European leaders in holding another Coalition of the Willing meeting to try to secure Patriot missile interceptors for Ukraine. The trip would be Burnham's first to the US since becoming Prime Minister in July.
UK Prime Minister Andy Burnham has hinted at the prospect of tax rises in October's budget, refusing to rule out the move whilst questioned on his visit to Kyiv. Speaking to ITV News, Burnham said he won't be unrealistic and also ruled out the possibility of an early election. Our next guest says Mr Burnham needs to be bolder on policy. Andrew Percy is the co-chair of the Social Prosperity Network at UCL and author of Prosperity 2030. Andrew, thank you very much indeed for joining us. Well, what is the remedy to the UK malaise at the moment in terms of creating a fairer society, but one also that actually galvanises the private sector and gives it enough incentive to create growth?
Yeah, I think Andy's in a tricky position, right? He's caught in between the bond market and the Labour manifesto as it was written in the last election. And that gives him relatively little room to move. And I think that that's what we're seeing at the moment. I think a lot of this comes down to the scheduling, right? When is the next general election? That's the second time that I think it was softer than ruling out. He said, I don't think the British public would like that at this time, which is not quite the same thing.
Right, isn't he?
Well, I don't know. I don't know that the British public wanted the Starmer replacement necessarily. I think that the situation is fluid and complicated. I think what the British public have clearly been saying for many years is we would like some quite fundamental change in the balance of power, local power. I was just at the Edinburgh Festival, and a very good comedian was saying, and this is relatively simple, can you get wages and costs in line for us? Seems like a simple ask, but has been something that has eluded Prime Minister after Prime Minister for a while now. And, when we launched the report for Prosperity 2030, we did it with a letter, which we did with Jim O'Neill and various other economists, including Jonathan Porteous, who has been on this show, I think. And our point was that tinkering isn't going to be what's needed here. So the sort of changes that we want for a much more vibrant economy require quite fundamental changes to the structure of our society.
Andrew, there's a lot in there, and we spoke to Jim many times over the years, both at Goldman's and thereafter, and spoke to him very recently. Look, you've hit the nail on the head, I think, and you said, people want devolution, they want more local powers. I'm going to disagree. Okay. I think people want the second part of what you said. They want wages and costs to be aligned. Yeah. They don't care whether it's more powers locally or more powers in Westminster. What they want is a fair wage for their work, and they want to be able to live without worried about inflation and worried about the future too much. And I think whether it's Westminster or whether it's Manchester, what they really want is to be able to earn more money and feed their family.
Yeah, and I think so. What we're all after here is disinflationary growth, right? And the problem that, in macro that you might describe is that we've had wages chasing costs, and that is a cycle that in itself just keeps reinforcing and is not the right way to do it. Which is why we've been very strong in saying there is another way to approach this, which is to try driving down the costs of living and do it that way rather than have the wages chasing the costs. Okay. Now, the issue with that is that it requires tax reform. And we are stuck in this situation where the last manifesto effectively ruled out any reforms to the major taxes, and that leaves Burnham where he is, or the government, it could be Burnham or anyone else, where they are today. And so one of the things that we looked at was, what can you do without a general election, without affecting the taxes that he talked about, that would start a new conversation? Because I think until we have a new conversation in which the government is asking the public for something as well as giving it to them, that there is a trade, that social contract exists in both directions. And what we've had so far from Burnham is good intentions. I want to try and drive down the cost of living. I want to do this, and take the 5% off the VAT on the energy bills. But of course, that was eaten up straight away by the revision of the energy limit. So that's a difficult thing to square in short little pieces. So then you have to look at what could he do that would really spark a new conversation. What would actually be a year? Because I think you need probably a year of conversations around every kitchen table and every living room in the country and in the pub that says, wow, okay, we're in a different direction here. Let's take a different approach to this. I think people do want more local. I think people are concerned about their local area and how the fabric is and whether it feels like it's on the up and high streets and all of this. But I completely agree. The major concern is, how do you align wages with costs? There's two ways to do that. You either look at driving up wages or you look at driving down costs. And I think that the driving down cost piece is what Burnham has signaled that he is aware of. And the challenge here is, if he's not going to call a general election, and I've written elsewhere, if you move the budget to October the 28th, I feel there's a reason for that. It does allow you to put an election in pretty quickly. But let's say he's not going to do that. All of the political pundits would say that's madness. The Labour MPs, there'll be Labour MPs who'll lose their seats, so you can't do it even if you were to win the election. So the question then comes down to, I think it's a timing issue here. He needs to do something bold. It needs to be an ask from the populace. What can he do without affecting the major taxes that have been ruled out?
What does a big, bold policy look like that would be effective then, do you think?
So the example we've costed it in the report, is you triple air passenger duty. That adds about £26 to a European flight. That raises enough money to do a number of things across the country, one of which would be free nationwide local bus services. Now, if you walked out your door for the next year and the buses were free, I feel that that is the sort of move that would start these kind of conversations. But it's a trade. You've actually asked for something. It's not funded by debt. It's actually paid for. And I think that's the critical difference in the conversation that needs to happen.
Be an almighty backlash, though, wouldn't there, from the airline industry, the travel sector, the airports, and that's before you even get on to people who've worked hard all year to save for a holiday, and they say, and now we're being hammered with a tripling of air passenger duty. Where's the fairness in that?
Yeah, I think so. Those sectors do exist, right? But you compare that to the number of sectors that would benefit from a more fluid labour market, from easier access to employment, and the number of people, half the people in the country don't fly every year. So I think that, you know, the £26 on a flight versus, it depends. If you're a bus user and you go on holiday once a year, you have just made out on that deal. So it's not that people lose in sort of, you know, in massive quantities here.
It's not necessarily about their net win or their lot, it's their perception of it. If you know, even if they are using the buses every day and it becomes free, if that holiday they've looked forward to becomes more expensive, the political sort of feeling around it, it is potentially outweighed. People don't see the little things; they'll see that one big.
I know what you mean, Ben. I mean, I think I would argue for most people, you know, 1 week down, 51 weeks up, in the conversation.
Andy, why don't we just do something radical here and say, look, when we wrote the manifesto, these were the circumstances. Yeah. Things have changed. We're going to get rid of the triple lock on pensions, and we're going to put a penny on income tax. Boom, done.
So now we're up against the bond markets, right? So I think we're in a very febrile...
The bond markets would love that. Would love the cost decrease from the triple lock, and they would love the fact that actually they're taking firm fiscal action, wouldn't they?
Well, I mean,
bond markets don't tend to get upset when you do stuff that actually cuts the deficit. Bond markets are very upset when you have unfunded promises like Liz Truss did.
That's absolutely right. But they also get nervous if what you've done is you've shaken the ground and they don't know where you're going. So if you do that, I think the risk that they run, it's not impossible, and there's nothing in the Constitution that prevents them from doing that, right? But I think that if you shake the ground underneath that, you then raise questions on everything else. So does that mean you're actually going to do, you know, they've said the fiscal rules. This is largely what the government currently stands on, is adherence to these fiscal rules. We hear it all the time. The Chancellor says they're going to stick to it. That's, I think, the question. You know.
Look, I mean, don't get me wrong, I don't want to pay more tax, and I don't think anyone in the UK, and I think I pay a fair amount of tax as well. And also, I'm closer to retirement than most people in the UK, I guess, so I kind of think, okay, maybe I'll lose out from the triple lock on that. But you know, if it finally, you're talking about bold action, if a government actually wants to do something that's actually going to satiate the bond market and be affirmative and be sensible, let's just get rid of these silly manifesto promises. Let's get rid of the triple lock, which neither government of any stripes has been bold enough to tackle as well. Straight away, your costs are going down and your income's going up. Done.
Yeah, the triple lock is a longer term kind of cut to costs, right? So that that will feed into the sort of projections that are made about 20, 50 years down the line. I don't know, it starts a good conversation locally. Here's the problem with the 1p on the income tax. The income tax at the moment is fundamentally unfair to people who earn their money solely from wages. Right. So there are, you know, notorious 58 to 60% bumps in the tax system at the moment.
When you earn between
so you add 1p on tax on income tax. This is really negative for ordinary people in ordinary jobs. I don't think that's a conversation that can be positive without fundamental tax reform, and that's effectively the argument we've made in the report.
Andrew, it's a really interesting conversation. Thanks for joining us this morning. Andrew Percy, co-chair the Social Prosperity Network at UCL and author of Prosperity 2030. France and Saudi Arabia have announced plans for a $7 billion amusement park near Paris, themed around the anime franchise Dragon Ball Z. The park is among deals set to strengthen economic ties between the two countries. The project's unique theme comes after French President Emmanuel Macron and Saudi Crown Prince Mohammed bin Salman revealed the two had a shared passion for manga, according to Macron's advisors. On the latest episode of the Tech Download, BlackBerry says it's embracing artificial intelligence, but with more caution than many other tech companies. CEO John Giamatteo says when software's controlling something like robo-taxi, reliability has to come before simply adding more AI.
It's one of our fastest growing businesses inside the QNX portfolio. You know, we don't talk that much about it, but we probably should. You know, we have in the QNX business over $950 million of backlog of firm orders from manufacturers all around the world. Now, today, the majority of that is in the automotive space because we serve, you know, basically every automotive manufacturer around the world, with the exception of one, and I'm sure you could guess who that is. So in that 950 million, there's a portion of it that is robotics, that is all these new use cases. So when we think of like the future and we look at it, we're sitting on a backlog of that magnitude, and cars is going to shift from 75% basic to more advanced in a place where we have 95% market share. Robotics is going to shift in a hardcore way as some of these AMRs and autonomous forklifts and all these different applications, they're just starting to emerge. A product that's safety, secure, and certified, like the QNX platform, is very well positioned to address those demands, and we couldn't be more exciting about the opportunity in front of us.
And you can watch or listen to the full episode of the Tech Download now, wherever you get your podcasts, or catch it right here on CNBC this weekend. If you want to know what Porsche is up to with AI, you can find out if you subscribe to CNBC's The Daily Open EMEA newsletter. It gives you that, but also a full, quick and succinct recap of all the key markets-related stories from overnight, as well as a look ahead to what's coming up in the trading day.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
When Amanda Lacasse took over Lynas Rare Earths, the company was on the brink of collapse.
I put my hand up because people in the business deserved someone to give it their very best shot.
12 years later, she's leaving behind the world's largest rare earths producer outside China. Can one company really challenge China's dominance?
I'm confident. We've got good people in Australia, we've got good people in Malaysia. Not only can we compete with anyone, we can win.
Find out more on Managing Asia.
I built a legacy on the court, and now it's the moment to build a legacy outside of the court. My main investments are in hospitality, in education and sports. So I believe that's the future. I see my brand as in a growing perspective and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have two small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
So it was back-to-back gains for the Dow in the Monday session on Wall Street. The only one of the three benchmarks stateside that closed the start of the week higher, up around about 0.25%. The S&P 500 and the NASDAQ decisively on the back foot in what is a big week for markets. It was shares in chip makers, tech, memory chip makers, and other AI-related names that dragged the S&P 500 and the NASDAQ lower. Nvidia actually closed Monday almost 3% down, the seventh straight day of declines. This as investors gear up for the latest big update from what is, I suppose, the poster child for the AI trade. We get the latest figures on Wednesday, but investors perhaps positioning ahead of that. Of course, all sorts of other factors weighing on equities. We've got the ongoing geopolitical situation, the escalation in the conflict with Iran in terms of the US moves to try and put economic pressure there. We've got the ramping up of the trade war with Canada, all of that pulling equities lower, weighing on investor sentiment. And that initially set the tone for the Asian trading session. This was how markets were looking, and they turned a much more positive, a much more upbeat tone as the session wore on. Initially, the tech pullback had affected some of the Asian equities, but largely shrugging those concerns off as the session ploughed on. Perhaps partly helped by a fall in the oil price. It was dipping back closer towards $91 a barrel, having fallen around about 2% in the Monday session, so lending some relief to the inflationary concerns that have at times weighed on equities. That's the picture on the Asian markets. Let's have a look at how European futures are gearing up for the start of the Tuesday session. And those have improved as well as we approach the European market open. All of the three there on my wall now being called positive, including the pan-European blue chip stocks 50. One thing that we did see some easing around was Treasury yields, especially at the long end of the curve. This was after some reports on CNBC as well that the Treasury could use its general fund, which stands at around $1 trillion, to fund some of that buyback of longer dated treasuries. Those have eased slightly, although we're seeing a little bit of an uptick on the shorter end of the curve. Of course, that has an impact on European yields as well. This is the picture. All of those easing slightly on the key 10-year paper for the main government debts here in Europe.
Scott Bessent has said the US Treasury will stick to its planned auctions of long-dated bonds, even after he announced an operation that would at least double buybacks of those same securities to at least $4 billion per operation. That expanded buyback program is expected to begin on September 10th for 10 and 20-year durations, according to Reuters. But that's a drop in the ocean compared with the nearly $740 billion in debt the Treasury expects to offer to investors this quarter. It also isn't clear how Bessent plans to pay for the move. The Treasury isn't the Fed. It can't print its own money. One way would be to borrow at shorter durations. The other would be, as Ben was saying, to use the Treasury's own funds, as sources have told CNBC. Bessent has built the Treasury's general account to nearly $1 trillion. He could run that down a little with bond purchases and still have some time to replenish it before any potential debt ceiling impasse down the line. Of course, that would entail selling even more bonds. The move is coming under scrutiny. Stanley Druckenmiller penning an op-ed in the Wall Street Journal warning that rising rates are a sign of trouble ahead and that artificially suppressing it only heightens the danger. In the article, Bessent's former mentor writes that governments defending prices against fundamentals always lose, saying the US shouldn't put itself on the wrong side of that trade. Meanwhile, a note out from Citadel has warned that tighter monetary policy may be in order, as the solution to the debt problem is not repeated intervention, but harder choices on fiscal policy and central banks willing to get ahead of inflation. So also signalling uncertainty, the gold price, which is on course for its best month this century.
While the unease is spreading across the Atlantic, Germany's Finance Minister Lars Klingbeil laying the blame for rising yields firmly at America's door, telling reporters they are a consequence of global uncertainty brought about by the war that Donald Trump started in Iran. German borrowing costs are currently trading at around a 15-year high. Don't miss our comprehensive coverage of Jackson Hole starting Wednesday. A lot of attention there on Kevin Walsh's speech, his first at Jackson Hole as the new Fed chair.
A couple of quick points. One, it is not the first time that people have worried about bonds and indeed treasuries for that matter. This is not a new story. This has been going on for a long time, the steady accumulation of debt, the increase of deficits as well. So there is no necessary reason why this is the moment of the straw on the camel's back being the key moment as well. So we may go back to some degree of normality afterwards. The other point is, despite all the conversation, this is about one thing. This is about the US getting its deficit in order, but maybe two things, and getting inflation in order. It's that simple. If inflation comes down and the deficit starts to decline, this story goes away.
And I suppose we'll all be waiting to see what Kevin Walsh has to say about those 2 points on Friday.
If he indeed doesn't mention it at all, because the subject of the Jackson Hole meeting is about financial innovation, so he may actually be talking about something completely different. This is where the futures are as we go to break. We are looking at a positive start to trading.
One hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC. Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned. Sponsors disappeared. Fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
Crypto FC on The Score.
Let me tell you about ambition. To me, too much is not enough. You have only one life, so go all out. The only way you're going to accomplish all the big goals is if you have a vision. Find out what you want to do, set the goal really high, and go all out. And then you create another vision, and another vision, another vision. So that's being ambitious, be useful. That's what my father always said. Don't just waste this life away, be useful, help other people. This is what this is all about.
There's some extraordinary moves on so-called safe havens. Gold having one of its best months we've seen in a very long time. The crypto area, well, bull market suddenly appearing in Bitcoin. Is it about concern and other assets, or is it just purely a couple of old momentum trades coming back in as well? Well, in the meantime, we are due Nvidia numbers tomorrow, and of course at the end of the week we'll be eyeing Jackson Hole. So lots to look forward to in this trading week then.
Yes, and this is how things break down in terms of the sector performance this Tuesday morning. Travel and leisure is having a pretty good week so far, up 0.8% in the first few moments of this Tuesday trading session. It was one of the big winners. In fact, it led the gains yesterday, adding 1.7%. Part of that, it's been so sensitive to the oil price, and we saw the oil price come off slightly yesterday, down around 2%. Brent crude tipping now down towards around close to the $91 a barrel mark. That has eased some pressure on travel and leisure stocks. Retail as well, advancing 0.75%. Industrial goods, about a similar amount, and tech on the board of outperformers there, up almost 1%. Tech had actually, I think tech had fallen yesterday. I can't find, can't find what it did yesterday, but it's doing well today. That's all that matters. Let's see where the biggest losses are being felt. And energy was the main laggard on the Monday session. It was off by 1.6%. Not on the board of underperformers so far today. Food and beverage leading the losses, almost 0.5% down. Car makers and parts giving up 0.5%. Household goods and media stocks rounding off the board of red. Let's see how things break down regionally. And after a Monday session in which the FTSE 100 was the only one of these four to close the day above the flat line in the green, they're all performing on a more stronger footing this Tuesday morning. The French and Italian markets neck and neck, thereabouts leading the way. The DAX not far behind, and the FTSE 100 the laggard out of those four. But we'll keep a track on the markets and bring you updates throughout the morning. Steve.
Equity markets pricing embeds optimistic assumptions about the payoff from AI spending powered by once-in-a-generation AI capex boom. Market pricing and consensus expectations have reached unusually optimistic levels. That's what Sebastian Redler is writing in one of his latest pieces. He is head of European equity strategy at Bank of America. Sebastian, nice to see you. Absolutely, markets do have bouts of irrational exuberance, but they also have bouts of irrational pessimism as well. But you think we're very much in the former, do you?
So right now, I've done this job for 20 years. I have not seen a picture like this before, where you have record margin expectations over the next.
What if you'd done the job for 26 years?
I think you would say, I think I've seen this movie before.
Yeah, okay, right.
And we had a great bull-bear debate with our credit strategist on Friday, and she was saying there are important ways in which this is different from what happened back then. Yeah. And I would say what you have seen back then and what you have not seen since is this wave of money washing in from a large technology-inspired investment boom, and it it gives a sugar high to margins, it compresses risk premium to unusually low levels, but you're really counting on that to be sustainable, and that is the key question. Are you just enjoying a sugar high that makes this market very dangerous, as was the case in March 2000, or is that a sustainable kind of level of corporate profitability that has just level shifted higher and is going to stay there? And I think that is a very optimistic assumption.
Yeah, and look, corporate America especially, but corporates generally are knocking the ball out of the park on earnings in this season as well. In many cases, double-digit increases in earnings as well. The case from the bulls is that actually this is a widespread rally we're seeing with widespread profitability. It is not just concentrate on technology.
That is right. And what I'm saying is what you're seeing, and again, it's this my theme of I have not seen something like this in 20 years. Normally, the earnings cycle is the macro cycle. So you need very strong growth to see these type of margins, these type of earnings momentum. Right now in the US, the 12-month forward EPS has gone up by 11% over the last 3 months. That is hands down the sharpest increase in 40 years. And of course, if you just look at the earnings, you go like, this is amazing, you have to be part of this. What I'm saying is you see that every single time. There's a great study by the BIS, the Bank of International Settlements, yes. We only had like 5 or 6 of these kind of waves of investments, boom spending coming through the economy over the last 200, 300 years. And what you always see at the start is the sugar high of profitability. Why? Because you get multiple layers of revenue recognition. Everybody's getting revenue from the spending, not just in tech, but also in adjacent industries. But you don't see any associated costs because they go through the balance sheet. They get capitalized and they get released later in terms of depreciation. So you get a lot of revenue, no cost. So you get basically a one-off widening in margins, and it looks fantastic. But the problem is this is not cost-free. The costs will come later in the form of depreciation charges. Asset-heavy business models reliably underperform over time. But you're saying, no, this will will stay. This profitability is now a permanent feature. And I'm saying is we have seen this movie before. It's a one-off shift higher in profitability. If you're counting on that to stay, you're counting on something that historically has not happened.
Fair enough, but Sebastian, what about those who say, I hear what you're saying, but we are in the early stages of this capex boom because of the scale of the AI rollout dwarfs anything seen before. So whilst there might be people who completely disagree with you or people who agree with you but just think you're too early on the trade.
That is entirely possible, but what you also know in 2000, everybody at that point, a lot of the semiconductor stocks were telling us, oh, we'll have these shortages, these bottlenecks that create scarcity and pricing power for years to come, and then it dropped very sharply. So what I'm saying is, look at the underlying economics. What will determine whether that continues to work? And there's a very simple metric. Will your return on investment stay above your cost of capital? And what we're seeing right now, and that is because there were some investment booms that were sustainable, like for instance the cloud boom of the 2010s. Why did that work and the tech bubble didn't work? And the reason is you didn't have competition, so you had good pricing power and you had wide margin to basically digest all these depreciation charges. Right now you see murderous competition at the model layer of the AI stack. That is not good for the pricing power that you need to sustain these margins. At the same time, your cost of capital is coming up. Look at Broadcom CDS spread, new cycle high. Look at the NVIDIA CDS spread. Because you have to rely so much on debt financing, your debt costs coming up, the spreads are coming up as the risk-free rate is rising to a 20-year high. Cost of capital is coming up, return on capital is coming down. That is not a recipe for a sustainable investment boom.
Sebastian, I'm interested that on your note, you say you remain negative on European equities. Is that right? But if there are fragilities in AI, is Europe not the place for investors to go if they want an index that is less vulnerable? Because you do have things. I mean, just to take one example, in the past 4 years, some of the European banks have given better return for shareholders than the Mag 7 companies.
Absolutely.
I'm just interested to know how those two link. The AI fragilities you point out and your negative stance on European equities.
So you have to distinguish between the absolute call on European equities and the relative call. So what you're making, we are discussing an absolute call. What you're saying is, yeah, but on a relative basis, maybe Europe is more protected. And I would agree with that in the absence of. If you look at the market in absolute terms, you've got EPS at all-time highs, margin expectations at all-time highs. You've got an equity risk premium at a 20-year low. And then you look at the domestic macro in Europe and say, what possibly could justify that? And there's only one answer. You've got a global investment boom, and you've got a lot of spillover, positive spillover in terms of risk premium compression, in terms of profitability. Even the banks, which are the biggest momentum trade in Europe, they have benefited from a global from a global macro environment of strong growth, strong corporate profits, low default rates, high interest rates. That is the environment in which banks thrive, and that was entirely sponsored by this investment boom, which has been the dominant factor in the macro landscape. Now, on an absolute basis, we'd be negative on European equities because we think that reality is too good to be sustained. On a relative basis, then, I think you make a fair point. Maybe Europe would be doing well. The problem is there's a second big theme that we're seeing is rates are very high. We think they will come down. It's a non-consensus trade from our rates team. We very much agree with that. Inflation momentum in the US at a 5-year low. Payroll growth, jobs growth is at 0. The consumer shows signs of cracking. That has been a key second motor of the economy. The rates have continued to move with Fed expectations. If the Fed responds to weakening inflation momentum, weakening job markets, then you're pricing fewer hikes. And Europe is, to finish this long rant, Europe is, on a relative basis, very rate sensitive. In a declining rates environment, Europe, which is a value trade, just doesn't work. So we'd be negative, absolute on the index, but also have a slight underweight on Europe because we're worried about rates coming down from these high levels.
So is it because what I was going to ask you is, given all the things you just pointed out there, as to why you think it's an overly optimistic view for Europe, I was going to say, and yet sentiment and investment has held up despite the geopolitical uncertainty with the war in Iran, the trade war between the US and Europe and the tariffs, the high energy prices, and still we see this robustness. What would it take? What is the pin that would pop things? Is it the interest rates?
I think it's a really great observation. We as macro investors generally are baffled. You get these shocks, and I think therefore this observation that I made earlier, the rules of the game are different now than they have been for the last 20 years. So the last 20 years, if you get that type of shock, you immediately get growth weakness, sentiment evaporates, risk premium. And what has happened effectively, and if you go back in history, you see that pattern. If you have this wall of money coming in, this year, 800 billion is almost 3% of US GDP. It strengthens the system and it makes it immune against these type of shocks. And so therefore, growth was stronger and more robust than expected. It was good for the banks. It was good for risk assets generally. So what would it take to pop it? We think, A, disappointment on the AI capex front. The economics of that industry, with so much competition at the model layer, it's going to be very hard to sustain these margins. If you don't sustain these margins, you're going to ask yourself, do I really have to invest in that? And secondly, the second pillar, as I said, is the US consumer, and we're seeing real weakness there. Payroll growth at zero. On retail sales, the consumers are now pulling back. So if you've got a situation where you get pressure on this expectation that capex is just going to rise and rise and rise, and the consumer with a savings ratio effectively at an all-time low, i.e. is as stretched as the consumer has ever been over the last 50 years, if you see cracks there, then that resilience can finally start to melt, and you will be reminded that after all, this is still a cyclical system, and right now you're pricing for it to be just a thing of utter stability.
Is there not a case in which the rollout of AI and the greater adoption helps achieve some of the productivity growth and the better profitability that Europe perhaps needs?
And I think we have to say, none of us knows the future. There's a wide range of outcomes. There's a really plausible tail risk scenario, positive tail risk scenario, where productivity, which is currently in the US running at 2%, in Europe is running at 0. During the tech boom, when you had a similar kind of development of your tech infrastructure, productivity growth reached 4%. That would be the panacea. That would be and on both fronts, because that's what Kevin Walsh dreams about, strong productivity, leading inflation to come down, then we get lower interest rates. At the same time, stronger productivity means stronger growth, and what it does, it further compresses risk premium. If you're in a high risk productivity growth environment, you get lower risk premium. That is the genuine bull case for equities. The point that I'm making is you're pricing that effectively with a 90% probability with these low risk premium, with these high profit expectations. And I'm saying is it's part of a wide range of possible outcomes, and I wouldn't put a higher probability than 10%.
And a great voice of reason coming from you there, Sebastian, as well. Look, if the market is wrong and they're putting too high a probability on the more exuberant scenario as well, any thoughts about the catalyst or what could actually bring about this reckoning as well? I guess what I'm really asking you to do is something quite impossible, is tell us when and where this is going to break.
Yeah, so I think there are basically two types. There are very few bears out there, so we are an endangered species. There are two types of bears.
The bears always sound so compelling, and
yeah.
yet, what is it? The bears make sense and the bulls make money?
Yeah, the version of the story that I know is you can either sound smart or you can make money.
Yeah.
Maybe I've bet on the wrong.
Well, you've obviously done quite well because you're doing so well ahead of equity strategy, so tell us.
So I think there are two types of the very few bears there are two types of them. The first is, and you were alluding to that, saying, oh, rates are going to explode and it's going to compress the multiple and then we're going to get a lot of defaults. And we're very much not in that camp because we basically don't see the inflation underpinning in the labor market. So what pops this from our perspective is that the hyperscalers look at the expected payoffs from investing in a technology. Yeah. You want to invest in a technology where you have a moat, where you have a competitive barrier, and therefore you get excess profits. This is incredible, the competition that you're seeing at the moment with all these Chinese models. Are you going to invest in an industry where there are 15 lookalike models that effectively have the same How are you going to make money on this? So if we get in the second half of the year or early next year the first indications that you're no longer willing to spend the money that currently you're pouring into that, this BIS study is very good on this. It says A, you're going to get weaker growth, B, you're going to get lower corporate profits, and C, because you've got so much off-balance sheet debt and so much financial interconnections between these players, you will get a meaningful increase in financial stress because there are a lot of people who have borrowed on the assumption that all these revenues will come through. And secondly, watch the consumer, watch the labor market. Everybody's convinced themselves that 0% jobs growth is fine because the break-even rate is lower. You have never seen this economy continue its recovery without positive jobs growth. Right now, your margin of safety is zero. You've got zero jobs growth. And you're really counting on either that rebounding or this time being very different from how this economy has worked over the last 70 years.
What I love about this show is I listen to someone who's smart. It's compelling. You know, we've got to be really careful. Then I'll have someone else come up who's a bull, and is equally smart as you, and is equally compelling as well. So,
that makes our job so fascinating.
It's a great sounding board for the broader industry. Sebastian, thank you very much for joining us. Sebastian Ledler, Head of European Equity Strategy at Bank of America.
Still to come on the show, Iran warns of retaliation as the US outlines a plan to isolate Tehran's economy. Dan will bring us all the details.
You can master your strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past 3 years, Interactive Brokers clients outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs through smarter execution. Access stocks, options, prediction markets, and more across 170-plus global markets. The best informed investors choose Interactive Brokers.
Halftime Report, weekdays streaming on CNBC+.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates.
A lot of strong numbers this morning.
Listen wherever in the world you are. Download the CNBC app now.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school. I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
Iran has vowed to respond with measures of its own after US Treasury Secretary Scott Bessent unveiled a plan to isolate Tehran's economy, threatening secondary sanctions on its enablers. The plan, dubbed Operation Economic Outcast, did not specify a date for Iran's trading partners to comply, or which countries will be targeted as well. As I said earlier in the show, we've had a degree of sanctions or various sanctions regimes for over 40 years, since 1979 as well. So there are a lot of sanctions that come, and one thing that I think I understand about sanctions, they take a long time as well. You need great patience for sanctions to work, and sometimes they don't even work after all that as well, because nations who are having sanctions put upon them have a form of autarky. They have alternatives that become available. So the question is, I guess, Dan, what is different about the new potential sanctions regime, and how quickly can it achieve results?
Well, Steve, good morning. Well, Treasury Secretary Scott Bessent is calling this Operation Economic Outcast, and the name kind of says it all here. The US now planning to target everything from Iranian oil sales to digital asset networks. And new CNBC reporting reveals if these measures are implemented, it could significantly sever the economic lifeline that has sustained Tehran's economy through nearly 6 months of war. In fact, CNBC analysis shows that China, the UAE, Turkey, Iraq, and India are among the top trading partners of Iran. The UAE has already announced its intention to scale back ties. And now the Treasury Secretary says foreign financial institutions could ultimately be cut off from the US dollar system if they don't comply. Of course, the US has already sanctioned dozens of Iran-linked targets. The broader threat against major trading partners, though, has not yet been fully implemented, which is why some of the measures that the Treasury Secretary outlined last night were widely seen as long on intent but short on detail. Washington saying individual countries are going to be given timelines to end their identified activities. Here's the Treasury Secretary speaking earlier.
Those who stand with the United States will reap the rewards of our partnership. Those who tether themselves to the Iranian regime should expect to share in the isolation of a withering regime. Teams from Treasury, State, and the U.S. military are now meeting with their global counterparts to tell them that the United States expects action.
Of course, China remains the biggest test here. Beijing has already rejected the US threat, and the Treasury Secretary insists that Chinese banks and companies will not be exempt. So we're watching and waiting to see exactly how China responds here. So far, the reply from the Foreign Ministry has been it is business as usual inside China. And then, of course, Iran is also dismissing this campaign. The parliamentary speaker Mohammad Ghalibaf saying no one believes the American bluster. He also claimed that Iran's trading partners had said that they would ignore these warnings. It's a claim that CNBC has not independently verified. And Iran's economy minister also weighing in, saying Tehran is prepared and is warning that its response may not be purely defensive. Listen to this.
Naturally, they want to carry out an economic terrorist attack against us. We have our own tools as well. We know how to play the game too. This time they should no longer think that we will remain on the defensive and only defend ourselves. They should also expect an attack from our side. As I said, the unipolar world is over. As you saw, 2 of the world's major countries did not accept these new sanctions and this new plan and refused to go along with them. We are almost certain that many other countries, either officially or unofficially, will not accept them either, and God willing, they will fail.
You heard there the economy minister saying the US should also expect an attack from our side, be that financial or kinetic. It remains to be seen. And of course, we do take these threats from inside Tehran with a grain of salt. But what's also interesting is that despite this new emphasis on economic pressure from the White House, the US Secretary of War Pete Hegseth has also said that military strikes in the Strait of Hormuz or around Iran remain on the table if this doesn't push the diplomacy forward. It's back over to you.
Brilliant work, Dan. Thank you very much indeed. Look, I just want to share with the audience that actually I'm getting some great commentary, and a lot of you are pushing back, but you're doing it in such a smart way. I'm loving the conversation. So if I don't get back to all of you, thank you for getting involved. Look, Roy wrote in. I caught your segment on the proposals and changing and what have you of just getting the UK economy back on the right track, and said rather than raising taxes or removing the triple lock, which is a pension guarantee for pensioners getting an inflationary type increase, we should focus instead on tightening welfare and pension access, especially pension credit and supplementary benefits as well. Robert, I've been communicating with as well. I get sick and tired of this cost of living discussion. It's a hidden veil for discussing more handouts. The best way to deal with the cost of living crisis is to get growth and focus on productivity that will fuel affordable growth in incomes. Great. Again, Ray points out to me that basically UK pensions are the least generous in the G7 group of wealthy nations when measured against average earnings. G7 comparisons and replacement rates. Low replacement rate UK retirees receive roughly 22% of average pre-retirement earnings from the state pension alone. Clive, getting rid of the triple lock would, of course, as you commented, help. However, that doesn't make it fair or reasonable when most people typically receive wage increases at a minimum in line with inflation. As an employer, I do with my staff. Why should pensioners alone suffer? Yeah, look, guys, all I can say is thank you very much indeed for lots of commentary we're getting in. A lot of pushback, but very smart people pushing back.
Yeah, it's always nice to have the different perspectives and people's different views and opinions on these things.
No, but people are fed up with paying more and more tax. I understand where they're coming from, and the same bit of society having to bear more burden, but yet we hear from our political classes that we need a fairer system, we need it fairer as well. Well, my point of view is perhaps if you had more growth, more productivity, and a private sector that was galvanised by a government that was given the tools to go forth and multiply, we wouldn't need the public sector to get so involved.
Yeah, I suppose this is what think tanks spend a lot of time looking at, and this is when we get the guests on saying they would like to see some big bold announcements, some big bold policy to try and achieve all of this.
Which is why I mentioned triple lock, but actually, as I say, a lot of pushback.
But again, yeah, and there would be. I mean, and I think, you know, it's easy for commentators and analysts to say this is what needs to be done, but politically, the amount of pushback you'd get and the political capital that would be expended in doing something that is, some would say, necessary to tackle some structural and fundamental problems would potentially be politically very damaging and lose a lot of political support. Even within, even within Parliament, let alone with the electorate.
At most, we have a 4 or 5 year cycle politically, parliamentary in the United Kingdom, which means that people don't think about the longer picture. To be fair to Andy Burnham, he is trying to think of a 10-year plan, but whether it's achievable or not remains to be seen.
Indeed. Have we got time to do these next bits? Yes, let's do it, because one ring to rule them all is probably what Aura would like you to think about its product.
The tracking ring.
The health tracking rings, yeah, Aura. That's how you pronounce it.
I think so, yeah.
Yeah, Aura.
Right,
it's reportedly considering to go public as early as next month, and the move could value the smart ring maker at more than $16 billion. That's according to Bloomberg, which says the company's planning to raise up to $3 billion in the listing. Aura said earlier in May it filed confidentially, adding it expected to generate nearly €2 billion in revenue in 2026. Power equipment rental company Aggreko has filed for a US IPO 5 years after it was delisted from the London Stock Exchange. The Glasgow-based company, whose technology is used in solar energy projects and data centres, among others, is backed by TDR Capital and I2 Capital and has reported a revenue of $1.9 billion in the first half. Chipmaker Ingenic Semiconductor has made its debut in Hong Kong. The Chinese company, already listed in Shenzhen, raised 3.2 billion Hong Kong dollars. It's the latest mainland chipmaker to seek a dual listing following Luxshare Precision Industry and Montage Technology.
Coming up on the show, Swedish AI startup Lovable hits decacorn status with at least $400 million funding round in its latest round. We're going to speak to the CEO of Europe's leading vibe coding platform coming up next.
For me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
For this edition of the CNBC Conversation, I'm joined here in Milan, Italy, by the Prada Group CEO, Andrea Guerra.
There is fashion waves, there is political waves, but then there is reality. The reality says the younger generation are looking at you, not just to what you say, but how do you behave. The way you are behaving in the society, you are behaving with your own people and suppliers and stakeholders, and how you are behaving towards the planet are the three things that are part of our inner mission. So we are here to allow everything inside our group to be connected smoothly and positively towards planet, society, and our own people.
Prada Group CEO Andrea Guerra sits down for the CNBC Conversation.
Welcome to Squawk Box Europe. I'm Ben Boulos with Steve Sedgwick this morning, and these are your headlines. US Treasury Secretary Scott Bessent cracks down on Iran, threatening severe sanctions on anyone doing business with the regime and suggesting that China won't be exempt.
We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
Scott Bessent insists the Treasury will stick to its auction schedule even amid its buybacks. Germany's finance minister pinning the blame for the spike in global yields on the Iran war. Bitcoin passes $80,000 for the first time since mid-May, following a 20% rally last week as renewed inflows into spot Bitcoin ETFs boost the cryptocurrency. So, Pan-European stock 600 up around 0.3%, and this is how the picture looks when you break it down by the key regional bourses. The Italian market leading the way higher, around about 5% up this Tuesday morning. The DAX and the CAC 40 both up around 1/3%, similar amount. FTSE 100 lagging behind its continental peers. Perhaps feeling a bit of downward pressure from the oil price, which has come off some of its recent highs. It tipped down around 2% yesterday, giving up a bit more ground this morning, hovering down towards around $91 a barrel, easing some inflation fears. That's eased some of the global bond yields as well. We saw the yields on treasuries and some European sovereign debt also ease as a result. Worth saying Bitcoin is up, we're saying up above $80,000 a barrel. Gold had touched 3-month high. Gold actually on pace for its best month since 1999, partying like it's 1999, you could say. Anyway, I'm getting carried away. Let's have a look at sector by sector. This is the picture when it comes to the outperformers. Travel and leisure is having a really good week so far, up more than 0.8% today. It was one of the big winners yesterday. In fact, it led the gains yesterday. It was up 1.7% on Monday, adding to those gains linked to the oil price. It's been so sensitive to the oil price rises. So as we've seen oil come off slightly, that has really lifted that basket of stocks. Industrial goods up, jumping to the top of the leaderboard as I speak. Banks also advancing 0.5% higher, and insurers rounding off the board of outperformers. Where's the fall being felt? I'm glad you asked, because there's a wall of red to show you as well. Car makers and parts giving up 0.75%. Media stocks down 0.5%. Household goods also lower, and food and beverage rounding off the board of underperformers. Tech somewhere in the middle. It had been one of the fallers yesterday. It had slipped 0.8%, but not doing as badly today. Of course, all eyes on the latest results from Nvidia, and that is one of the things that the US markets will be looking ahead to. We get those figures from Nvidia tomorrow, Wednesday, but markets have really been positioning investors ahead of that as they wait to see what that tells us about the status of the AI trade and the momentum there at the moment. We can have a look at what's being called for US futures. We can see a more positive start being called to the Tuesday session. It was only the Dow that finished the Monday session higher. The Nasdaq and the S&P both closed Monday on the back foot, firmly into negative territory. It was chip makers, memory chip makers, and tech-related stocks that had dragged the broad index, the S&P 500 and the Nasdaq lower, but looking to recover, to recoup some of those losses. Of course, also this week, we've got the latest inflation data, the PC inflation data out on Wednesday in the US, and we were talking about it, the Jackson Hole gathering, and what Kevin Walsh has to say as Fed chair, his debut there at Jackson Hole. Steve.
By the way, viewers, thank you very much for getting involved on the UK pensions stroke tax stroke economy conversation. Thoroughly enjoyed all of your commentary. I'm sure you've all got a view on Bitcoin as well, which has crossed $80,000 for the first time since mid-May. I mean, it's just been the most extraordinary rally over the last 3 or 4 days as well. For the first time since May, it's above that level. As renewed inflows into spot Bitcoin ETFs and improving risk appetite extended the cryptocurrency's recent rally. Bitcoin started tracking higher last week as it surged over 20% in 3 days for its biggest 3-day gain since 2023. Institutional demand has also returned, with ETFs attracting almost $2 billion in net inflows last week, the largest weekly haul since October. Meanwhile, shares of the Chinese electric vehicle maker XPeng, as you can see, down 9% on the slide after the company issued a weaker than expected forecast for third quarter deliveries. Losses widened compared to a year ago to 1.4 billion yuan. XPeng also revealed its robotics business has secured a valuation of over $6 billion in its first funding round. Okay, Swedish vibe coding platform Lovable has announced a fresh $400 million Series C funding round, valuing the firm at just over $13 billion. That makes it a decacorn. Okay. The round was led by Menlo Ventures and co-led by Scale Up Europe Fund, which was set up to address Europe's long-standing lack of late-stage capital, especially in technology. Joining us now is Anton Osika, who is the CEO of Lovable. Good day to you, sir. Thank you very much indeed for joining us. Well, look, tell us why you're raising the money and why, well, for start, sorry, I beg pardon. Congratulations on raising the money. Now tell us why you're raising it.
Yeah, thank you a lot. It's great to be here. What we've seen in the last 12 months is an exceptional acceleration in how we're able to help companies from building their software, increasingly to running large part of their business operations on top of our platform, as we've been investing a lot in that infrastructure, reliability and security. And we are doubling down on that, as well as the capability that we have now in-house, which is to make our models and the agent that is helping companies run their business become smarter and smarter every single week. So we're building up a team, every single function globally, headquartered here in Stockholm and betting on Europe, of course.
The whole concept of vibe coding is brilliant and fascinating. And to someone like me, very encouraging, because I'll be brutally honest with you, Anton, I couldn't code for love nor money, and I certainly couldn't create a software product for love nor money. But it's companies like you that would make it very accessible to do both of the above for people like me as well. You're quite the disruptor in the industry, aren't you?
Yes, we've seen almost the entire world has been watching how people specialized in creating software being able to do something that they have not been able to do, being told that it's very, very difficult. Now we're proving out that you can build entire businesses with software without knowing how to code. And there is a lot of things that you want to add on top of your business if you're building it with software, which we're now making seamlessly integrated into the same platform if it comes to payments, your email with your customers, and so on. And these companies that are building on Lovable, they're not just based in US or Europe. It's a very global market for us. There's a huge company growing really fast, started by a founder quite recently with more than 1,000 B2B customers, reaching $20 million in revenue on helping them with AI. And they're doing everything on Lovable. This is just one of many, many examples out of the million new projects started every single week on the platform today.
Yeah, so here's my point, I guess, in many ways. Great product, making it very accessible to people like me who are technologically inept as well, but a lot of companies who wouldn't have access to software and AI at an affordable cost have it as well. Does your product and your industry, the vibe coding industry, does it undermine the case for those who are spending vast and extraordinarily large historic amounts of money building up AI platforms to sell both to enterprise and indeed to individuals?
Well, yeah, what we're seeing at a lot of technological advancement is that we break down barriers, we make things much more cost effective, and we make it possible for anyone to have a custom solution to how they want to use AI. And they can do it at a very, very reasonable cost. I do believe that if you're betting on selling software for tens of millions of dollars, you're going to have to rethink some parts of your business for sure.
Yeah, and so that's my point, I guess. We're seeing these extraordinary sums that people think that Anthropic's worth, that SpaceX is worth, that OpenAI is worth, that all these companies are worth. But I'm trying to work out whether you're going to undermine that business case.
So a lot of these companies, that they're fundamentally selling infrastructure these days, like tokens, and I believe that demand for token is going to continue to exist, and it's a good business to be selling tokens. What we're doing is that we're not just selling the tokens, we're selling this platform that puts on a lot of guardrails in how do you develop secure software, how do you collaborate on it, how do you manage who has access to which data as you're building software with AI, and how do you integrate AI into the software you're building. So I think it's just like two very good business models that are a bit orthogonal to each other.
Anton, it's Ben here. I was reading about vibe coding and the frustrations that people in the tech world have with it. And they point out that if you have created something through vibe coding, you have not written the code yourself, which means that if you detect some glitch or something that doesn't look right or isn't functioning quite right, it's much harder to go in and change it when you haven't written it yourself. Sometimes it's impossible, and what would normally be a quick, cheap fix, it requires you to go right back and build it again from the start. Is that the case?
What we're talking about here is a frustration that has been a part of what I would say used to be called vibe coding, especially 2025. The later half of 2026, we're seeing people who have been skeptical waking up and saying, I don't think we should call this vibe coding anymore. This is just the way that software is being built by the professionals as well. And the problems that you're describing, they don't appear. First, we're investing to make it possible for any type of use case, really mission critical, any type of use case, rely on the AI to put those critical workloads on software written by AI, not rather than vibe coded. But not being able to change something in the UI, that's a problem of the past. Now is the time to use Lovable again, if you haven't used it in a while, and see how fast this technology is moving forward and how much it can do.
And who do you see as your potential customer base? Is it on the enterprise level? Is it, for example, a CNBC wanting to revamp its app? Or is it an individual? Is it a Steve Sedgwick wanting to create his own personal Steve Sedgwick app for people to kind of get his running tips and so on?
So we're seeing two big types of customers being extremely successful. It's the people who often have professional experience, they're close to a customer in some sense, and then they're starting a new business or a new product line for that customer base, and they can move extremely fast compared to how it was before at a fraction of the cost. And these are tens or hundreds of thousands of small teams working on Lovable and running a big part of the company on the platform. The other one are larger companies, established companies that are selecting parts of their workflows, their processes in go-to-market, how they sell to the customers, in finance and operations, in how they run their internal processes, and same with HR or marketing. NVIDIA has 3,000 people working in marketing, being super successful on our platform. And these companies that adopt Lovable in parts of the organizations, bottom ups, they are large, like NVIDIA, Deutsche Telekom, Adidas, but they're also this medium-sized. I love a user of Lovable and their entire company called Nursa, healthcare staffing. Their VP of product. He's this persona that's just again and again showing how productive they can be on the platform because of how many ideas this persona has. So now the VP of product, he built a completely new product line on the platform for certification of new nurses, administration panels, scheduling, everything. And then after rolling out the product line, he brought it in-house to his entire team, and they swapped out 10 of the tools they used previously to just using Lovable, saving $1 million every year on the change that they're doing, building on their company on top of the platform. So there's the large companies that are switching out parts of their workflows, and then there's the new companies that are starting entirely on the platform.
Well, when I was on holiday earlier this summer, I had an idea for an app. I'm not going to say what it is, just in case one day I do something with it. But take someone doing it from scratch. How quickly, from idea to functioning app, and how much would it cost for someone to do that as an individual?
It depends on the complexity of the app. If you want an app with a few features, you will do it in less than an hour, probably more like 10 minutes, and you will spend $25 million on the monthly subscription of Lovable, and that's it. And then the hosting is very reliable and taken care of as well.
Wow, that is an hour to create a, I mean, essentially you can create a, you're saying you could create a business in an hour. I know you've got to have all the infrastructure, the accounts and everything and all the rest, but you could have the functioning basis of a business, an online business, set up and ready to go in an hour.
Yeah, you just need a Lovable account, and then you get your custom domain built in as well. So I think you personally love to see your app after your vacation.
Anton, just one very quick one from me. EU Scale Up Fund was part of the backing for Lovable as well. What more do we need to do in Europe to get companies from unicorn, from private sector, from small status, to get them to be the same kind of size we're seeing on a global basis?
The biggest problem for founders like me that I care about is, of course, the talent and the people that we're building the team with. And these people, they're everywhere. Sometimes I want someone with a very specific experience, right? And for every country in Europe, I think we can make it even more easy to migrate into the country if you're have this specific skills that we're looking for to build companies here and to make it attractive to work and get paid here in Europe. I think that's the main thing that I'm caring about. Apart from that, I think Europe has a lot of things to give to the world, and I'm really betting on the more success stories like us, 11 Labs, Legora coming out of Europe and really proving the world you can build from here.
Brilliant. Oh, do you know, you're the second guest on the show today that said Europe's got a bit of sizzle and has got a lot of advantages as well. So I'm absolutely loving the European positivity compared to my usual negativity. Most of it comes from me, I'm afraid. Anton, lovely to see you. Well done. Thank you very much indeed for your time. Anton Osika, CEO of Lovable. By the way, I've got to pick you up on something.
Oh, go on.
No, just something.
Oh, no.
Just one thing. No one, and I appreciate how sweet it was of you, but no one wants to hear running tips from me, I can assure you.
Speedy Sedgwick.
No one on this planet should spend as much time doing something as I do and be so bad at it.
Oh, come on, you're not. You're being humble. You're being modest. People, there's a community spirit around it. It's not about being the best, it's about doing it and inspiring others.
I agree.
I'm making him blush now.
No, not the slightest, but I just think nobody needs tips from me.
I dispute that. Anyway, we'll have to agree to disagree. BlackBerry has quietly built a sizable software business inside the auto industry with more than $950 million of QNX orders in its backlog. Now the company's betting that the same technology can expand into one of the market's biggest emerging themes, robotics and physical AI.
When you think about robotics and some of the industrial use cases, let's say in a factory or warehouse, or some of the medical use cases, they will require such secure software, right? Similar to what you've done in the automotive space.
Absolutely. It's one of our fastest growing businesses inside the QNX portfolio. We don't talk that much about it, but we probably should. We have in the QNX business over $950 million of backlog of firm orders from manufacturers all around the world. Now, today, the majority of that is in the automotive space because we serve, basically every automotive manufacturer around the world, with the exception of one, and I'm sure you could guess who that is. So in that $950 million, there's a portion of it that is robotics, that is all these new use cases. So when we think of like the future and we look at it, we're sitting on a backlog of that magnitude. And cars is going to shift from 75% basic to more advanced in a place where we have 95% market share. Robotics is going to shift in a hardcore way as some of these AMRs and autonomous forklifts and all these different applications, they're just starting to emerge. A product that's safety, secure, and certified, like the QNX platform, is very well positioned to address those demands, and we couldn't be more excited about the opportunity in front of us.
And you can watch or listen to the full episode of the Tech Download right now, wherever you get your podcasts, or catch it right here on CNBC this weekend.
And coming up on this show, President Trump ramps up the pressure on Canada as the trade war with the US escalates. We'll have the latest next.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Lunch, streaming on CNBC+.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC+.
Scott Bessent said the US Treasury will stick to its planned auctions of long-dated bonds even after he announced an operation that would at least double buybacks of those same securities to at least $4 billion per operation. That expanded buyback program is expected to begin on September the 10th for 10 and 20-year durations. This is according to Reuters. But that's a drop in the ocean compared to the nearly $740 billion in debt the Treasury expects to offer to investors this quarter. It also isn't clear how Bessent plans to pay for the move. The Treasury isn't the Fed. It can't print its own money. One way would be to borrow at shorter durations. The other would be to use the Treasury's own funds, as sources have told CNBC. Bessent has built the Treasury's general account to nearly $1 trillion. He could run that down a little with bond purchases and still have some time to replenish it before any potential debt ceiling impasse down the line. Of course, that would entail selling even more bonds. The move is coming under scrutiny. Stanley Druckenmiller penning an op-ed in the Wall Street Journal warning that rising rates are a sign of trouble ahead and that artificially suppressing it only heightens the danger. In the article, Bessent's former mentor writes that governments defending prices against fundamentals always lose, saying the US should not put itself on the wrong side of that trade. Meanwhile, a note out of Citadel has warned that tighter monetary policy may be in order, as the solution to the debt problem is not repeated intervention, but harder choices on fiscal policy and central banks willing to get ahead of inflation. Also signalling uncertainty, the gold price, which is on course for its best month this century. Steve.
So, why are gold and Bitcoin rallying? Are they, and it's one of those things. It seems really obvious. Oh, there's an underlying reason. We can probably find it. I don't know if it's that simple. They were earlier in the year when no one was worried about market. Gold certainly in the most extraordinary rally, and Bitcoin's had some amazing adventures regardless of what's happening in the bond market, regardless of what's happened in the equity market as well. So I don't want to be too simplistic about this, but it could just be that they are seeking the opportunity. People are taking money out of other assets and thinking there's a monopoly, there's a momentum trade here. Let's ride this momentum trade. And goodness knows, retail investors especially have been very, very good at that ever since we saw, or for a long time, but ever since April the 2nd, when they were the ones who bought the 17% dip in the S&P, not the professionals. So it could just be that simple, or it could be safe haven buying on Bitcoin. It could be safe haven buying on gold as well. But back to your point about the bond market as well. And look, it seems really, really simple. In a world where there's so much complexity, if the US Treasury and the US administration is successful at lowering the deficit, which is currently 6%, 5.8, 6.4, we can argue the toss. If they are successful, if any administration is successful and show they've got a grip on finances, and at the same time inflationary pressures abate, well, a lot of the guests around this desk have said they are abating, then surely the pressure in that bond market not disappears, but the pressure goes very, very quickly as well. It's about showing you're in control of inflation and indeed your spending. Isn't it really, at the end of the day, that simple?
It's simple to say, but harder to do.
For sure, but honestly, I cannot tell you how much I've read, whether it's brilliant people like Steve Leisman, Carl Weinberg, Goldman's, you name it. I'm reading everything I can on what's going on in the Treasury market as well. And it just seems to me to come back to one very simple thing. Get the deficit down, control inflation, the pressure on the bond market will go. Because if people want to hold treasuries, they really do. They want to hold it as a safe haven, as the ultimate safe haven in an uncertain world.
Yeah, I mean, it's true. There's also the thing that's beyond their control, which is the gravitational pull of capital into big tech company debt, the corporate bonds that are being issued there, and investors seeing that as perhaps more attractive. Maybe they have a word with them. Naive, I know, to
say that corporate debt associated with AI is synonymous with treasuries is an extraordinary situation. Well, something we'll ask a lot of guests about. Anyway, don't miss our comprehensive coverage of Jackson Hole starting on Wednesday. We'll be back after a very short break.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have two small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
On Market Shaping Industries, we are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot, despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
A very warm welcome to Scorebox Europe with Ben Boulos and myself, Steve Sedgwick, and these are your headlines. US Treasury Secretary Scott Bessent cracking down on Iran, threatening severe sanctions on anyone doing business with the regime and suggesting China will not be exempt.
We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
Scott Bessent insists the Treasury will stick to its auction schedule even amid its buybacks. Germany's finance minister pinning the blame for the spike in global yields on the Iran war. Bitcoin passes $80,000 for the first time since mid-May, following a 20% rally last week, although pulling back just below that level today as renewed inflows into spot Bitcoin ETFs boost the cryptocurrency.
Iran has vowed to respond with measures of its own after US Treasury Secretary Scott Bessent unveiled a plan to isolate Tehran's economy, threatening secondary sanctions on its enablers. The plan, dubbed Operation Economic Outcast, did not specify a date for Iran's trading partners to comply or which countries will be targeted. Dan joins us with more. Dan, a lot of people are saying this is about China and China's support for Iran by buying its products as well. Is it more sophisticated than that, though?
It is, and this announcement overnight was kind of long on ambition but a little short on detail. Treasury Secretary Scott Bessent calling this Operation Economic Outcast. The goal here is to target everything from Iranian oil sales to digital asset networks. A new CNBC reporting actually shows that if these measures were to be implemented, then it could significantly sever the economic lifeline that has sustained Tehran's economy through nearly 6 months of war. Now, as you mentioned, China is of course on top of the list here, but this is a list that also includes the likes of the UAE, for example, which has already moved to cut its trade and economic ties with Tehran. It also includes Turkey, it includes Iraq and India, among some of the other top trading partners of Iran. The UAE, as I mentioned, already announcing its intention to scale back ties. And now the Treasury says foreign financial institutions could ultimately be cut off from the US dollar system if they don't comply. So this is Washington saying you're either with us or against us once again. Washington also saying individual countries will be given timelines to end identified activities. As I mentioned though, China of course remains the biggest test. It sits on top of the list here. No major Chinese bank was included in the opening round that the Treasury Secretary outlined overnight, but he did say that Chinese institutions will not be exempt if they help Iran to move its oil revenue. Here's the Treasury Secretary speaking earlier.
Those who stand with the United States will reap the rewards of our partnership. Those who tether themselves to the Iranian regime should expect to share in the isolation of a withering regime. Teams from Treasury, State, and the U.S. military are now meeting with their global counterparts to tell them that the United States expects action.
Scott Bessent there, and I also wanted to bring you some reaction from the UAE. As I mentioned, the UAE suspended all trade, commercial exchanges and financial transactions with Iran last week, citing the regional escalation. Well, Dr. Anwar Gargash, the diplomatic advisor to the UAE president, says Iran's attacks on the Arab Gulf states have only deepened Tehran's isolation and weakened its position. Gargash, in this most recent post on X, also saying the path out of the war now lies in working with the Gulf states to de-escalate and to find a political exit here. Interestingly, of course, the response from the Iranian side has been a little more pessimistic. Iran basically dismissing this threat from the White House overnight. The parliamentary speaker Mohammad Ghalibaf saying Washington can't afford to damage its relations with other countries, and Iran's economy minister also weighed in saying Tehran is prepared and also warning that its response may not be purely defensive as well. Listen.
Naturally, they want to carry out an economic terrorist attack against us. We have our own tools as well. We know how to play the game too. This time they should no longer think that we will remain on the defensive and only defend ourselves. They should also expect an attack from our side. As I said, the unipolar world is over. As you saw, 2 of the world's major countries did not accept these new sanctions and this new plan and refused to go along with them. We were almost certain that many other countries, either officially or unofficially, will not accept them either, and God willing, they will fail.
Iran's economy minister Ali Madanizadeh there. And of course, as this week will officially mark the 6-month milestone of this conflict, there's still a lot of questions about exactly which way this thing is going and how much political capital the president is willing to actually throw at this in order to bring about some kind of diplomatic off-ramp here. Of course, I spoke with one analyst this morning who also suggested maybe we should have seen some of these economic measures being announced back in February, not 6 months down the pike. He suggested to me, this is Ryan Bowl at Rain, saying that maybe if the administration had have started by pulling the economic levers first, then we wouldn't necessarily be in this situation where so far kinetic activity has failed to bring about any kind of effective change inside the regime when it comes to finding a negotiated path to settlement here that would bring about peace for both sides. So all eyes now on whether or not the economic measures will actually work and whether or not we'll see some kind of change inside this country. It's back over to you.
Very good. Thank you, Dan. Well, that leaves us nicely for the next conversation with Paul Hasselbrink, who is a lead oil and gas analyst at Global Data. Paul, Dan's laid out a lot of the factors for us and why this wasn't done in February, perhaps many people are asking as well. But how effective will this be, given the fact that Iran has survived, not thrived, but survived decades and decades of varying degrees of sanctions?
I think the biggest telling factor is, as rightly pointed out, the fact that they didn't choose this as the first avenue, the fact that despite the heavy risks involved in military action and the escalation that actually materialized, that they deemed sanctions so ineffective that they chose to take that risk. Yeah. That's a huge tell. And I think between what was the first round of sanctions and then what came to be the sort of maximum pressure 2.0 earlier in the Trump administration, we've seen that the change in Iranian export patterns has made this sort of sanctions quite ineffective, and that's because 90% of Iranian imports into China are going to these teapot refineries that are just very able to just not be exposed to the dollar economy, and that means that there's basically very limited scope for these sanctions to work under the sort of current understanding that we have of them, given also that the binding constraint on Iranian supply during the last 6 months has fully been the blockade, not sanctions. We have seen exports hit a 6-year low under the blockade, while sanctions barely made a dent.
So the biggest, according to a piece that we have on CNBC.com, which is using World Trade Organization data from 2024, the largest trading partners with Iran are the aforementioned China, UAE, Turkey, Iraq, the EU, India, Pakistan and Russian Federation. What are the chances? I mean, the EU, I'm sure, would fall into line, maybe Turkey, but what are the chances of all these other nations, especially, I guess, China and Russia, falling into line on the back of a new US regime?
Well, it's also quite telling the fact that what we saw yesterday was Scott Bessent leaving out, sort of excluding from these sanctions, Chinese banks, port operators and state majors. That's also obviously a restraint that is very deliberate ahead of the Xi-Trump state visit. What we're likely to see is maybe some kind of olive branch from the Chinese. That's what I see as likely the most sort of effective sort of negotiation that could be had in the background between the US and China. But this exclusion of, as I said, Chinese banks, port operators and state majors really limits the bite of these sanctions. And we're looking at China as sort of the main focus in terms of financing essentially the regime currently. And that's also, I think we should add the toll regime and how that's been affected by the latest round of sanctions from yesterday.
In which case, will all this work?
I bring it back to my first point. I don't think they really believe that it will, unless, of course, there's something that's changed between February and now that has made them think that sanctions are more effective. Now, of course, Scott Bessent was really emphatic yesterday and he carefully chose his words in saying, we know who you are, we've identified you. So he's trying to at least speak directly to the enablers, to those people that are enabling the STS transfers of the ships and the oil, those who are enabling the financing of the steam pot refineries. If they have actually identified very clearly who is enabling them and they have found a way to stop them, then yes. But I would say trade on this at your own risk. That is not the base case that we have.
Are you surprised by any of the moves we've seen in the oil price this week, given, I mean, when they were ramping up the rhetoric about targeting Iran and trying to blockade all oil exports, we saw, I think yesterday, oil dropped around 2%, which to me doesn't make sense.
Yeah, I would say don't build your narrative around the sort of effectiveness, prospective effectiveness, or what the market thinks about these sanctions on the Brent price. It's just not the right signal. Also, as you rightly pointed out, 2.5% is noise, especially when there are missiles flying around. What we should look at is what we call the Shandong differentials, which is essentially the difference between the Brent price and what tin pot refineries are paying in China. Sanctions set the discount, they don't set the volumes. And so this is something that we're likely to only be able to see within 30 days or 60 days, where we can actually see the Chinese import volumes coming from Iran. This is not something that we should expect to be seeing on the Brent price. However, there is something that is yet to be factored in prices, which is, as I mentioned before, the fact that the expanded designations list is not the most consequential event that happened yesterday. It is actually the attempt to criminalize the Hormuz toll regime. Now, Iran has institutionalized the protection racket. It's been built around three entities: the Transit Authority, the Maritime Underwriter, and the Safe Passage Services. Now, this is much broader. It's much more significantly sort of covering the market, because it includes the barrels and the LNG that is coming from the wider Gulf. So it includes 20 million barrels a day of liquids. It includes over 80 million tons per annum of LNG.
So, Paul, just to come in on that point then. So, criminalise one of the key parts of what Iran sees the future looking like. That is, we will now charge for transit through the Strait of Hormuz. But the Omanis, who have under their own threats recently from President Trump, which is quite extraordinary, they clearly don't want to charge. They just want to have free transit again and be able to get on with their business without threats from the US and Iran as well. So what difference will that make? You think that's the key point? The Iranians say we want a toll. The US says it's a criminal act. That's just going to be more conflict rather than less, isn't it?
Indeed. It is inadvertently an escalation, and it means that shipowners will have to decide essentially whether to go uninsured, to go under sanctions, or to not go at all. What happens now is essentially very similar to what was happening under the start of the blockade, where ships will not be allowed through essentially by underwriters, because there's just not going to be any insurance on those ships.
Why is Ben's point is the right point? Why is the oil price very, very benign on the back of this, given the fact that the crack spreads, the refined product prices, and you mentioned the teapot refine as well, but the product prices are through the roof compared to the underlying Brent price?
I think there's two factors. One, the market is still focusing on the sort of the big headline of the sanctions and the fact that maybe the market still doesn't believe them to be quite effective. And second is that this is something that's yet to be priced in. What I mentioned later, the fact that possibly we're going to see a larger disruption to Hormuz flows because of the criminalization of the toll regime. That obviously, assuming it's going to be effective. And we're also coming to a point where the market no longer fully believes what the Trump administration is saying.
Okay, Paul, you covered a lot of bases. Thank you very much indeed for joining us today. Really interesting hearing your views. Paul Hasselbrink, who is the lead oil and gas analyst at Global Data. Coming up on the show, German business sentiment rises more than expected. This is turning into the show where Europe comes back, isn't it? We've had some very positive guests, and now we've got a positive IFO. We'll talk you through the outlook with the president of IFO. Don't miss that conversation after the break.
You can master your strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past 3 years, Interactive Brokers clients outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs through smarter execution. Access stocks, options, prediction markets, and more across 170+ global markets. The best informed investors choose Interactive Brokers.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Halftime Report, weekdays streaming on CNBC+.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
The race to commercialise physical AI is moving beyond humanoid robots. BlackBerry's CEO John Giamatteo says some of the biggest opportunities may be in warehouses, factories and medical systems, areas where machines need software that works safely every time.
What trends around AI do you think you're going to be able to tap into to drive future growth of the company?
We think that could be even a faster growing segment of the industry for things like robotics, AMRs, automated mobile robots that are used in supply chains all around the world to do pick, pack, and ship. You're probably not going to need people to do those things. You're going to see robots doing more of those things. We're seeing robots in, surgical robots with medical device makers that are looking for, opportunities for an embedded operating system to make sure that surgical robotic arm does what it's supposed to do every single time. Industrial automation is another segment or vertical inside, the whole physical AI space that we're very much focused on. So as excited as we are about the dynamics of the automotive industry and where that's going, these other applications around robotics and medical instruments and industrial automation represents a tremendous growth opportunity, and one that I think BlackBerry and our QNX portfolio is really well positioned to address.
And you can watch or listen to the full episode of the Tech Download right now, wherever you get your podcasts, or catch it right here on CNBC
this weekend.
It's like we've gone back to the future this week. I'm seeing BlackBerry, I've seen MySpace mentioned, I've seen Yahoo mentioned, all as comeback kids as well. It's like we just put this show 20 years ago. Right, let's have a look at the gainers. And it is gaining across the board despite everything that everyone seems to be fretting about, whether it's AI spending, whether it's the bond market, whether it's what Nvidia is going to come up with, what Walsh is going to say on Friday as well. Despite all of that, the market's just posturing on quite nicely at the moment and seeing some solid gains as well. Sectors rallying this morning include industrial goods, oil and gas, utilities and travel and leisure, the latter being up 0.5%. What sectors are in negative territory? Let's take a very quick look here. We have autos and auto parts under pressure, of course. Real concern about the ramifications of the upscaling of the war, as Mark Carney puts it. We are at war on a trade basis with the United States, he said now. And of course, those extra tariffs on autos and auto parts sending shudders throughout the entire industry as well. Household goods down 0.7%, as indeed is media. Food and beverage down 0.5%. US futures look like this. We are called higher across the board, and after the downtick we saw on the Nasdaq yesterday, seeing a little bit of a rebound there.
German business sentiment grew more than expected in August, according to the latest IFO data. The Business Climate Index rose to 88.8 in August, the 8th month, up from the 86.7 reading in July. Really tallies with what we've been hearing from some guests, this theme that Europe does have some appeal. It does have some competitiveness, it does have some momentum. I was just looking at the IFO email. Where is it? If I can find it. Have you got it?
I'm just looking at the same thing you had there. That is your IFO email.
The IFO email, yeah. It covers, there was gains in terms of the index. It rose in manufacturing, in services, in trade, in construction. So all areas of the economy, there's this improvement in business sentiment. And
that's despite the fact that the cost of money is still elevated. Concerns remain about the cost of money as well, and concerns about underlying trade wars and cost of energy, which is normally the factor that people say is the biggest problem. One of the two biggest problems. One of them is bureaucratic regimes and not enough easy trade flow between the different countries. But the cost of energy doesn't seem to be hitting the sides at the moment, despite where we are on Brent.
Yeah, and I think there are expectations we could see if inflation in the Eurozone continues, if there is further feed through as a result of the oil price and the ongoing conflict in Iran, markets pricing in the possibility of the European Central Bank hiking rates by the end of the year, the deposit rate potentially up to 3%. And as you say, in light of that, the fact that the sentiment is so buoyant, is so robust.
So whilst we wait for Clemens Fuchs, let's go through a few of the sectors as well. Manufacturing, the index rose noticeably. Managers assess the current business conditions as significantly better. I can't wait till we speak to Clemens Fuchs, because I really want to know how that is the case. They are significantly better. Also marked by less scepticism. Services, business climate improved. IT services providers more confident about their future developments, although transportation and logistics still under a bit of pressure as well.
Trade, the indicator rose, retailers expressing greater satisfaction, they said, with current business conditions. Expectations also continued their upward trend. In wholesale, it says, in particular, business sentiment improved significantly. And just the last key area, construction, the index increased due to noticeably less pessimistic expectations. So a lot of positivity to be found there. What is the source of it? Clemens Fuchs, president of IFO, may not be the source of it, but he's here to tell us the details. What did you make of these latest readings, Clemens?
Yeah, it certainly is a surprise, a positive surprise, and there are two factors in my view driving this. First, fiscal expansion. There's a lot of debt-financed public spending going on, in particular in defense, that is having an impact. There is spending going on in infrastructure. But what we also see is that part of this is coming from abroad. So exports are stabilizing, in particular exports to other European countries. industries, less so to China or the US, where German companies are struggling for various reasons, but exports are also stabilizing. So it seems that some adjustment has taken place in the industries with difficulties, but the economy is now stabilizing on this reduced level.
Just picking up on the manufacturing side of it, managers assess their current business conditions as significantly better. As Steve points out, though, cost of borrowing is higher, energy costs are higher. What is it? I hear your point about the fiscal expansion and the benefits that brings, but that's one element in the broader picture. What do you think is leading them to have this rather upbeat take on the situation?
So what we see within manufacturing is that automotive numbers are bad. So the mood in the automotive industry continues to be bad. But what's better is machinery, electric equipment. And as I say, it's money spent, public money spent on defense, on infrastructure, but it's also companies spending more on digitization, adjustment to artificial intelligence. So we see companies, for instance, in the chip industry, in electronics, benefiting from that. And then there is some stabilization in export markets. And it looks like companies to some extent have adjusted to the new situation. It's nevertheless surprising to some extent that, for instance, energy prices, which continue to be high, do not have that much of an impact. But again, the chemical industry has reduced production in Germany, and maybe that adjustment is over for the time being, and it's other industries taking the lead now.
Clement, Steve may touch on service and construction, but I just want to focus on manufacturing and trade, because the other reason I find it so surprising is we have spoken on this show recently about the problems caused by the heat waves across Europe. Germany, the Rhine, at some point, it fell to such a low level, it was not navigable, and we reported on production shutdowns as a result, shipping costs going up, the difficulty of transporting physical goods as a result of that crucial trade waterway being seized up. How do we make sense of that?
We do see negative readings in the logistics sector. Now, actually, the impact on logistics is ambiguous, because there is, of course, more demand for companies doing transport via roads. But still, they do feel the difficulties in ship transport, as well as the higher energy costs. That's where we see it. But in terms of industries transporting these goods, it's the steel industry and the chemical industry which is affected. But it looks like the other sectors have found ways to get around this and to adjust to this. It may also be that some impact here is coming later. But if we look at supply bottlenecks, for instance, we ask companies, do you face supply bottlenecks? And we see no big change here. So it seems that up to now, the impact of these transport problems has been limited.
Clements, good to see you. Your first answer said one of the reasons why we're seeing the uptick is debt-financed public sector. Is the government getting it right now with the guiding hand for the German economy?
Well, I think the demand the government creates, especially through defense spending, is welcome in this situation, in this weak economic situation. At the same time, it doesn't address the structural problems, the deeper structural problems, which are about cost competitiveness, which are about productivity, driven by digitization. At the same time, it looks like companies are investing into digitization, into the use of artificial intelligence, restructuring their production. But overall, I would say, the demand push through this debt financing is coming at a good moment.
So you mentioned the structural problems. So there are deeper issues that won't be solved just by spending, that the government and perhaps Brussels in combination with Berlin should be addressing. What are they, Clemens?
Exactly. It's red tape. It's partly inappropriate regulation, over-regulation, reporting requirement, but it's also a lack of flexibility in the German labor market. The German labor market, the regulations are very much geared towards preserving jobs, protecting existing jobs. That was fine in crisis where the crisis was about a transitory decline in demand and then a recovery. But what we're facing at the moment is structural change, for instance, away from automotive towards other industries. And if you face structural change, what you want to see is not people staying in their jobs, but people changing jobs. And regulations in the German labor market do not favor job changes. And that's why we see very few people changing jobs. But this is something we need. So these are examples of structural problems. The other thing is, of course, social insurance. Due to demographics, we face rising costs in pensions, in health, like many countries, and something has to be done about that.
Yeah, very interesting. I was speaking to Klaus Rosenfeld only last week from Schaeffler about how they're adapting from purely automotive areas to areas like humanoid robots and being part of that supply chain. So German companies are trying to adapt, and some doing it very successfully. Clemens, lovely. We always love our gauge of German sentiment. Thank you very much indeed for joining CNBC today. Clemens Fuest, the president of the IFO. Coming up on the show, the Coalition of the Willing reaffirms its support for Ukraine as it celebrates Independence Day in Kyiv. We'll discuss more after the break.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Listen to CNBC on the move with the CNBC app.
A lot of strong numbers this morning.
Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
I check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Fast Money is America's post-game show.
Near all-time highs against the S&P.
We want to arm people with the information to make great decisions.
Valuations matter in a higher interest rate environment.
Fast Money, CNBC, streaming on CNBC Plus.
If you're watching CNBC, it's because you want to get an edge, you want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I'm thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
Hello, welcome to Squawk Box Europe. I'm Ben Boulos with Steve Sedgwick, and these are your headlines. The US Treasury Secretary Scott Bessent cracks down on Iran, threatening severe sanctions on anyone doing business with the regime and suggesting China won't be exempt.
We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
Scott Bessent insists the Treasury will stick to its auction schedule even amid its buybacks. Germany's finance chief pinning the blame for the spike in global yields on the Iran war. Bitcoin passes $80,000 for the first time since mid-May, following a 20% rally last week, as renewed inflows into spot Bitcoin ETFs boost the cryptocurrency.
Let's check in on the markets. What are we now? About an hour and a half into the trading day, and European equity benchmarks all in the green this Tuesday morning. The Italian and German markets leading the way, more than 0.4% higher. The CAC 40 up almost 0.33%, and the FTSE 100 is the slight laggard, but still trading positively this morning. There has been quite an interesting move. Vistry, the house builder, has shares have popped more than 17%. The London-listed house building group getting funding from the government, £350 million. To build 3,000 affordable homes, so that helping lift its share price there. In terms of gainers more generally, these are the sectors where we're seeing the biggest gains. Industrial goods, top of the board there, up 1% or so. Travel and leisure, it's been having a good week, almost 0.9% higher on top of the gains we saw yesterday. They were up 1.7%, travel and leisure stocks. Utilities, banks also on the board of green. This is where the laggards are to be found, and it's car makers and parts giving up 1% or so. Media stocks down, household goods, food and beverage all retreating this Tuesday morning. Plenty to watch out for stateside this week. We can pull up the US futures after a Monday in which all the benchmarks, well, two of the benchmarks closed lower. The Dow was the only one of the three that finished Monday higher, looking for the Dow to build on that and for the Nasdaq and the S&P to recover some of those losses. We got Nvidia latest results, of course, on Wednesday. We've got the PCE inflation data on Wednesday, and we've got the Fed chair speaking at Jackson Hole on Friday. So plenty for investors to anticipate and position this week. Steve.
Britain and France have pledged stronger military support for Ukraine after a meeting of the Coalition of the Willing in Kyiv yesterday. The two nations committed to providing support, including access to classified technology and faster delivery of defence missiles. Speaking at a press conference in Kyiv, marking the country's 35th year of independence, leaders of the Coalition of the Willing threw their support behind Ukraine.
The clear message to Putin should be that Ukraine will never give up territory that Russia cannot win on the battlefield, and negotiations must start from the line of contact. On that basis, we should keep pressing Russia to agree to a full and unconditional ceasefire now and work with the US on that effort.
We should also be mindful that Russia will try to escalate against European countries in order to deter them from assisting Ukraine. And I want here to reiterate my solidarity vis-à-vis all the colleagues being targeted or having targeted during the past few weeks. And it's clear that NATO countries will be targeted and the provocations will multiply.
We need to make sure that the winter package of air defense will be in Ukraine, and we need winter package of Patriot missiles, and we need, and that we hope that we will have this package. We need at least 300 Patriot missiles for the winter and for the cold month. Every missile means lives to be saved, and so please continue this work through Pearl, through bilateral, our dialogue and different decisions.
UK Prime Minister Andy Burnham says he's planning to travel to New York next month around the UN General Assembly. Speaking to UK broadcasters whilst in Kyiv, Burnham said he would likely join European leaders in holding another Coalition of the Willing meeting in a bid to secure Patriot missile interceptors for Ukraine. The trip would be Burnham's first to the US since becoming Prime Minister in July. Tom Bailey is head of research at Han ETF and joins us now. Tom, nice to see you. Look, we've come an enormously long way. I'm just thinking about the more recent history of Ukraine, not since independence, but since 2014 when I was in the country first, and the military was hopeless. It was outdated. Yanukovych had defanged the country and it couldn't stand up to the Russian invasion of Crimea and elsewhere in the Donbass. Spin forward to, I don't know, the end of that decade, 2019, 2020, and the West was beginning to supply a large amount of weaponry, including, probably its finest moment, Boris Johnson being a great advocate of Ukraine having Western missiles and Western defensive capability. So let's get through to 2026 now as well. That relationship, though, has gone from hopeless, unable to defend themselves, to actually learning to use Western technology and having the education to use that equipment effectively in 2022, to 2026, where it's more symbiotic now, isn't it? There is a useful on both sides. Ukraine supplying technology and expertise to the West, and vice versa.
You're right. So, at the beginning of the full-scale invasion, Ukraine was largely a recipient of European and American military aid. And it's developed gradually since then to much more of this, as you say, symbiotic relationship of essentially the two industrial ecosystems of Central and Western Europe and Ukraine becoming increasingly intertwined. So Ukraine has developed its own defense capabilities, particularly in areas like drones, but also long-range strike capabilities in, say, cruise missiles with the FP5 Flamingo missile, which Western companies, Western European companies, are looking at licensing production themselves. But also it's a two-way street here. So at the same time, now we've seen this announcement that Ukraine will license the Storm Shadow missile for production inside Ukraine itself, as well as the previous month with the French-Ukrainian agreement to start producing the Aster-30 counter-ballistic missile interceptors as well. So it's very much you're seeing these two industrial ecosystems start to merge together and this symbiotic kind of relationship forming.
Yeah, can I ask something, which may be a dumb question, I'm not sure as well, but it seems to me that the battlefield itself is barely moving. Maybe we hear about some Russian advance in the Donbass, and then we hear about the Ukrainians having a little bit of a pushback as well. But it seems to me that all the action is happening in Russia, with warehouses and what have you being attacked, and refineries, what have you, and elsewhere in Ukraine, where it all can't be defended against the Russian ballistic missile threat as well. So you've almost got two wars going on. You've got the front line, which is barely moving, and then you've got this other tit for tat going on country by country.
Yeah, so obviously you have the front line in Donbass and other regions of eastern Ukraine, but you have this air campaign essentially being waged by Ukraine against Russia in order to impose costs or increase the cost of Russia waging this war, and also to disrupt their logistics and their economy. So that's what we've seen particularly this year, is this use of extensive long-range deep strikes inside Russia, targeting both obviously its energy industry, and then more recently some of the logistics hubs with the Wildberries facilities within Russia itself. So, and likewise Russia is obviously targeting Ukrainian cities and civilian centres with ballistic missiles as well. So you do have in parallel these kind of different air campaigns they're waging at the same time to try and obviously shift the dynamics on the battlefield itself.
But then I don't see what happens to move the needle on this one. If Putin is saying we have maximalist demand still, and Ukraine is refusing to cede any more ground, and yet Russia, okay, its economy is under pressure, but it's still pretty well financed through hydrocarbons, what have you, to carry on the campaign, and the West has committed, or certainly large parts of the West has committed to carry on financing the resistance from Kyiv. I don't see how anything is changing apart from, as you say, maximalist pressure on both sides and both economies. What changes?
Yeah, I mean, ultimately, with the latest announcements, say with the Storm Shadow and the Aster-30, these aren't going to fundamentally change that kind of the stasis that this conflict is in, but it does increase Ukraine's capability to continue to wage its air campaign and continue to impose those costs on Russia, and at the same time, with the Aster-30 interceptors, to be able to better defend its cities against these Russian attacks. So the latest news isn't, it's not a fundamental change in the military balance within Ukraine, but it is a positive development in terms of showing obviously Ukraine's ability to kind of potentially increase the pressure on Russia and impose greater costs on Russia, and as well as that deepening of relationships between Europe and Ukraine, and showing the commitment of Europe to supporting Ukraine in the fight, however long it does end up taking.
It feels like one of the developments recently has been that both sides, Russia and Ukraine, have realised that they need to try and hit the source of revenues that are funding the defence capabilities. And we've seen with Russia, it has really tried to clamp down on the ability of Ukraine to export grain through its ports. On the other hand, Ukraine seems to now be very specifically targeting big Russian retail and commerce warehouses. Does that change things at all, or is that just an evolution of what we've seen before?
Yeah, I think it's more of an evolution of what we've seen before. Obviously, if you see the kind of Ukrainian success more recently, it has actually been a combination of these kind of deep strikes against Russia and disrupting logistics, and at the same time, obviously, the advances they've made in terms of the deployment of drones in a tactical sense on the battlefield. So, the idea that the air campaign itself isn't necessarily going to be the fundamental change in terms of the war itself, but it's a necessary part of the strategy Ukraine is pursuing.
And then in terms of, I don't know if you have any thoughts on the row that seems to have erupted over whether there should be wartime elections or not. Does that sort of political division weaken Ukraine in the way that Zelensky says it has the potential to?
I mean, it obviously has the potential to, but it's also, I mean, very clear that this was not a dispute between kind of different factions of the Ukrainian government in terms of their commitment to defending their territory against Russia's aggression. It's very much a different visions in terms of how that war should be fought, and obviously the dismissal of the defense minister, and then after that the Syrsky, the commander-in-chief of Ukraine's armed forces. That kind of political division obviously can be unhelpful in a time like this, but I don't think it fundamentally changes the kind of political commitment of Ukraine to regaining its 1991 territory, or the support of Western governments, particularly European governments.
Brief Q&A, Tom, just to finish us off. To your expertise, can you see either side winning this war?
I mean, it's
moving the needle on the battlefield.
It's very hard to say. I wouldn't want to, because ultimately, if it's Ukraine's decision in terms of what is an acceptable outcome in terms of territorial losses and recognition of these of any of those losses by the international community, etc., and how that plays out. It's not necessarily my place to say kind of what Ukraine should agree to. Its commitment now is to restoring its 1991 borders, and that is still the position of, or at least European government.
Would accept a frozen conflict on current battlefield lines, wouldn't they?
Yes, but at the same time with some form of security guarantees, because that's obviously the risk is allowing Russia to rebuild and re-strengthen its military capability.
If they have a strong military, which they have, and then they have Western expertise, which they have, and their own expertise, they don't necessarily need kind of a couple of thousand British troops or a couple of thousand French troops on their land, do they?
It's important for a potential trigger. Obviously, if you had those peacekeeping forces within Ukraine itself, as literally a physical barrier to stop further Russian advancement. But at the same time, we can say security guarantees is also ensuring that Russia's not allowed to impose its own demands on Ukraine, which have included stuff like demilitarization of Ukraine and ultimately the dismantling of its industrial defense sector, which is now obviously vital for Europe itself. So that's also one of the other challenges, is to ensure that any peace deal doesn't end up leaving Ukraine kind of open to further attacks in the future.
Thanks, Tom. I went over a little bit, but thank you very much indeed for that. Much appreciated. Tom Bailey, Head of Research at Han ETF.
Still to come on the show, Bitcoin passes $80,000 for the first time since mid-May, following a 20% rally last week, as renewed inflows into spot Bitcoin ETFs boost the cryptocurrency. We'll delve into that in more detail after this short break.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to that high-level information and help explain to every single person out there watching why what's happening in these complex markets matters for their lives today and in the future. That's what drives me. I love being part of this.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4?
We are gearing up for the biggest IPO of the year. Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented.
This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
Extreme heat and droughts have put European agriculture under strain, and the impact is being felt in one of France's most famous exports, champagne. Grapes are now ripening faster, with workers rushing to harvest almost 2 weeks earlier than usual to preserve yields. Jenny Reid filed this report.
This year's champagne harvest will be the earliest on record and potentially the least fruitful. Extreme heat and drought have pushed the grape-picking harvest forward by almost 2 weeks across the famed French region. And timing isn't the only concern. Sweltering heat is accelerating ripening, making grapes sweeter and narrowing the picking window. That's a problem for champagne, which relies on a slow maturation process for its signature crisp taste. Some winemakers, desperate to diversify revenue, are leaning into tourism instead, now a profitable and growing part of the industry. But the macro picture isn't much better. Producers shipped more than 260 million bottles last year. However, weakening demand and global uncertainty have driven prices in the investable wine market down around 25% between 2022 and 2025, according to fine wine online marketplace Livex. But it isn't bad news for everyone. Rising temperatures are making England's chalky soil viable for sparkling wine. Champagne house Tattinger has already bought land in Kent to produce it. Wine production across the UK surged by 55% between 2024 and 2025, totaling more than 16.5 million bottles, according to official data. One UK-based winery told CNBC the growing season is also moving earlier in the year in England, but remains long enough to make the future of sparkling wine in the UK exciting. Climate change is the biggest threat facing champagne's future in France. But across the channel, England may be an unlikely winner. Jenny Reid, CNBC Business News.
Can't call it champagne. That's not the only difference, but wow. I'm just trying to prod my French friends as well. And Karen, who obviously knows the difference between the two. Apparently, English sparkling wine and champagne share the exact same grape varieties, which is Chardonnay, Pinot Noir and Pinot Meunier, and use the same traditional bottle fermentation process. However, England's cooler climate produces a lighter, crisper style with higher acidity, while champagne offers a richer, toastier profile from warmer conditions and traditional aging. But I suppose as global warming gets worse, we're going to get more of that kind of toastier profile with warmer conditions.
That drift of the conditions, meaning that southern England is just as suitable for growing those grapes.
I heard the wine industry is in a lot of trouble anyway, to be honest, because people are drinking a lot less anyway.
Well, a lot of people can't afford to go out and spend the money on the drinks, given the...
Unlike yourself. He's out on the lash.
It all adds up, doesn't it? It all adds up. Interestingly, though, there is one winemaker founder who says, in 30 years, I've never seen a year like this. I was so stressed, but it looks like we could have a really good harvest, bucking the trend there. If you want to read more on his take, you can find it in the article about the earliest champagne harvest on record. It's in Jenny's piece, which is there for you on cnbc.com.
In the meantime, Scott Bessent said the US Treasury will stick to its planned auctions of long-dated bonds, even after he announced an operation that would at least double buybacks of the same securities to at least $4 billion per operation. That expanded buyback program is expected to begin on September 10th for 10 and 20-year durations, according to Reuters. But that's a drop in the ocean compared with the nearly $740 billion in debt the Treasury Treasury expects to offer to investors this quarter. It also isn't clear how Bessent plans to pay for the move. The Treasury isn't the Fed. It can't print its own money. One way, though, would be to borrow at shorter durations. The other would be to use the Treasury's own funds. Now, as sources have told CNBC, great piece from Steve Leisman online, Bessent has built up the Treasury's general account to nearly $1 trillion. He could run that down a little with bond purchases and still have some time to replenish it before any potential debt ceiling impasse down the line. Of course, that would entail selling even more bonds. Now, the move is coming under scrutiny. Stanley Druckenmiller penning an op-ed in the Wall Street Journal warning that rising rates are a sign of trouble ahead and that artificially suppressing it only heightens the danger. In the article, though, Bessent's former mentor writes that governments defending prices against fundamentals always lose, saying the US shouldn't put itself on the wrong side of that trade. Meanwhile, a note out of Citadel has warned that tighter monetary policy may be in order, as the solution to the debt problem is not repeated intervention, but harder choices on fiscal policy and central banks willing to get ahead of inflation. Also signaling uncertainty, the gold price, which is on course for its best month this century. How extraordinary.
Well, the unease is spreading across the Atlantic. Germany's Finance Minister Lars Klingbeil laying the blame for rising yields firmly at America's door, telling reporters they are a consequence of global uncertainty brought about by the war that Donald Trump started in Iran. German borrowing costs currently trading around a 15-year high. Don't miss our comprehensive coverage of Jackson Hole, the gathering there starting Wednesday.
And a quick word on Bitcoin, which has now crossed the $80,000 mark for the first time since mid-May. Early this morning, it's just below it again now, as you can see, but it was up there on the right-hand side of the screen. Renewed inflows into spot Bitcoin ETFs and improving risk appetite extended the cryptocurrency's recent rally. Bitcoin started tracking higher last week as it surged over 20% in 3 days. Huge rally for its biggest three-day gain since 2023. Institutional demand has also returned, with ETFs attracting almost $2 billion in net inflows last week, their largest weekly haul since October. And there you can see a lot of the extended hours trading and the crypto stocks. Right, that is it for today's show. From Ben and myself, Steve, have a lovely day. The great show that is Morning Call coming up next.
One hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC. Never miss a moment.
Cybersecurity fundamentally needs to change. Every organization needs to up-level its cybersecurity practices.
Non-technical people can create a website, can write code. The same thing will happen in financial services.
If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. It's totally individualized because we know today cancer is a disease of DNA.
I started investing a little money for my dad, and I got by the bug. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
Combat sports icon Ronda Rousey. She's conquered the UFC, dominated the WWE, and now she's sounding off on both.
It's extremely oversaturated right now. There's too many fights.
San Francisco 49ers owner Jed York. He sat down with us to explain how he turned the team around and the critical lesson he learned. Plus, influencer Jesse Rydell, also known as Jesser, explains his simple ingredient for online success. This is CNBC Sport on the Record.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Lunch, streaming on CNBC+.
The AI boom is reshuffling the global equity market rankings, with Taiwan and South Korea leapfrogging past long-established markets. Taiwan has climbed past Canada and India to become the world's 5th largest equity market, while South Korea has moved into 6th place.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about 3 companies at the heart of the AI hardware supply chain.
It's the AI theme which is driving things. So we have this kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth.
So what does this reshuffle tell us about how AI is changing global stock markets, and what are the risks?
I'm Dominic Chu, and this is your morning call. Good morning, everyone. I'm Dominic Chu in for Morgan Brennan this morning. U.S. equity futures are at least moving in the green right now, with the Dow coming off back-to-back winning sessions. At the moment, the Dow's implied higher by roughly 130 points, the S&P by about 19, and the tech-heavier NASDAQ trade north of 200 at this point. We're watching Treasuries as well as the debate over Secretary Bessent's intervention rages on. We are seeing, though, U.S. Treasury prices bid. We're seeing higher prices, lower yields. Right now, the 10-year note yield 4.69%, the 2-year note yield 4.23%, and the 30-year long bond 5.22%. Ahead, why Stanley Druckenmiller calls it tantamount to quantitative easing. Now, amid the moves in the bond market, the dollar is also seeing some moves as well here. At the dollar index, currently standing at just about 99. We're down, though, about 2/3% over the course of the past week or so. Debasement trade monitor with Bitcoin hitting its highest level in 3 months as well. Keeping an eye on some of those prices. You can see, at least with Bitcoin, right now, 1 1/3% gain there, 79,859. We did crack that 80,000 mark earlier on. You can see Ethereum prices $2,482 per token there as well. Metals also surging with gold at 3 months highs. You can see here COMEX gold now pulling back by just about 1/3%. $4,683 per ounce. Silver, $67.74, off about 1% there. And then on energy prices, still in focus given the conflict in the Middle East. U.S. benchmark West Texas Intermediate down about 2.25% to $83.02. ICE Brent crude futures, the world gauge, $90.16, off by a similar percentage amount. Sticking now with the Middle East, and the White House unveiling an anti-Iran global sanctions plan it calls Operation Economic Outcast, as it looks to open a new front in its war against Tehran.
We are launching an economic onslaught against Iran's financial connections around the globe. Our objective is to sever every economic lifeline that sustains this tyrannical regime until Tehran stands alone.
Treasury Secretary Scott Bessent adding that his, quote, economic D-Day is a final warning to countries, including China, to sever their business relationships with Iran or risk being cut off from the dollar-based financial system. Well, we've got a global reaction now with our Dan Murphy in Abu Dhabi and Eunice Yoon in Beijing. Dan, we're going to begin with you.
Tom, good morning. Well, here in the Gulf and Arab capitals, Operation Economic Outcast is now in play. The Trump administration stepping up its campaign to cut Iran off from the global economy here, threatening secondary sanctions against countries, banks, and companies that continue doing business with Tehran. The opening salvo basically targets everything from Iranian oil sales to digital asset networks, but the announcement was also light on some details and stopped short of naming and shaming countries in the crosshairs. The Treasury Secretary basically saying instead, you know who you are, and you can expect a call from Trump on the timeline. Now, China, the UAE, Turkey, Iraq, and India are among the top trading partners of Iran, and new CNBC reporting says this effort, if implemented, could significantly sever Tehran's economic lifelines after nearly 6 months of war. Yunus is going to speak about China in a moment, but here in the UAE, Dr. Anwar Gargash, diplomatic advisor to the UAE president, posted on X just a short time ago saying the escalating economic pressure announced overnight shows Iran's attacks on the Gulf states have backfired, deepened its isolation, and weakened its position. As for Iran, its top voices are also doing their best to dismiss this campaign. The parliamentary speaker Mohammad Ghalibaf said no one believes the American bluster, and also claims that Iran's trading partners had said they would ignore the warnings. And Iran's economy minister also saying Tehran is prepared and warning that its response may not be purely defensive. So, Dom, China is really the central test here. It buys about 90% of Iran's oil exports, historically providing Tehran with billions of dollars in annual revenue. The administration saying the pressure here could create conditions for regime collapse inside Iran. But after more than 6 months of war, the key question now is whether Washington is going to risk its wider economic relationship with China to enforce the threat, and whether this greater economic pain will actually change Tehran's position. It's back over to you.
All right, Dan Murphy live in Abu Dhabi with the latest reaction from the Middle East. Now to the reaction, as Dan pointed out, from China, and our Eunice Yoon with that side of the story in Beijing. Eunice.
Thanks, Dom. Well, perhaps not surprisingly, the Chinese Foreign Ministry was very critical of the U.S. steps, saying that the American sanctions undermine the rights of other countries and that the pressing priority of the Iran conflict should be de-escalation and holding talks. The state media has also been very focused on President Xi, who has been hosting the King of Jordan, saying that there should be a need for dialogue to resolve this U.S.-Iran war. Now, this is the message that we've been hearing out of the leadership for the past several days, really trying to paint China as the responsible statesman. And even as China has been accused, including by the U.S., of being destabilizing on a lot of global hotspots, including Iran. Bessent had sanctioned 60 entities, including China, as well as Hong Kong-listed ones. These companies and people are generally in a network of middlemen in trading, finance, as well as shipping, moving goods that include sensitive technologies with a little-known exposure to the U.S. But in some respects, China has kind of gotten off easy because none of the big banks or the major refiners were included on this list. It's unclear, though, whether or not the U.S. is going to get tougher on China, even as China, as Dan had pointed out, is a very important partner economically with Tehran, or if China would engage in Bessent's, what he described as quiet diplomacy, because what we also learned today from the foreign ministry is that they would not disclose whether China had heard from the U.S. on a timeline of enforcement. They didn't say anything about the Chinese banks. And in fact, the state media, as well as the Chinese foreign ministry, avoided completely any discussion that any Chinese or Hong Kong-listed companies were included among those 60 entities, Dom.
Eunice, another question, though, given the fact that they're being somewhat radio silent on those topics, has there been any chatter from the state-linked media or official channels with regard to some context or color around whether or not this changes the dynamic for President Trump and President Xi possibly meeting in just maybe a month or so's time?
So far, there has been radio silence in the official media on that front. But in terms of just discussions in China circles, that's exactly the question that people are wondering about. They were wondering, will the U.S. really have the stomach to get tough on China if they, really wanted to isolate Iran, because they have just in a couple of weeks. President Trump apparently, or expected to host, I should say, President Xi Jinping on September 24th.
All right, Eunice Yoon live in Beijing with the latest there on the Middle East and China. Thank you very much for that. Let's bring in now Chris Campbell, founder and CEO at In-Camera Solutions, also a former assistant Treasury Secretary during the first Trump administration. somebody who's got a little insight perhaps into what's going on with these sanctions and everything else. Chris, first of all, welcome and thank you for being here with us. You heard the reports from both, you heard the reports from both Dan and Eunice, kind of outlining some of the contextual points of view from the Middle East side and from the Chinese side. These sanctions, we don't have a whole lot of details on them, but can you tell us from your experience, are they that much worse than what Iran has already gone through for the past several years? And what exactly can we expect to see happen if Secretary Bessent's plan comes to fruition?
Yeah, again, it's good to see you again. Thanks for inviting me back. Look, I think that it's a brilliant question, and the challenge is that the U.S. approach to sanctions has always been on Iran has been very, very difficult. But now we're at a place where they've significantly maybe tripled or quadrupled down on those sanctions. Let's scene set a second. Iran is, has a 90% inflation rate going into these sanctions, and on the kinetic action we've been taking with them. But these sanctions are different than the sanctions in the past because these are more systemic sanctions. It's sanctions against governments, sanctions against whole sectors of economy. Is noted in the lead-in, crypto technologies, gold, aviation, shipping. And then by Treasury putting those categories together, it allows the Treasury Department to impose sanctions at a much more rapid rate, and not go individual by individual or company by company, but by sector by sector, and that will be a significant punishing and brutal to the Iranian economy. And of course, classic Trump style, these sanctions have a strategic ambiguity as to how they will be enforced, and so I think it's it'll be on the time and manner that which the Secretary Bessent and the President decide, and I'm sure that they'll use that to maximum leverage to be able to maximize their ability to be able to negotiate a solution within the Iranian conflict. And then these important to note, of course, these sanctions are different than sanctions in the past, of course, because you already had kinetic action in Iran, and so these are being imposed upon Iran and their allies. In addition to kinetic action that's happening in the space, and then there's also a smaller humanitarian carve out in these sanctions that we've seen in sanctions in the past, which will, I think, put a significant amount of pressure in Iran. I think the outcomes likely are going to be that I think we'll probably see a moderate economic impact immediately in Iran, but a significant punishing political impact in Iran as they further isolate around the world. The president, as in the lead-in suggests, the president is calling foreign leaders and putting extreme pressure on them to be able to live up to these sanctions. We'll see how how those foreign leaders and foreign governments respond. But it certainly suggests that the secretary and the president are not they're getting very serious about the imposition of these sanctions and the carrying out of.
Okay, so that's the Middle East side. Let's do it like we did with our reporters. Eunice had the Chinese side as well. How does this affect the dynamic for the upcoming anticipated meeting between President Trump and President Xi Jinping?
Yeah, so look, I think that meeting is TBD, depending on how China acts and how we react to what China does. Again, a scene set here. China has, as you know, Dom, China accounts for about 90% of crude exports out of Iran. Significant economic relationship and very important to the Chinese economy. But I think that going into these sanctions, China has signaled some formal opposition to the sanctions. I think we'll likely see some informal opposition to it as well. And as Gina suggested, that for the first time ever, we actually have the real possibility of secondary sanctions being imposed on China. And buried with Secretary Bessent's comments was a threat to perhaps a Chinese financial institution. That would be an unprecedented step from the United States government should we impose sanctions on a financial institution within China. I believe that obviously would have some significant destabilizing effects within the relationship, and likely would have a different outcome should that meeting occur between President Xi and President Trump later this year.
All right, the world still runs on dollars, so we'll see how those sanctions play out. Chris Campbell, thank you very much for the insights. We'll see you soon, sir.
Thanks.
All right, let's see how markets in Europe and Asia are shaping up and reacting to some of these developments. Elaine Yu is standing by in Hong Kong with the latest there. Ben Boulos has been tracking the early action in Europe out of London. Ben, we'll begin with you.
Yes, good morning to you. European equities ticking higher this Tuesday morning. The Pan-European Stock 600 up around about 0.4%. But much of the attention firmly on the events later this week. Nvidia earnings expected to be a major test for markets, especially the AI trade, when we get those figures on Wednesday. Meanwhile, Fed Chair Kevin Warsh, as you've been discussing, set to give a keynote speech at the Jackson Hole gathering on Friday. This is the picture across the key benchmarks, equity benchmarks in Europe, all of them trading in the green this morning. Yesterday, it was only the FTSE 100 in London that closed above the flat line. The other three were all closing Monday in negative territory, but recouping some of those losses. In terms of sectors, travel and leisure stocks are ticking higher this morning, building on the gains that we saw yesterday. The outperformer yesterday, also on the board of outperformers this morning, up almost 1%. Oil and gas shares also have been climbing after US Treasury Secretary Scott Bessent threatened severe sanctions on anyone doing business with Iran. The oil and gas basket increasing value despite a sharp fall in the oil price. Brent crude, when I last checked a few moments ago, down around 2.5%, dipping below the $90 a barrel mark. Meanwhile, shares of European car makers are continuing to lead the losses in today's trade, and those are the other sectors that are giving up ground today as well. Dom.
All right, Ben Boulos with the action out of London. Thank you very much for that. Now to the action in Asia. Our Elaine Yu has that story. Elaine.
Good morning, Dom. So investors are certainly watching uncertainties in the Middle East and also the Jackson Hole speech later this week. But it's a mixed picture in Asia. Taiwan, Korea, and Japan stocks all recovered from a U.S. chip sell-off and gained as investors wait for Nvidia's earnings for clues on where the AI trade is headed. The TAIEX, the Kospi, and the Nikkei all closed less than 1% higher. But the bigger moves were really in China. China's EV maker XPeng plunged 9% in Hong Kong today after the company issued a weaker than expected forecast on its third quarter deliveries. Citi said that this guidance fell short of investor expectations, especially as the company faces what's likely to be supply chain disruptions and constraints. And this is despite XPeng's robotics business securing a valuation of $6.3 billion in a funding round. Now, staying on robotics and physical AI, China's best-known humanoid robot maker Unitree has been all the rage earlier this month, right? But it has slumped 45% from a peak at one point during its debut. It's been down 36% in the last week, but it's still up 300% from the issue price. Now, it had a massive first-day pop that was driven by retail hype, and there are now bubble concerns. Back to you.
All right, Elaine Yu with the action out of Asia. Thank you very much for that. We've got a lot more to come here on Morning Call, including the $280 billion market wildcard facing investors when Nvidia reports later on this week. Plus, what Kevin Warsh has to say at his first Jackson Hole symposium as Fed chairman. And then later on in the show, the AI data center pushback as more governors join a growing chorus of states saying, "Not in my backyard." Very busy hour still ahead when Morning Call returns after this commercial break.
Listen to CNBC on the move with the CNBC app. A lot of strong numbers this morning. Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
When Amanda Lacaze took over Lynas Rare Earths, the company was on the brink of collapse.
I put my hand up because the people in the business deserved someone to give it their very best shot.
12 years later, she's leaving behind the world's largest rare earths producer outside China. Can one company really challenge China's dominance?
I'm confident. We've got good people in Australia, we've got good people in Malaysia. Not only can we compete with anyone, we can win.
Find out more on Managing Asia.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC Plus.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. And I think CNBC allows our viewers to fulfill their passions. I could not imagine covering anything else.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked, I get it. People say they overpaid, I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
All right, welcome back. Investors continue to digest the latest round of sanctions on Iran and Canadian tariffs as well. The developments adding to an already busy week for the markets with PCE inflation data, NVIDIA earnings, and the kickoff to the Jackson Hole Economic Symposium still to come. For more, let's bring in Ben Emmons, the founder of FedWatch Advisors, a guy who's seen a lot of catalysts in his days. So let's talk about the plethora of macro that's on the calendar these days. We'll start maybe dovetailing off the conversation that we just had with Chris Campbell about Iran and China and everything else. Sanctions-wise, there is an effect on the overall scheme of the market, the feeling in the market right now, but it doesn't seem to be the primary catalyst, at least for the time being. And that is Scott Bessent's perhaps use in the future of the Treasury's general account to buy bonds. What exactly does this interventionist Treasury have to do with the future stability of the interest rate market?
Well, they could affect it, no question. You know, if you're going to deploy this whole balance at the checking account of the Treasury at the Fed, then it's $935 billion or so. If you were to actually buy with that amount all these long-term bonds, even though you have to fund it with other debt, but that's a lot of money, right? So that could affect interest rates. Whether they actually will do that is to be seen. You see Druckenmiller coming out with some criticism this morning. There's other people are skeptical, and I do think that they pay attention to it. Like, you can only affect interest rates so much, right? Ultimately, it's the markets, it's the economy that drives interest rates in one direction or the other, and the market's so large in treasuries, 22 trillion. It's like a currency market, right? So it's like not that simple. But I do think that the Treasury will at least go forward with these bigger buybacks. And then we'll have to see what happens at the intervention.
There are a lot of folks who are trying to kind of game out, scenario analyze what could happen at certain levels of bond buying, the types of assets that are being targeted. This is, in essence, kind of what the Fed does to control monetary policy and money supply. But the Treasury at the executive branch is trying to do it now. How exactly, then, could they either work with each other, either by coordinated efforts or non, because they're not, they're separate entities. But how exactly could they then maybe run into loggerheads with each other as well, given policy on the monetary side and the fiscal side?
Well, if you think of coordination, what then would happen is that the Fed would absorb all the T-bills that the Treasury would be issuing to buy the bonds. But if they get to loggerheads, then it's exactly that part. It's like, as we know how Kevin Warsh feels about the balance sheet for fiscal policy, he's not necessarily going to agree with that approach. So it's going to be the Treasury that's going to likely be on its own, having to issue a lot of T-bills to try to buy more long-term bonds, and hopefully rates go lower This is why I think a lot of people are skeptical that the effect, how the Treasury affects the Treasury yields is less than it would be as the Fed did, like say in 2011 when they did that type of operation.
What do you make of the market's current reaction to some of the bond buying and intervention programs that have been talked about by the Treasury Secretary and that have already actually happened, right? You know, for some of the currency side of things and everything else. The market reaction has been fierce and swift for a very brief moment, and things have generally gone back to kind of where they were. How much does potentially using a near $1 trillion Treasury slush fund to kind of juice that particular trade help matters or hurt matters? Is it really the bazooka that Hank Paulson had during the financial crisis?
There's actually a different bazooka there, Dom. If you think about how many treasuries are outstanding in the long end of the curve, that's $6.5 trillion. If you actually were to do that, buy $6.5 trillion, say, and then issue the debt on the other side, that would be the biggest bazooka, because you take all this debt out. That's very different what the Fed does. Fed buys bonds but keeps on the balance sheet and still in the system. The Treasury, when it buys debt, it retires the debt. It just issues new debt. But to your point, like intervention, typically what happens, you get a sharp reaction and then you drift back to the level where the intervention happened. This happened with the yen. This is now happening with the 30-year. I think the market's trying to test the line and say, where is this line on the 30-year or on the yen? And I'm sure that they will try to, control those lines, but the market's too big, right? So I don't think they're going to manage it.
Well, the old saying is, "Don't fight the Fed." We'll see if they fight. We'll see if they fight the Treasury.
Yeah, or fight the market.
There you go. Thank you very much, Ben Emmons. We appreciate that. All right, straight ahead on the show here, the IPO pipeline heats up amid new reports a major wearable tech giant is readying its public market debut. But first, checking the VanEck Vectors Steel ETF, or SLX, which rose for a second straight session yesterday on the back of the collapse of the U.S.-Canada trade talks this past weekend. Taking a look at some of the biggest gainers in the ETF, Steel Dynamics, Nucor, Cleveland-Cliffs, you can see there, are moving generally higher in the pre-market trade. Keep an eye on steel. Morning Call is back after this.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
This is not just good content, this is good business. It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
I'm with Becky. This is the greatest show on earth.
Squawk Box, streaming on CNBC+. Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green, Saturday and Sunday afternoons, only on CNBC.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
Welcome back to Morning Call, checking some of this morning's latest headlines. Billionaire investor and Scott Bessent mentor Stanley Druckenmiller is calling into question the Treasury's recent actions in the bond market. Writing in a Wall Street Journal editorial, governments defending prices against fundamentals always lose. Multiple reports, smart ring maker Aura is considering a U.S. IPO as soon as September as well, having already filed paperwork to raise as much as $3 billion at a more than $16 billion valuation. Also weighing possible U.S. offerings, according to reports, data center operator Switch, SoftBank-backed SB Energy, neo-cloud company Nscale, and Duncan parent Inspire brands as well. Alabama's Attorney General is opening an investigation into OpenAI after its models hacked Hugging Face last month. The probe looks to see whether OpenAI violated the state's consumer protection laws or poses an ongoing risk to its citizens. And the Trump administration is reportedly set to revoke the business and tourism visas of as many as 200,000 people that have applied for or are currently seeking asylum in the U.S. If it goes through, it would be the largest single mass revocation of visas in U.S. history, but would likely face legal challenges. The expected move reportedly would impact so-called B1 and B2 visas issued between 2016 and 2026, whose holders have sought or are seeking asylum. And then SpaceX is using a new partnership with NVIDIA to accelerate its plans to launch orbital data centers as soon as next year. Elon Musk says his company plans to launch its first Starmind AI-1 satellites by the fourth quarter of 2027. Well, still on deck for the show here, the U.S. data center political pushback, what it means for your money, and reaction to Jim Cramer's hot take on which firms will make it out on top. Morning Call's back after this.
This political pushback might be a godsend for the hyperscalers. They can comply with these new rules the small fry can't. Classic case of government regulation crushing the small fry and boosting the big boys. Here's the bottom line. This data center pushback may be a victory for big tech. A real cynic would say that they should back the new rules. Clarity and a little money to each town, along with electricity subsidy and a clean water commitment would suit them fine, helping their bottom lines and crushing the smaller players that are trying to compete with them.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4? We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision certainly got more interesting over the last couple of months.
Here's what investors are watching this morning.
China is the world's second largest consumer market behind the US. In 2025, the country's total retail sales of consumer goods exceeded about 50 trillion yuan, or about 7.2 trillion US dollars, up by 3.7% year-on-year. With a population of 1.4 billion people, the market has long been a cash cow for global brands. But today, success is no longer a given, with some Western brands struggling and even scaling back operations in the country.
When you think about live streaming and social media, the hottest new thing is going to bubble up overnight, and you have to have it the next day.
The number one thing that you will see is how little loyalty Chinese consumers are because of the brands and how fast they innovate and how quickly they push things out. Consumers are very used to being hit by new concepts, new designs.
So what does it take to win in China?
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates.
A strong number this morning.
Listen wherever in the world you are. Download the CNBC app now.
All right, let me tell you about ambition. To me, too much is not enough. You have only one life, so go all out. The only way you're going to accomplish all the big goals is if you have a vision. Find out what you want to do, set the goal really high, and go all out. And then you create another vision, and another vision, another vision. So that's being ambitious. Be useful. That's what my father always said. Don't just waste this life away. Be useful, help other people. This is what it's all about.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
I'm Dominic Shewan from Morgan Brennan. Welcome back to Morning Call. Checking U.S. equity futures right now. They are solidly bid with the Dow coming off its back-to-back positive sessions. It's implied higher by 240 points, the S&P higher by 30, and the NASDAQ 100 higher by 270. Taking a look at Treasuries, the benchmark 10-year note yield currently stands just below the 4.7 now, 4.676%. The 2-year note yield, 4.225%. Tracking the dollar as well, it's seen a down week for the most part, fractionally lower, about 2/3% for the past week, currently sitting at 98.96 for the ICE U.S. dollar index. Now, the debasement trade monitor with Bitcoin hitting its highest level in 3 months here, topping 80,000 briefly at one point, currently at 79,871. Metals also surging with gold right now at 3-month highs. You can see here gold prices $4,690 and change at things currently stand right now. And a look at the energy complex on the back of those U.S. sanctions on Iran. U.S. benchmark West Texas Intermediate currently down 3%, $82.46. Brent, the international benchmark, $89.52, off by 2.75%. We're also watching shares of NVIDIA after kicking the week off with a nearly 3% drop ahead of the earnings report tomorrow after the bell, riding a 7-session sliding session, its longest losing streak in 4 years. Options traders are pricing in a 5.5% swing in the stock one way or the other on the back of those results tomorrow, or about a $280 billion shift in market value. The expected move would be below NVIDIA's historical average price swing of around 7.5% over the course of the last 12 quarters. We'll have more on that story coming up here. Well, the growth of AI data centers in the United States is surging, with power demand projected to double by next year. That's straining local power grids and leading to backlash from local communities that do not want a data center in their backyard. With a Gallup poll showing this spring, showing that 7 in 10 Americans oppose construction in their area. Politicians on both sides of the aisle are now pushing back as well, with governors in Pennsylvania and Texas recently signing orders placing restrictions on new development for those data centers. Here is Texas Governor Greg Abbott explaining his decision.
These data centers are coming online that people didn't see coming. The other is the way that the data centers, they didn't do their job to get the support of people in local communities. Gaining the support of people in local communities is essential. Because they did not do that, that's why I am now coming in as governor saying, listen, if you're a data center and you want to operate in Texas, you have to first get the approval of those in local communities.
All right, some strong comments coming from Governor Abbott. AI companies are taking notice of this wave of negative sentiment. CNBC reporting late last week, Anthropic's IPO prospectus, which is expected to be filed in the coming weeks, will list this as a potential risk factor. In preliminary meetings with investors and bankers, the company is being asked what happens if there is a slowdown in the build-out of data centers. Let's talk more about the challenges with Sarah Kunst, the managing director at Clio Capital. And you know, it's interesting, just a few weeks back, we had a conversation with Chris Crosby, who's the CEO of Compass Data Centers, one of the biggest privately held data center developers in America. And what he had to say was, hey, local communities, tell us what you want. Give us the list of what you think you need for us to do this, and we will help make it happen. There is seemingly a dialogue that will happen between local communities and these private developers. What else needs to happen for data centers to become more viable without such public backlash?
I think they have to provide some value to the public, right? And not in this sort of long tail, hey, you know, now your Google search results are a little bit better, or it's a little bit easier to do stuff when you're using a Meta product. It has to have a tangible benefit. And for many of these people, it doesn't. And I also think that the sort of tech ethos of move fast and break things does not translate well to City Hall. And they are finding that out in real time. This isn't like Uber, where a lot of people said, hey, actually, we don't really care about the taxi monopoly. We want to be able to get from place to place. In this case, they're looking, saying, what's in it for us? We're not getting anything out of this. And it's become a really good indicator of, hey, very little is going our way for the average American. Why should we let this through on top of everything else?
What can those data center developers and hyperscalers and other people who are trying to build these AI data centers do to get that public support? Is it something like, hey, we're going to build you X new schools and or a fire department and or a new kind of recreation center, or how many jobs do we have to bring? What kind of collection or what portfolio of benefits do you think local communities are looking for to greenlight these projects?
I mean, I think there's two pieces there, right? What the local city councils and things are looking for, as well as what local people are looking for. We know that data centers don't bring a ton of jobs. This is not, you know, Ford in the 1950s starting factories and providing generational, solid blue-collar working class jobs. This is, hey, we have to bring on a few plumbers. We pay them a lot of money at the moment. But then once it's built in a year or so, it takes a few security guards, right, and a couple maintenance people, and that is your employee base. So many of these communities, I'm from Michigan, where there's been a lot of this, outrage. And we have seen, especially since 2008, that very few big employers, very few big companies that come in, keep their promises, do much to benefit the community long term. It's hard to tell a state like Michigan, where Michigan still doesn't have clean water, that, hey, the data centers will take care of you. And so I don't think it's about the data centers per se. I think they've come to represent something much, much bigger.
Are we also now seeing some of the ripple effects on the valuations of these large AI-oriented companies? I had mentioned Anthropic listing possibly in their prospectus coming up, a risk being the kind of pushback on data center buildouts. Are we seeing some of these valuations possibly at risk in not just the big private ones, but also the big hyperscalers that are publicly traded as well because of the AI, at least pause?
So I think what you're going to see is a market sentiment shift. I do not think that this is the safest time in the world to be a big tech CEO, a data center CEO, even though it might be one of the most lucrative times in history. I think that for these CEOs, for the NVIDIAs of the world, where you're used to sort of being beloved and you wear your leather jacket, everybody recognizes you, everybody loves you, that sentiment has markedly shifted, and I don't know if it's going to come back anytime soon. I think for the IPOs, we're going to see them have to stand more on their merits than on hype and excitement. And as we're seeing in real time with SpaceX, that doesn't go super well. Once you dig into the economics and you say, wait, you're not going to be profitable till you go to Mars, and you don't have any way to get to Mars. And so, I think that you're going to see a much more critical lens applied to these IPOs. And then for the big companies, I think that there will be an increasing consumer sentiment concern. I think that Main Street, while not the biggest buyer of stocks, is going to pull back because they don't like these names and they're also starting to believe in them less. And I think we'll also see, does the AI adoption actually scale with the data center build out? We know that almost every enterprise study we've seen says actually we're spending too much on AI and we could not tell you how it's helping or what it's good for. We have to hire people back or we have to roll back our layoff plans, right? So it doesn't seem like AI is working well kind of anywhere. And then the data center piece of it is just that very loud, very noisy, maybe polluting, pushing up your power prices, physical manifestation that you can kind of throw rocks at.
All right. Sarah Kuntz at Clio Capital with the AI data center pushback. Thank you very much. We'll see you soon. A lot more to come here on Morning Call as well, including commercial real estate showing some signs of life. Dinah Olick breaks down the one component essentially left for dead. That's now helping fuel that rebound. And as we head to break, a check on the automakers after getting hit yesterday on President Trump's threat of 50% auto tariffs on all imports coming from Canada starting in January. After falling between 1 and 3.5% yesterday, shares this morning you can see are relatively stable. Morning Call is back after this.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could just follow the markets and talk. And my ambition was to be able to pay my bills and not have to constantly be selling. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
I think if I knew how complex was trucking, I think I would have thought again. So the unknown was very helpful.
Gaurav Biswas thought he had landed on a simple idea. Uber, but for trucks. There was just one problem. He had never moved a truck in his life. Then one day at dinner with friends, he saw a problem he had never thought much about.
He was constantly having to walk out of the restaurant, and we could see that he's arguing or shouting with somebody. I was like, hey, is everything okay? He's like, oh, I have 7 containers that have to go on the same vessel tomorrow. Then I said, hey, you should have an Uber of trucks.
That idea became Trucker, a digital freight platform that connects companies that need to move cargo with the truck owners and transporters that carry it.
Trucking is extremely important as a sector because whatever you touch and feel, consume, it's all touched a truck. Whether it's a seaport or an airport or a factory, the trucking is that connector.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budgets are. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall things. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you. And you need to be on this learning curve forever.
Welcome back to Morning Call. To commercial real estate now, seeing signs of life after a rough few years, including the reality of higher for longer interest rates. Diana Olick has exclusive new details in this week's Property Play. Diana.
Well, good morning, Dom. That's right. Investors are getting a boost in both confidence and credit, resulting in more competitive bidding for commercial real estate. Bidding for properties in July posted its strongest monthly improvement in a year. That's according to quarterly bidding and credit indexes from JLL, released first here to the Property Play. Now, the month also saw the second highest count of unique bidders in the index's 5-year history. Competition among lenders is also well above previous record highs. The spread between credit and bid intensity is actually narrowing after you see that peak spread in May there. Credit is the leading indicator for bidding. In other words, credit availability sets the tone for liquidity. Now, all this even though macro uncertainty in the economy prevails and interest rates remain stubbornly high. So, where's the action, right? Here's a surprise. Retail. After that sector was declared all but dead due to e-commerce, retail is seeing new life. The bidding for properties is also getting more competitive. And that's because current landlords like their returns and so aren't so interested in selling anymore. Also, industrial continues to see strong demand, much of that thanks to onshoring manufacturing to reduce supply chain risk and, of course, avoid tariffs. Now, the weakest sector continues to be multifamily, as an oversupply of new construction still makes its way through the pipeline and rents remain flat to slightly lower. Now, for much more on this story and a brand new tracker for data center financing, you were just talking about it, it's all in this week's Property Play newsletter. Drops in a couple of hours. You've still got time, cnbc.com/Property Play. Dom.
All right. Thank you very much, Diana Olick, for that. We'll keep an eye on that Property Play newsletter as well. We appreciate it. Straight ahead on the show, the Morning Call crew assembles, teeing up the trading day ahead, and the story one member says is the real catalyst for markets right now. It's time for your call sheet coming up. Keep it right here.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC+.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What did the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
The AI boom is usually told as a Silicon Valley story, but some of the biggest winners are thousands of miles away in South Korea. And their windfall is now spilling into an unexpected place, the housing market.
Before we saw this massive rally this year, people just like to invest in the housing market because there is no alternative for savings and investment.
From January to April 2026, home buyers used about 3.7 trillion won, or roughly $2.4 billion from stocks and bond sales to fund purchases.
The government wanted to boost the stock market so that people could move away from homes into the stock market, but people are coming back to the property market with the money that they earned in the stock market, and it's also sort of this vicious cycle.
The danger is not that one stock market sell-off would immediately crash home prices. It's that the same wealth channel pushing stock gains into housing depends on confidence.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school, and I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's gonna give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
Time now for your call sheet. The crew members assembled today are Jessica Inskip of stockbrokers.com, Tim Seymour of Seymour Asset Management, also a CNBC contributor, and Victoria Fernandez of Crossmark Global Investments. Our first topic today will be, of course, geopolitics. It's front of mind right now, whether it's Iran and or Canada. And maybe I will start, Tim, with you on this one here. The global investing background that you've had have maybe colored some of your opinions of how markets do react in times of geopolitical uncertainty. How important are Canada and the U.S. and the U.S. and Iran to the market narrative overall?
I think they're very important. I certainly think U.S.-Iran, if you think about oil price and the correlation, what we've seen with the 10-year, and I think the markets are all about the 10-year here. I think the U.S., Canada, the latest on trade, I think we're going to work through it. I think the concern around what those headlines mean is a lot less important than probably the sanctions and what China is thinking in terms of the impact on the U.S.-Iran sanctions. So, yes, all very important. I think how it boils into the 10-year and the 10-year rates and where we are in the long end is very, very important here.
Well, speaking of, everyone's got their eyes on interest rates because not just of that, but we've got Jackson Hole coming up as well and PCE inflation data. Jessica, I'll go to you for this one. If you take a look at the way things are shaping up for the markets, they seem to be at least shrugging off, for the most part, higher yields on the long end and the threat of maybe bad catalysts on the interest rate side down the line. Is the market, in your mind, justified for not being as, I guess, volatile around those rates?
I think it's very susceptible to shocks right now, and I think it's interesting how those rates have subdued, but I think a lot of that has to do with what Bessent has announced, and it's a balance of items where we want to hear what's happening with PCE. That will give us indication on the front end. We've got competing now on the long end with the 30-year in fiscal policy. So how is Kevin Warsh actually going to interpret that? And that may be perhaps what the market is actually waiting on. We have some uncertainty. It creates ceilings from a technical perspective. That uncertainty needs a catalyst, and right now that's clarity, and I feel like it's just communication. So the next 3 days are going to be very interesting in the market for sure.
Now, Victoria, it seems as though, based upon what Jessica laid out, this is a wait-and-see market. Everyone's waiting to see what Kevin Warsh says at Jackson Hole. This is not from that to massive monetary. What exactly would you expect out of Jackson Hole?
You know, Dom, I'm afraid up and go get yourself a cup of coffee. You may miss the whole speech. I mean, he has not been known to be long-winded, especially when we're looking at the press conferences after the FOMC meeting. So I actually don't expect us to get too much information. I know there's a hope by many that he will get out ahead of the September FOMC meeting, give us a little clue as to what's going to happen, but he just doesn't seem to lean that way. I think he's still waiting to get all the reports from his committees that he put together before he makes any kind of big statement. And when you look at the 10-year that we've been talking about this morning, it is in this kind of wedge pattern, and I think it's waiting to either hear something out of Jackson Hole or hear something on the geopolitical front before the 10-year breaks out one way or the other. But I'm afraid it's not going to be Jackson Hole that gives it what it wants to hear.
All right, so from the macro to the biggest, arguably microeconomic driver of the markets this week, it's going to be NVIDIA earnings after the closing bell tomorrow. Tim, I'll start with you on this one here. What are your expectations, and just how much has NVIDIA been kind of a new barometer of the AI trade? We know it was the poster child before. It's relatively flat since its last quarterly report.
Well, it's down 7 straight days going into at least today, and going into earnings. I think it's a pretty decent setup to be honest with you. I'm concerned about semis, and if you look at where they've performed relative to the S&P, they've certainly rolled over. They've certainly rolled over relative to themselves. Nvidia, to me, is going to be a story about circular financing. It's going to be a story about gross margin. It's going to be more of the big picture, I think, than the small picture. So I kind of like the setup for Nvidia here. I'm not as, I would just say, concerned overall about the circular financing, other than I think the impact we've talked about on the macro is very important here. So very important to get through this number. And unfortunately, then the markets have nothing less to focus on but the macro.
Jessica, you're an options expert. Take us through what the options setup is. What's it implying? I talked about the move 5.5%. Do you expect it to come to fruition?
I do. What's interesting is the moves and the implied moves have actually started narrowing, and I pulled up implied volatility as well from the past implied moves, and that has also come down, which makes sense mathematically. If you have less moves, we're going to have less implied volatility, at least from a projected perspective. I think what's interesting, though, is we have this competition with the options market, almost with the bond market, if that makes sense. And it's all very related. Even when we're thinking about the debt that's happening with all of these hyperscalers, they're competing for funding also within the debt market. And so there is almost this ceiling that is happening with rates across the market, and it's boiling into micro. So really from Nvidia, yes, the implied move is 5.5%. I'm sure we'll see something around that. But what I really, really want to understand is what's happening with financing and the diversifying of revenue outside of semis.
All right. Yeah. Jessica Inskip, Victoria Fernandez, Tim Seymour, thanks very much for being part of the crew today. We appreciate it. Keep it right here. Squawk Box starts right now.
Good morning. The Trump administration moving to severely isolate Iran's economy. One key question, though, how will China respond? And the U.S. is also ramping up the economic fight against Canada. President Trump says he's going to hike auto tariffs starting next year. And some pointed criticism from a Wall Street luminary against the Treasury Department's move to buy those bonds, those long bonds. It's Tuesday, August 25th, 2026, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Right now, it looks like the U.S. equity futures are sharply higher this morning. Dow futures indicated up by over 260 points. This comes after 2 days in a row of gains for the Dow. And in fact, after yesterday's close, the Dow was only about 2.4% from an all-time high. The S&P 500 and the NASDAQ closed down for 2 days in a row yesterday, or 2 out of the last 3 sessions yesterday. The S&P 500 this morning indicated up by about 32 after yesterday's close. It was about 2.1% from an all-time high. And then the NASDAQ is off by about 4.5% from an all-time high. This morning, though, it's indicated up by 300 points. Energy prices, something we've been watching closely. They have climbed in recent sessions, but this morning they are down by about 3.4%, coming after some of this announcement of this economic D-Day. $82.18 for WTI. Brent is trading below $90, $89.22. And then you've got Treasury yields at this point a little lower as well. The 30-year sitting below 5.2%, 5.19. 10 years at 4.66. The 2-year is at 4.21. Finally, Bitcoin prices this morning are higher, sitting just below $80,000, $79,115.
Meantime, Iran now vowing retaliation against a new set of U.S. sanctions. Iran's economy minister telling state television the country is prepared for the economic hit. That followed the Trump administration announcing what it's calling Operation Economic Outcast to isolate Iran's economy after 6 months of war. Treasury Secretary Scott Bessent stopped short of issuing secondary sanctions on Iran's trading partners, saying he didn't want to rattle the global economy.
We believe that a warning shot and a level set of expectations is appropriate. And if people do not want to meet our expectations, then we expect, and they should expect, that they will leave the dollar system.
Treasury Department did penalize a group of vessels and entities for violating U.S. sanctions policy. Bessent said President Trump is making requests to world leaders to stop dealing with Iran and will lay out timelines to halt specific activities. All this, of course, raising lots of questions about what it exactly means to have an economic D-Day at all and just how far this could ultimately go and what those conversations in the fall will look like when President Xi Jinping arrives in D.C., because you could have as many conversations as you want with some of the countries in the Middle East, but it's China that's the ultimate story. And the other question is this the chip? I don't know if it's a chip that you have to use, but is this the ask that's going to be used rather than every other ask, whether it's on trade, whether it's on tariffs, whether it's on AI? I mean, there's a long list of things that this president is going to want to do with China, and how you're going to do that at the same time that you anticipate sanctioning them for this.
Without any of the sort of ancillary questions, what's happening in Iran is getting dicey right now in terms of currency and in terms of everything else. And over the weekend, we started seeing it manifested by not the military types, but by the domestic types, where they're feeling it, and that's the piece in the journal today. It was already getting bad, and it's going to get much worse, and that's usually a time when things can collapse on their own internally, and that's what we're hoping for. Hopefully, we won't have to even deal with the bigger issues with China or other countries. Keep our fingers crossed, and hopefully this will do it. Hopefully.
In fact, the U.S. government's moves won't currently impact China, although the Treasury Secretary did suggest the key Iranian trading partner would not be exempt from U.S. penalties. Eunice Yoon joins us right now with more on this from Beijing. Eunice, it's good to see you.
It's great to hear from you, too, Becky. The foreign ministry, perhaps not surprisingly, was very critical of the U.S. measures, saying that these sanctions undermine the rights of other countries and that the, quote, pressing priority on Iran is to de-escalate and hold talks. The state media has also been citing President Xi Jinping, who's been hosting the King of Jordan here, as stressing the need for dialogue. Now, this is a message that we've been getting from the leadership over the past several days, basically painting China as the responsible global actor, even when it has been criticized, including by the U.S. government, of being destabilizing when it comes to global hotspots, including Iran. So Secretary Bessent announced sanctions for 60 entities. That included Chinese as well as Hong Kong-linked ones. These companies and people are generally associated with middlemen and in trading, finance, shipping, who transport goods, including sensitive technologies. These entities have little known exposure to the U.S., but in some respects, China has gotten off easy because none of the companies on the list are big refiners or major Chinese banks, which is really important to the Chinese. Now, it's unclear whether or not the U.S. is going to get tougher on China. China accounts for 90% of Iran's oil exports. It's a huge trading partner for Iran. But what's also unclear is whether or not China would cooperate, because the Treasury, in fact, Secretary Bessent had announced secondary sanctions just a few months ago on kind of this network of refiners. They're called teapot refiners that are sort of off the books, that find workarounds to be able to accept Iranian crude. That when those secondary sanctions were announced, the Chinese government directed those companies to ignore the United States. So even though state companies, like the big ones, and especially in the financial industry, are very much, by and large, following U.S. sanctions regulations, but it's like these smaller ones have not, and a lot of that is also because the Chinese were encouraging them to ignore the U.S. rules.
I guess, Eunice, we get back to this meeting between Xi and President Trump that's coming up in September, and the potential for pushback from China. If they don't want to go along with this, they still have things like the rare earth minerals to fall back on. We're working on close to a year where we've been at a truce over that situation. What's your sense from the rhetoric that you hear in terms of how willing the Chinese would be to use something like that again?
Well, I haven't heard from rhetoric just like in official media. Nobody's talking about it. But just in conversations in China circles, people are saying, yeah, just two words, rare earths. You know, the Chinese have all this leverage with rare earths. And from what I do understand, the Chinese side and the U.S. side are both working towards potentially renewing the truce on rare earths curbs. Because they want that. So if you suddenly have a situation where the U.S. is going to crack down on the Chinese when it comes to their support for Iran and making kind of this big deal of it, kind of pointing their finger at the Chinese, that the Chinese would find that destabilizing, insulting, and then potentially use their own leverage, which is to flex their muscle when it comes to rare earths curbs.
There's no talk yet of that meeting in September being called off.
Nope. From my conversations with people who are familiar with the planning, it's still on course. That right now the conversations are ongoing, and that the focus is the hope that they would be able to renew this agreement that they had, especially on rare earths. But as of right now, it is still on the books.
But Eunice, just so we understand, do you believe that if they do have that meeting in September, it turns into a meeting almost entirely about Iran? Or do you believe it could be a conversation that talks about rare earths, that talks about tariffs and the like, that talks about trade, that talks about artificial intelligence? I mean, there's a laundry list of things this administration, I think, wants to get done with China. And the question I'm trying to grapple with is just how forceful the U.S. will ultimately be with China, or how interested China will ultimately be in cooperating with the U.S. insofar as it appears that China's already saying it's that it cooperates with Iran and it doesn't want to be disrupted.
Yeah, I mean, it's hard to say. I think that a lot of these topics are being discussed. I mean, I've heard from a lot of different, just in a lot of different conversations with people who are either kind of close to some of the planning, that topics do come up, that there is a hope that you would have a discussion about AI. But the focus seems to be more on making sure that there is a renewal of this truce that the U.S. and China currently have. And so in that way, the Chinese would have some leverage. If they see that the U.S. Really wants to get this renewed, then, you could ask, why would the Chinese kind of go along with what the U.S. says, or why would they tolerate the U.S. Cracking down on them on Iran?
Eunice, thank you. It's good to talk to you. We appreciate it.
Legendary investor Stan Druckenmiller taking the Treasury Department to task for announcing it's going to increase the size of debt buybacks. A big piece in the Wall Street Journal, an op-ed piece. Druckenmiller said the fall in yields and the quick rebound after Treasury made its announcement last week showed that the market, judged the government's campaign not to be liquidity management, but price management. He writes that in the lead up to the government's move, the bond market wasn't being a vigilante, as some would say, others would say vigilante, some would argue, it was being a pushover that had finally begun to clear its throat. And Treasury moved to quiet even that. You know who Druckenmiller is. They want me to tell you he's a highly respected investor on Wall Street and obviously mentored, you didn't know, Treasury Secretary Scott Bessent. We both were at Soros earlier in Bessent's career. And then, Druckenmiller had 30 years of, 30% a year. It's not some crazy number, never had a down year, so he's known for being pretty savvy. He called for returning the buybacks to small scheduled operations and above all tackling the deficit as the only way to durably lower long-term yields. He said it even better in the piece. I just want to read a little bit about it. I've spent 5 decades trading on a simple premise: markets aggregate information no committee possibly possesses, and prices how that information reaches decision makers. It sounds like Rick Santelli talking about there's only one arbiter of what's really true, and that is the market. And he goes on to say the long-term Treasury yield is the most important price in the world. He also says the only way to handle this is fiscal discipline. Every basis point of artificial yield suppression is a subsidy to not dealing with our entitlements. Neither party will run on entitlement reform. Both have spent the past decade expanding commitments while ignoring arithmetic, and that's the bottom line. If we don't, and we're going to have some guy on, another guy that wants, you know, the wealth tax guy. Everyone wants to raise more revenue. No one wants to do what is necessary, and that is to stop the spending the way it is now. That is the problem.
You know, when this first happened last week, when the buybacks were first announced, there was a lot of talk and a lot of people around Scott Bessent were actually pointing at Stan Druckenmiller and suggesting this is something that Stan would like and bless.
Right, and that was not true. Yeah.
And that was not true.
Yeah.
And I think that this was a genuine rebuke of the Treasury Secretary. This is a genuine rebuke of the strategy and a genuine rebuke of the idea that he even has asymmetric information. In fact, the quote you read, this idea that no committee or that no individual,
the market's
telling
you what
and I think that this, for a lot of people, surprised people last night.
I don't think so because of Warsh. And this is antithetical to what Warsh is trying to do, and Warsh is a very close.
I was going to say the other side of the story is
it wasn't surprising to me.
Well, I would say that last week there were a lot of people who were looking at this and saying that this was a good to the supporters of the administration and to the supporters of Scott Bessent. There were all sorts of people who were saying, "Oh, this is completely in line with what the sort of Druckenmiller school of economics would do."
Which, by the way, that's probably why he felt like
compelled to write.
And long term,
just to
obviously, it's
separate himself from it. I asked him if he wanted to come on and talk about it. He did not.
I was talking to him yesterday. I did not ask him to come on because I knew I know better at certain points. He said what he wanted to say. I did talk to him because I responded to Elon Musk yesterday. He said there aren't enough humans left in countries, and I said I vote for more dogs.
Yeah.
And I sent that to Stan because we're both big GSD lovers. So, but I didn't even. I know when he wants to come on, he lets us know when he wants to come on.
But I think that's a key point. He doesn't want to come on and talk about it. He wanted to separate himself from people who were saying this is this. I don't know if it's a rebuke of the Treasury Secretary as much as the policy. They are close friends, have been for a long time.
I'm surprised a little bit in that he wants to let, Warsh is the guy right now,
and this makes Kevin's job a lot more
but
difficult.
I think he's distancing himself
from all of it.
From all that. Right.
I think what's most interesting is I've been thinking about since last week. You can't fight the Fed. Does this mean you can't fight the Treasury? And Druckenmiller brings up you can't fight the market. You know, his point is you can't fight the market.
This doesn't sound like Santelli and yelling at Leisman every day.
Well, and by the way, they're the ones, he and Soros and Bessent were the ones who broke the Bank of England and were able to push back on that with the pound trade back in 1992.
I think we all know that these are. I still think that if you throw a little bit of a question mark to people that are locked into a trade, that at least they got to think about it. But long term, these band-aids never work. Things are going to. What he's talking about that we're looking at, and that's 40 trillion. I don't know what entitlements are at this point. The participation rate 66%. If you stack benefits, you can live at home. For on $60,000, there's plenty of reasons. We're at 24% of spending. We're not doing it. Neither party has any. I don't know. They don't have the courage to talk about what we. And if they did have the courage to talk about what we need to do, they'd be out of power anyway. So you're not going to get elected.
We're going to continue this conversation, I'm sure, throughout the broadcast. Do not go anywhere. When we come back, we're going to talk about how markets are digesting the latest geopolitical headlines from Iran to Canada, as well as the Treasury Department's move to buy back more bonds. That is next. Take a look at gold. Yesterday, it hit its highest level in more than 3 months. Stay tuned. Squawk returning right after this.
Today's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Powerline, streaming on CNBC+.
A market shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot, despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
Combat sports icon Ronda Rousey. She's conquered the UFC, dominated the WWE, and now she's sounding off on both.
It's extremely oversaturated right now. There's too many fights.
San Francisco 49ers owner Jed York. He sat down with us to explain how he turned the team around and the critical lesson he learned. Plus, influencer Jesse Rydell, also known as Jesser, explains his simple ingredient for online success. This is CNBC Sport on the Record.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
Joining us right now, JJ Kinahan, the CBOE Global Markets Senior Vice President of Retail Expansion and Alternative Investment Products. JJ, this is a big week for the markets. Lot happening in terms of what we were just talking about with what the Treasury's doing, what Stan Druckenmiller has said about the Treasury's moves, but also with what we anticipate coming from Chairman Warsh coming at the end of this week. How are you kind of preparing for it, and what do you see happening in the markets ahead of that?
Well, and before that, Becky, we have NVIDIA earnings, which I think is going to be a big thing. So we'll switch tomorrow from micro to go to macro overall. And so I'll start with NVIDIA earnings, first of all, because I think they're a real testament to how the options market has changed over the last few years. And what I mean by that is if you look at the activity there, you've seen yesterday we saw almost 2 times the normal amount of trading we've seen over the last 10 days in options. In stock, we only saw 75% of what we see normally. So as people are starting to play earnings overall, they're starting to do more and more through the options market rather than the stock market. And a few interesting things to keep in mind when it comes to NVIDIA, people are expecting about just over a 5.5% move based on what the options market is telling us. And in fact, we've seen a lot of bullish activity over the last few days on 220 calls, 225, even a 230 calls that are all expiring on Friday. But one thing to keep in mind is that if you look at the last couple of years on what's going on in there, people have actually overestimated the move in the stock more than 70% of the time. And in fact, the implied move has been just over 7.25%. In actuality, the moves have been under 5%. So I think that that's something to keep in mind as we go into the earnings also. And of course, you know, what they're expecting is, I think, going to be hard to meet. You're expecting a 97% year over year lift in revenue. I mean, it's absolutely crazy when you think about the numbers that they're throwing out.
What's the volume on the puts versus the calls?
The calls are traded about just over 2 times more than normal, and the puts just about it's a little less than 2 times normal. So it has been pretty evenly distributed, to be honest with you, Becky. You know, a lot of the puts have been the 200 and the 185 put line. So, you know, that 185 put would be a pretty good move down, just at the very tail end of the expected move. And
go ahead, JJ.
No, go ahead, please, Becky.
Well, how does that compare with what we've seen over the month of August? I mean, typically it's a slower trading season. How is it kind of evolving around the NVIDIA earnings?
Well, as I've said, you know, the last few quarters, last couple of years, we've seen priced in about just over 7%. So it is less of an expected move than we have seen. But in terms of the volume, I think that, you know, NVIDIA is always a retail favorite. And so NVIDIA is usually within the top 5 traded names every single day in terms of both equities and options. So again, as we go, and that's why I compare it to the last 10 days, because I think it's more of a fair comparison as to what we've seen in the volumes in August.
What about just what we're seeing in overall market activity? Let's get back to the macro, because I think that's what's driving things this morning. Stocks are much higher in the futures market this morning. Overall, the indexes are up, and that's probably because oil prices are down substantially. What have you seen when people are kind of betting between oil and what's going to happen with the markets?
Absolutely, Becky, and as you guys were talking about there a moment ago, you know, obviously heading into Jackson Hole, there's a lot of expectation. I think that the expectation may overwhelm the actuality, only because, as we know, you know, Fed Chairman Warsh usually is not a man of a lot of words, and in fact doesn't seem to love talking one way or the other. And so I think there's going to be a lot of expectation around his speech there. I don't know that we will necessarily get satisfaction about what he's going to say. History would kind of tell us, from what we've seen from him in throughout his career and since he's taken over his Fed chair, that he may not say a whole lot there. But I do, you know, the point that the markets are the final arbitrator that you guys were making before you went to the break is of course true, but it usually takes a lot longer to get to the market being the final arbitrator, particularly if you're going to have the Fed or, you know, somebody else, I won't say interfering in the market, but certainly being involved in the market, you know, the Treasury in a way we really haven't seen in a long time. And then of course take on top of that the statements out of Secretary Bessent yesterday afternoon throws a wrinkle into the possible conflict. That said, I look at the VIX. The VIX is telling us that the market is taking all of this in stride. It actually seems unbelievable to me that we've been stuck near this 15, you know, under 16, 15 and a half to 16 range. And so it really is incredible that the market is not acting. And so just, you know, mathematically, a 16 VIX implies a 1% move for the day. And so I don't think that that's crazy one way or the other. And again, market just taking the S&P 500 in stride.
Okay, JJ, thank you.
Great to see you, Becky. Have a great day.
You too.
Coming up, smart ring maker Aura reportedly gearing up for an IPO. I just knew that was actually what was coming up, luckily, because I'm looking at no help from you in the control room. Details on that story next. Squawk Box is up.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned. Sponsors disappeared. Fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
Crypto FC on The Score.
1 hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC. The Exchange, streaming on CNBC Plus.
Welcome back to Squawk Box. The smart ring maker Aura reportedly considering an IPO as soon as next month. Bloomberg reporting that Aura is now looking to raise up to $3 billion in a public offering, which could value that company at more than $16 billion. Last October, it raised $900 million in a Series E funding round that valued Aura at $11 billion. I've talked about my Aura ring for a very long time. However, I don't know if you guys saw late last week, there is a class action lawsuit against Aura claiming that Aura, the sleep stages that Aura reports, they're claiming are effectively a coin toss, meaning that the algorithm unto itself can't figure out what sleep stage you're in. I've now looked through the lawsuit. I have lots of views about it.
Well, can you tell us? Is it right about the sleep?
I don't think it's necessarily right about the sleep. I think what they're arguing is in the case is that to actually monitor sleep, which is true, to genuinely do it in terms of how they're marketing Aura, you would want to put patches on your brain and your feet and all the things you do in a sleep study, and that the ring unto itself is not doing that. What the ring is doing through an algorithm is approximating what.
No kidding, though, right?
That's what I read the lawsuit and thought. No kidding. Of course, the ring is not tracking it that way.
Right.
Except that they have that what Aura has said thus far is that the results that come off the ring are, I believe, 95% accurate relative to a sleep study. So that the approximation of what's happening on your finger is 95% matching.
So they're going to try and get them on the marketing?
I don't know. I mean, it went. The headline went everywhere. By the way, of course, because people know that I wear the ring, I was sent the article about 10,000 times, and then of course I went to read the case. But it's interesting that the suit was brought as the IPO was in the works. Of course, there had been an expectation that this was going to happen this fall. So.
Probably some lawyers thinking about the timing.
Sleep is still a mystery. And if you think about what even a sleep study, that's a blunt instrument to try to figure out exactly what's inside your head. And so that's blunt, with all the, electrodes here and everything. And so think about what you're trying to decide from.
But it also made me think, if that suit is a real suit, you would have a suit against Whoop, you'd have a suit against Apple, you'd have a suit against Google, you'd have a suit against Samsung, because all of these devices effectively are doing the same thing.
I think you should assume the standard deviation from what's really happening is fairly wide on most of those.
That's why I question.
Take it with a grain of salt. Take it with a grain of salt.
My recovery score this morning, you're a little bit suspect.
Are you at, what was it? You're at 85?
My readiness today is at 80.
Your readiness today is at 80.
How do you feel about that?
I'm dealing with whether I like melatonin or don't like melatonin at this point. I go on and off. I go off for a couple of weeks, and then there's times where I really, if I'm going to go bed on a Sunday and I've been up for the weekend, I want to get drowsy. But then these dreams, Andrew.
I'm a melatonin addict. Which I shouldn't admit.
Don't you have crazy dreams?
Sometimes.
I don't know why you keep showing up in them. There must be some. Put some clothes on.
The thing I worry
Would you
about,
please?
Can we talk about
You're in a
this?
Speedo.
I mean, there's a lot of people waking up just now, but
it's waking up and throwing up.
Possibly. The thing, though, there have also been some recent studies, or at least people concerned about melatonin as it relates to your heart.
I know. Well, that's all I need.
And that's something that I worry about now.
Well, you should. You take it? You
I don't take anything. I go to bed.
I think these things are like 1 or 2 milligrams. You're doing at least 5 or 10 milligrams.
No. Mini. No,
1 or 2. 1 milligram.
One. You actually want to stay super low.
Right.
But honestly, how do anybody have trouble sleeping on this schedule?
Never more than 3.
I can sleep anywhere.
Like on a Sunday night. Like there's something about laying down and being really drowsy right away that's kind of a good feeling, right? Isn't that sort of good to really feel?
No, my issue is my brain is spinning. Otherwise, I might stay up till 2 o'clock in the morning, and then talk about being drowsy right here. That's not going to work, as you know, because I got two super smarties over here.
Okay.
No,
moving very fast.
I will say it makes me nervous to come in here without being kind of on your toes, and that's good. We keep each other on our toes.
This train going through this tunnel constantly.
Yeah. Okay. You're taking too much.
Yeah. We'll talk.
Washington Monument. What is that?
It's a monument in Washington, D.C.
I know, but it's Freudian.
Really? When we come back, highlights from CNBC's interview with Philadelphia 76ers owner Josh Harris. His first sit-down since the team signed LeBron James for the upcoming season. You don't want to miss this. That's coming up next when Squawk Box returns.
Never miss a moment.
Cybersecurity fundamentally needs to change. Every organization needs to up-level its cybersecurity practices.
Non-technical people can create a website, can write code. The same thing will happen in financial services.
If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. It's totally individualized because we know today cancer is a disease of DNA.
Listen to CNBC on the move with the CNBC app.
A lot of strong numbers this morning.
Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe. Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange, and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
I love the story. I love the drama that is business. A great interview is when you can get the subject to tell you something that you never expected, that you never imagined. My ambition is to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
Josh Harris, the billionaire owner of the NFL's Washington Commanders and the NBA's 76ers, sat down exclusively with CNBC Sports, and that's apostrophe because it's CNBC Sport is the name of correct who you work for, but I'm introducing the apostrophe because Mike Ozanian is here. He works for CNBC Sport, right? And this is your first, or was Josh's first interview since LeBron was signed. He talked about the signing and made some surprising comments about the sale of the Los Angeles Lakers.
We had joked, well, maybe LeBron had opted out from the Lakers, and we said, well, maybe we'll go after him, like, man, we'll attempt, ha, ha, ha. But then, all of a sudden, we had a really competitive team. And so we took it really seriously after that. I bought the Commanders at $6 billion, and everyone said it was the highest price on planet Earth. And I think that now it looks like a good, attractive deal. I think that the Lakers are worth every bit of $12 billion.
Mike Jones just now already referenced him. I mean, the Commanders, I don't even want to venture a guess. But you must know what's he talking about.
Well, he paid $6.05 billion 3 years ago, and he's building a new stadium. Be ready in 2030. 10? Over 10. I mean, our valuations will come out September 9th, but over 10. Look, the Seahawks sold for $9.6 billion, and the Commanders have a much better market. They're going to have a newer stadium. The big takeaway I had from talking to Josh, though, was, I said 20 times revenue for the Lakers. I said, when you bought the 76ers, you're talking like 3 times revenue, 15 or so years ago. I said, is this a bubble? We get asked that all the time. He said, look, not at all. He said, he owns a lot of different teams. He owns an English soccer team, he owns an NBA team, an NHL team, an NFL team. So he's really in the know about investor interest.
But here's the thing that I can't figure out. Clearly, these are become almost like pieces of art, these teams, in terms of valuations. I think that's fair to say. I don't know if you'll agree with that, in terms of just where they've gone. And by the way, I think we're about to hit a whole new period of new billionaires from SpaceX, from Anthropic, from OpenAI. People are going to want to own sports teams, want to own art. But at some point, if the math doesn't math at all, meaning if there's not enough cash flow to actually support the transaction, does that change the dynamic? You've talked about how at the NFL, all these teams, I think, are in the green, right?
Yes,
but there are teams in Major League Baseball, for example, that are not. And it's harder, even when you're a billionaire, to hold on to those assets for a very long time if they're actually just going to bleed you every year. And so is there a moment at which the math makes it much more complicated?
No, I think that's the ultimate question, Andrew. You're absolutely right. That's why I think it's very different within the leagues. So you mentioned the NFL, all the teams make a lot of money. So if you're talking about revenue multiples 14, 15 times, it makes sense. In the NBA, same thing. The lust for NBA teams and the line of capital waiting to invest in the NFL, NHL is huge. If you're talking about the NBA, we're at a new paradigm where maybe 15, 17 times earnings. Also, we have to make a difference between
earnings and revenue.
Revenue. So you're talking about Lakers, Knicks, Celtics. Different story than if you're talking about, the New Orleans franchise. Right. Major League Baseball, that's what the battle's about. They want a salary cap and a salary floor so you can have, like the NBA has one and the NFL does. So the math will work.
Right.
And then the top NBA teams, and then the top of the top are the Lakers. I mean, just Showtime, there's Los Angeles, the entertainment, Jack, all the stuff that goes along with hopefully for a long time.
Josh was really interesting, and he was talking about that the revenue growth will make the multiples make sense. And if you look at what they're doing with these stadiums and these arenas where they're building out and generating extra revenue from mixed use and retail and all of that, and the belief that they can expand internationally. Roger Goodell said the NFL is going to have teams, in Europe. We have the NBA Europe League. So, Josh is saying that the revenue growth will justify these multiples. But to your point, if you're talking about EBITDA, the NFL and probably the NBA.
Did he say anything about Mark Walter?
Did not ask him about Mark Walter.
Because literally, if you think about it, Josh was obviously in the private equity space earlier. That's what he's in. And there's still been this large question about what Mark was doing at Guggenheim with a lot of these insurance funds to effectively support a lot of these purchases. That's and the sort of cross-collateralization of all of these assets. That is the fundamental question underneath it that forced the sale originally and may force the sale of Chelsea and whatever other teams you think Mark may have got himself into a bit of heat on.
Yeah, if I was a betting person, I would say if he doesn't sell the Dodgers outright, Mark Walter, he will certainly look to raise capital. Kudos to you for writing the very first article when he bought the team that questioned it. And interestingly, there was a lawsuit brought against him, I think, in 2016 that the class action suit, they didn't win, but was pointing out the use of insurance money. But I don't see what Mark Walter has alleged to have done as being something widespread in sports. Most of the capital is coming from what you pointed out, which is really wealth creation. So, and I actually think had the Lakers been put up for auction, which is maybe, Jeannie Buss's contention is they could possibly have commanded more than $12.5 billion.
Give me something on LeBron and the Sixers, what they've got with Maxey, with the rest of the team.
I think their odds have gone from winning the championship before LeBron signing 20-1 to now I think they have the third best odds in the league, or tied for third with the Knicks right now. Embiid's got to stay healthy. That's the key. If he doesn't stay healthy, I don't think it looks good as far as winning a championship goes.
They're going to save him, I think, towards the end of the season.
That'd be the smart move.
Yeah, it would.
Laker girls. They're still going strong, apparently. That's part of it?
Absolutely. It's all part of the brand.
So you said, you don't know about how about the behavior of the 49ers? I guess you're not going to talk about...
It's an odd story.
Good luck with that one.
Yeah.
When you come in here that you should think, what am I going to say to that question?
Yeah, let's just say I pray for the guy.
You do. I check. I get the board. It's even more. The trailer park's bad now. Anyway, thank you.
Thank you.
All right. Coming up, We Need to Tax Billionaires. That's the title of a new book by a leader in the global wealth tax management or tax movement. We're going to talk about it, debate it, all of it in a conversation you do not want to miss. It's happening right after this. And a reminder, get the best Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll come right back.
One hour of added insight every morning doesn't just add up, it compounds. One extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC. Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green, Saturday and Sunday afternoons, only on CNBC.
Welcome back to Squawk Box. Our next guest, known as the architect of the global wealth tax movement. Joining us right now, Paris School of Economics professor Gabriel Zucman. He is a UC Berkeley summer research professor, founder, director of the International Tax Observatory. His new book is out today, We Need to Tax Billionaires. Good morning to you. It is the hot topic in your state, in California, but also around the country. And I'm going to start with this. The biggest question I have is just the philosophical need/question. Let's assume you need to raise more revenue. At the same time, I imagine you may think we need to cut services, but maybe you don't. I don't know. About taxing unrealized gains. And I think that is sort of a philosophical breaking point for a lot of people, because people say, well, and I get the real estate story in terms of, but when I say real estate, people tax real estate, whether it's realized or unrealized. But make the case on the taxing unrealized gains, just on a philosophical basis.
I mean, this is not about taxing unrealized capital gains. This is about creating a new principle, which is the principle that extreme wealth should come with unavoidable duties towards society. So the idea is that there has to be a minimum amount of tax that you must pay each year if you're extremely wealthy. And we can debate what it means to be extremely wealthy. I've proposed $100 million, but that's the basic idea. There has to be a floor. And it's an idea that I think everybody can agree with. And so then the question becomes, how do we compute this minimum tax? If it's expressed as a fraction of taxable income, as defined currently by the tax law, it doesn't work, because the main problem is that the billionaires easily find ways to report no or very little taxable income. Hence, the minimum to be effective has to be expressed as a fraction of wealth. And so that's the proposal I make in the book, to create an annual minimum tax for the super rich equal to 2% of their wealth.
But this goes back to effectively deciding you're prepared and willing and want to tax unrealized gains. And the question I'm coming back to is sort of the philosophical decision to tax something that somebody technically doesn't have. And that, I think, is it just sort of a breaking point for some people. I've always wondered why we don't do lots of other things in the tax scheme. Prevent people from taking loans. You talk about loopholes, taking loans against their assets so that they don't have to pay taxes. That's something I think seems like low-hanging fruit. We could talk about carried interest. That seems like low-hanging fruit. Stepped-up basis at death seems like low-hanging fruit. You can even have a broader conversation about capital gains taxes at a certain level, whether that should actually look a lot more like income taxes for the super wealthy. But I think there's a lot of people who sort of start and stop the conversation around unrealized gains, even when they don't understand what unrealized gains are.
I mean, by all means, let's do all the things that you just mentioned. Closing loopholes, the step up in basis at death, and all of that. It's necessary, but it's not sufficient. It's not sufficient because it wouldn't address the core issue, which has been highlighted by recent research all over the world, which is that past a certain level of wealth, It's just very easy to structure your wealth such that this wealth will generate no or little taxable income. That's how you end up in situations where people like Jeff Bezos or Elon Musk in years, they report no taxable income or barely any income, and so they don't pay any income tax. This was revealed a few years ago in the US by the media ProPublica. And so the solution is not that the solution I'm proposing is not to tax unrealized capital gains in the sense of taxing the increase in the value of your wealth from one year to the other.
Gabriel,
it's something much simpler. Let me just finish on that. Because when you say unrealized capital gains, then it gives the impression that we are taxing something that's notional, that's virtual, that doesn't exist. But what I'm proposing is to tax wealth, and wealth is very real. Wealth is the value of all your assets, net of your debts, right? And there's already a wealth tax in the US. There's even two wealth taxes.
Right.
You have property taxes for homeowners.
Let me ask you one more question. I'm sure
tax.
Joe wants to get in, so let me just ask you this, though.
I don't want to.
And again, it is a somewhat of a philosophical question. You said that taxes right now are insufficient on the wealthy. One of the arguments about wealth taxes and just taxes more broadly is even if you decided to confiscate 10 or 20% of the wealth of the 1%, it would have a dent of half a year of the United States budget. And so the question is, ultimately, I think, and is this an issue on fairness on one end, or is it really an issue of how do you actually fix the problems that we have in this country in terms of our overall budget? How do you find a way to raise enough revenue and cut enough expenses so that this $40 trillion debt that we're all looking at can get solved?
It's first and foremost an issue of equality before the law. The most conservative interpretation that you can make of that principle when it comes to taxation is that wealthier individuals shouldn't be allowed to pay less tax than less wealthy individuals. But that principle is violated today, and the most effective way to fix that issue is to create an unavoidable minimum tax based on wealth. Now, it turns out that because the wealth of billionaires has skyrocketed over the last decades, with a particularly striking acceleration over the last few years, it turns out that now the government revenue implications from taxing the wealth of billionaires have become large. Many people in those debates are kind of stuck in the 1980s, 1990s, when billionaire wealth was just much smaller relative to GDP, relative to total wealth than it is today. And so they think, okay, maybe some of those guys don't pay their fair share, but they're so few in number that, why should we care? It's not going to change anything for the debt, for the government budget. That might have been true back then, but today, that's not true anymore, because the 400 wealthiest Americans, now they own in wealth the equivalent of 25% of GDP. The 250 billionaires of California own in wealth the equivalent of 50% of California's GDP. Their total wealth for these 250 billionaires in California is as large as the total AGI, the total taxable income of all 30 million families in California. So now, you can get more money by taxing everybody with the income tax, or just 250 massively undertaxed billionaires. That's the situation
you
today.
Keep dodging the key issue is that it's not going to solve our problems. And all you just highlighted why there should be punitively a tax on success. I guess it even sounds like it's a zero-sum game, and the wealth that they've created is taking food and dollars out of people that don't have a lot of wealth. None of it. But the key point is, it's de minimis on trying to solve our problems. It just makes you feel better that you're socking it to these people, and you have all the numbers there, 10 times this, and the entire population of this, they have this money. They've created a lot of wealth and created a lot of shareholder wealth, created a lot of employees, created a lot of taxes, and there's no reason to look at them and just say, we got to get them. And that's exactly what you're doing. With the, I understand how things work in Europe, and especially in terms of income inequality, but I don't know. The key points, you just keep talking over the key points about how nasty these billionaires are because they have so much money.
I mean, there's one thing I agree with is when you say that it's not going to fix all the problems.
Okay.
That I totally agree with you.
Then what's the point?
I do. So it would fix
if it's not punitive.
one basic. No. I mean, we're talking about rates. In my book, we need to tax billionaires of 2% per year. So it's not punitive or confiscatory. We're talking in California. We're talking in California with the California billionaire tax, Proposition 40, that's going to be on the ballot in November, of a one-time tax of 5%, when the wealth of billionaires just over the last couple of years has increased by like 200%. So we are very far from something that could be qualified as punitive or confiscatory. The problem that it solves is precisely that these billionaires, they don't pay a lot of tax today. They don't pay a lot of tax because for them, income, taxable income is just not the right indicator of the ability to pay taxes. So it's fixing that problem. And you might say, well, it's not a big problem. We don't care. But I do think it's a very big problem because equality before the law is at the core of the rule of law, of what it means to live in a democracy. And also, if you don't fix that problem, if you allow some people to live tax-free in their own parallel society, what does this generate? It fuels the rise of wealth concentration. Because, of course, it's easier to accumulate wealth when you don't have tax to pay. And look, wealth is a good thing. I'm all in favor of encouraging wealth accumulation by the middle class, by the working class. But for the super rich, also, wealth is power. And extreme wealth is an extreme concentration of power. And even if you only care about markets, about market efficiency, I don't think you want to live in a society where a few individuals can have so much power and influence on our society and on markets, where they can buy competitors, where they can influence policymaking, where they can buy newspapers and radio stations and TV channels, where they can buy elections. That's not just the right way to run a society.
Gabriel, we got to leave it there. We appreciate it. It's a fascinating topic. It's not going anywhere, and I imagine you'll be talking about it and we'll be talking about it for a very, very long time. Thank you.
Thanks a lot for having me.
All right, 7 a.m. on the East Coast. You're watching Squawk Box on CNBC. I'm Joe Kernan, along with Becky Quick and Andrew Ross Sorkin. Our top story, Treasury Secretary Scott Bessent unveiling some new sanctions aimed at cutting off Iran's economic lifelines. The Treasury chief says that countries have a set timeline to wind down business with Tehran or risk U.S. secondary sanctions, making clear that China is no exception. Joining us now is Steve Yates, former Deputy National Security Advisor, now Senior Research Fellow for National Security at the Heritage Foundation. Steve, it's good to see you again. One thing I noted we haven't talked about, and that is, are we going after the current leadership now, the ones that I think the administration at one point said they're easier to deal with than the last leaders, and we're going to deal. But now, did we actually levy a bounty on the head of some of the current leaders? That's different, isn't it?
Yeah, I think there were a few things that were different about what Secretary Bessent outlined, and I welcome the announcement. I think it's exact right way to avoid getting stuck in the endless loop of negotiations that have, I think, defined the last few months and defined the pre-Trump era in a lot of ways. It also avoids the dreaded boots on the ground invasion occupation scenario. Treasury Secretary Bessent basically said the objective is no longer to pressure the regime to try to bring them back to the negotiating table, but essentially to defeat the regime. So the president and his team seem to have basically had it with getting lured into the back and forth of these talks. And so this is, I think, genuinely maximum pressure. The Iranian regime did have their public display of putting the president's son image on their media and social media, putting a $10 million bounty on him. Didn't seem like a very wise thing for them to do. And the United States has, in fact, seemingly escalated all the targeting. And the Treasury Secretary said absolutely no leakage on this. No one is above the sanctions, whether they're the Iranian regime or those who are enabling it to continue its economic and other terrorism.
Sounds like you welcome these moves. Did the administration exhaust all the other possibilities of what it was trying to accomplish? Because I guess people would say we could have done this 3 months ago, and there was actually a point where we were not only accepting Iran's ability to sell oil, but almost helping the country generate revenues. Now I guess this is like the final. We've given them every chance. And now, okay, so this is the way it's going to be now. I mean, does it make sense we didn't do it earlier?
Well, there are a couple of things, and it's very easy for me to look back in retrospect and say I would have done this or that. But at this, I look at the early phase of major military operations jointly with Israel and maybe some others as well. That could have gone on for another month, and maybe we would have been in a completely different space. But the president and team had their reasons. They wanted to try the negotiation path to see if there was another landing place that might be cleaner. That resulted in months of back and forth. We saw the ugliness of how that conveys to international media and other observers. But over the course of that, key allies like the United Arab Emirates arrived at a decision that prior to Secretary Bessent's announcement, they said they're cutting off all financial linkages with the Iranian regime. And that matters because there was, over decades, a lot of economic leakage that would come out of Iran through the Emirates and other parts of the broader Middle East. And that sort of showed this is not America alone on this new, I think, economic weapon of defeat for the regime. So I think some things may have changed along the way. I would have liked to have had these tough measures really early, but maybe I'm more of a maximalist on this, and they're learning options that I didn't see weren't available earlier in this campaign.
Where does our partners around the world, or even not even our partners, some of our adversaries, who will go along with what the United States wants to do? And do we know for sure about Russia or China that their relationship with Iran is, in their view, sacrosanct, or will they say, you know what, we want this ended as well? Why did China stop importing so much from Iran already?
Well, in some cases, I think that the blockade has been more effective than maybe has been appreciated along the way. I also think the Iranian regime has been in more distress than they have let on, and maybe others have been able to cover. So a lot of the oil out of Karg Island doesn't seem to have been getting out of Karg Island for some time. We have the Iranian currency at 2 million to the dollar at the moment, and inflation, I think, around 66%. That's pretty crushing reality. So things haven't been moving for a bit. So China's felt that pinch. Now, to me, this new economic operation all comes down to fortitude and standing firm. If we stand firm on these tools, these are the most powerful economic tools at our disposal. I would equate them to economic nuclear weapons. They should defeat a target regime. And if we hold the third countries to the same, that if you allow linkage, a leakage of resources to this regime, then you'll face similar penalties in your institutions. That's sort of what we did to the Chinese when we wanted to bring North Korea to the negotiating table in the mid-2000s. Now, I think we gave that pressure up too quickly for just some talks. This is broader in scope. But if we are consistent with the Chinese, I think that they will have to find a way to honor this, because they cannot escape the need to access the dollar-denominated international financial system.
And you said that we didn't do it long enough. Do we have the wherewithal to do it long enough now, with midterms, oil, everything else?
I think that we do. This is, I think, a very, very logical, plausible strategy. It should answer what a lot of people were yawning for in terms of what is the strategy? Where does this land? Are we going into a quagmire, or are we picking up and leaving in defeat? I think this answers the question that we're going for victory. We're going for the defeat of the regime, and this is going to be crippling for them. We already have priced into our lives a bit of an increase. It isn't as bad as was warned in the dire forecasts of the beginning of these operations, but it's been more than nothing. And so the Xi Jinping summit coming to Washington a month from now is going to loom very, very large. Between now and then, the president will have an acid test of whether his friendship with Xi Jinping results in China actually taking action beyond the lip service he gave in May when he went to China.
Hey, Steve, just very quickly, when we talked to our correspondent in Beijing earlier today, she said 2 words when you push China around: rare earths. What's to stop them from coming back and threatening to cut off our access to their rare earth minerals again?
They could. That has to be out there as a considered leverage point that they will want to exercise. I don't think that leverage works as well now as it did before. It's not as if we have completely solved the matter, but we have opened up many more avenues to try to reduce that complete dependency. And China is even more dependent on access to our financial and goods markets. They do not live without copious amounts of exports to U.S. consumers. And so the president has further steps that he could take in that regard. He doesn't want to go down that escalatory road. Maybe his friendship with Xi will be able to help navigate that. I don't believe in friendships with communist leaders, but the president is doing the hard negotiations on this. But you're right that there is that vulnerability. I would just argue that longer term, China has way more dependency and vulnerability than we do. And if you just look at even just the energy markets, what we've done over the last decade plus has insulated us from a lot more risk than could have been the case in this current exercise.
Okay. All right, Steve, we'll leave it there. Thanks.
Thank you.
And President Trump just posting on Truth Social, loves to tweak, doesn't he? The United States is giving serious consideration to changing the name of Lake Ontario to Lake America, in that we don't expect to be doing much business with Ontario any longer. Thank you for your attention to this matter, President Donald J. Trump. We know that Doug Ford was back talking yesterday, sort of throwing down the gauntlet, and it's probably not a surprise.
I was just on Google Maps, I put in Gulf of, because I started to look for Gulf of America or Gulf of Mexico.
It's still Mexico?
Interestingly, no, they actually now have it as Gulf of America with Gulf of Mexico in parentheses. Well, actually, first it says Gulf of Mexico with parentheses Gulf of America.
Right.
But if you actually go on the map itself, the little red dot goes to Gulf of America. So anyway, this is all quite silly.
We do have.
I don't know what to say. I can't imagine this helps the negotiations.
I mean, you never know. It's a tweak. It's how right. I don't know if I'd, like we've said in the past, don't take them literally.
The problem is the reason that the Canadian politicians are pushing back is because this is what their population feels about.
Right.
They really don't like being told this. All right, coming up, news from United Airlines. We will hear from CEO Scott Kirby right after a break. Squawk Box will be right back.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's 2 winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green, Saturday and Sunday afternoons, only on CNBC.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
Closing Bell Overtime, CNBC.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC. Streaming on CNBC Plus.
For this edition of the CNBC Conversation, I'm joined here in Milan, Italy, by the Prada Group CEO, Andrea Guerra.
There is fashion waves, there is political waves, but then there is reality. The reality says the younger generation are looking at you, not just to what you say, but how do you behave. The way you are behaving in the society, you are behaving with your own people and suppliers and stakeholders, and how you are behaving towards the planet are the three things that are part of our inner mission. So we are here to allow everything inside our group to be connected smoothly and positively towards planet, society, and our own people.
Prada Group CEO Andrea Guerra sits down for the CNBC Conversation.
Welcome back, everybody. We've got some news from United Airlines this morning. Phil LeBeau joins us right now with the CEO, Scott Kirby. Hi, Phil.
Hi, Becky. Scott, good to be here at your facility in Newark at the airport here. You're announcing 10 new routes that you're adding as you continue to expand internationally. This growth, especially transatlantic, what's driving it right now?
You know, this is an exciting day for United, for our employees, our customers. I've never known of an airline to announce 10 new international destinations in a single day. But
unique ones as well.
Unique destinations. And really, at United, we've been doing a lot of this. We've added a lot of new cities and new destinations around the globe in the past several years. And this is just the next step in that evolution. As we've built a brand loyal airline that customers choose to fly, that customers love and want to fly, it allows us to fly places that aren't even on the planning horizon for any other airline, because we have a great customer base and lets them try new places around the globe.
We'll talk more about that expansion and the new aircraft behind us in just a little bit, but I have to ask you about jet fuel. Right now it's at about $3.80 a gallon. Not as high as it was in March, but certainly well above where it was at the start of this year. And you said for a while you expect higher for longer. What do you expect jet fuel prices to do the remainder of this year going into next year?
So I thought really since mid-March that the situation in the Gulf was unlikely to get resolved and that fuel would be higher for longer. And that has in fact been the case. I've been pleasantly surprised at all the workarounds that more oil has gotten out of the Gulf and gotten to markets than I thought would have gotten to markets. So I think we're also in a gradual world where we're going to continue to get more oil from other sources and other ways out of the Gulf. And so who knows for sure, but my base case would be that oil sort of gradually declines. It stays higher than it was, but that oil kind of gradually declines into 2027.
Do you look into 27 and say we get back to where we were at the beginning of 26?
I don't think that we get back to where we were at the beginning of 26. Personally, I hope I'm wrong. I hope it gets lower, but I think we stay much elevated. The good news is I think that we're going to be able to pass all of that on in 2027. I still feel pretty confident that United Airlines is going to have double-digit margins in 2027, which is sort of the North Star that we're shooting for financially.
When you look at Labor Day through Thanksgiving, historically that was always a slow period for the airlines. Not anymore. No. Are you seeing any slowdown, particularly among corporate customers?
We are not seeing a slowdown at all. I looked at the bookings this morning from yesterday. Really not even a blip in demand so far. And it's true, it's across the board. Business demand is strong, but leisure demand is strong. And all these new international destinations, like the ones that we are adding today, have become much longer seasons. Instead of just flying during the summer, these go all the way through October. And October's become one of our best months of the year. It used to not be. October is now one of the best months of the year for United Airlines.
We're in front of the new Airbus A321 XLR, which essentially is going to allow you to do these new routes. More, I wouldn't call them remote, but smaller destinations.
Cities.
How is that critical to that growth internationally?
Yeah.
And do you continue doing this in the years to come?
Yeah, this airplane is a huge enabler for flying to destinations like Luxembourg or Toulouse, and we've wanted to do that. Waiting for the airplane to show up. It's going to be it's a great airplane for customers. It's one of the, it's as good as any airplane in the Western world for customers. Nose to tail, like I think one of the cool things on this airplane is there's a snack section in the back for economy customers, or you can just go up if you're out over the Atlantic and you wake up and you're hungry, you can go get a snack. Something that's always been in case, up front, but now is going to be in economy class as well.
Speaking up front, you guys have went several months now of base premium fares, but people can pay up if they want more, like flexibility, rebooking a ticket. Are most of your corporate customers doing that?
Yeah, most customers tend to buy, don't buy the basic economy ticket. Most customers, corporate and
But on the premium
otherwise.
side, are they buying the base premium?
On the premium side as well, something like 80% of customers are buying up.
So you're seeing that demand continuing.
Yeah. The demand really is strong across the board. And customers want a better product. So I think really the thing that we've demonstrated in the last 5 or 6 years is that air travel is not a commodity. Customers want more than just a flight from A to B. They want great service, they want great technology, they want a great product, they want reliability. And all of that matters when customers are choosing what airline to fly.
2 quick questions here. With American and Delta both rebuffing your interest in potentially merging, are we in the status quo when it comes to airlines and mergers, let's say over the next year and a half?
Well, first, I only talked about one of those airlines, so I'm not going to confirm any others. But I think we probably are in the status quo.
And last question, we always like to give you a trivia question. Your history as a man of operations, knowing airport codes around the world.
Oh, God.
Here's one for you. LJU. Do you know the airport for LJU is the airport code?
I would have said Ljubljana, but...
It is Ljubljana.
Okay.
It's one of the new cities.
It is.
It's a favorite thing we like to do. I like to ask them airport
Patrick
codes.
usually does that to me.
Patrick Quayle here for the United Airlines does it as well. Don't ask him CVG, Joe. He knows what CVG is. He knows all the U.S. codes.
EWR, Joe.
There you go. Guys, we'll send it back to you.
So you're talking Slovenia, right?
LJU is Ljubljana, Slovenia.
Yeah, in Slovenia. Yeah, I had to look that up quickly. Some of these, I was going to ask Scott, I mean, how do you decide? I guess you gauge the market and what you'll be able to do. You want to fill the planes, obviously. And I immediately, Scott, checked, some are from San Francisco, some from Dulles, but the ones from Newark, because I can get there in about 10 minutes from where I live. So if I ever decide to go right into Sardinia, I can go to, what's that symbol? Olbia?
You got 2 cities in Sardinia you can go to, so not just one. It is pretty amazing. For Newark, like 8 new destinations from Newark. And look, this really is a point of now that the FAA has effectively slot controlled Newark, and Newark works well. It's the most reliable of the 3 New York airports now. That's what enabled this kind of growth. I mean, this is the power of, if you get the airport working well, it enables 8 new international destinations out of Newark.
Have I flown on an A321 XLR? It's a single aisle, and it must have some lay-down seats and stuff like that, Scott?
It does have lie flat seats. It's a 757 replacement, really. And so it gets to all the, it can't go as long as the wide-body airplanes, but it gets to all the near Europe, North Africa, particularly from the East Coast. So we got more of these airplanes coming in the years to come. So you're going to see more small cities in Europe, more destinations popping up as we get more and more of these aircraft.
Oh, just got to get Andrew to pick out a good hotel for me, and because you're the man. Anyway, thank you both. Thanks, Phil. Thanks.
You need a hotel?
Going in Slovenia, in Ljubljana.
Do they have Starlink on the flight? That's the most important part.
I think they're going to put them in on all.
I know. It's going to be amazing.
It is amazing.
It's amazing.
You don't have to do anything. Yeah.
Coming up, shares of Dick's Sporting Goods sliding on quarterly results. We're going to have that and more when Squawk Box returns.
there were definitely a few times when there was no money in the bank.
Before Kareem became one of the defining startup stories of the Middle East, Mudassir Sheikha was trying to keep it alive from one funding round to the next. He'd left a safe consulting job, and he and his co-founder had each invested $50,000 of their own money into the company. In the early days, Kareem wasn't an app that magically matched riders and drivers. It was the founders calling drivers themselves in the early hours of the morning.
It was radically basic. All we had was a website.
And 7 years later, Uber, the rival Kareem spent years fighting, agreed to buy the company in a landmark deal for the region.
To do a deal with our biggest rival, the company that we thought was trying to kill us, was just very, very difficult for the organization.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
A market shaping industries, supply chains, and global momentum. The China Connection, weekdays. This really is a business-first pivot. CNBC.com and the app anytime. Only on CNBC, connecting you with China.
Shares of Dick's Sporting Goods tumbling, earnings and revenue falling short. The company's cutting its full-year outlook due to what it's calling a challenging athletic footwear and apparel marketplace. Looking at that stock now down, wow, about 14%, $154 right now.
Wow. All right, when we come back, from the AI trade to the moves in the treasuries, we're going to have the markets on next. You can see right now, Dow futures up by about 210 points, S&P futures up by 23, the NASDAQ indicated up by 260. And later, the Pentagon's multi-billion-dollar investment in drones. We will get into the future of warfare with Department of Defense Chief Technology Officer Emil Michael. That's coming up at 7:30 a.m. Eastern Time. Squawk Box will be right back.
All-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
Crypto FC on The Score.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
All right, checking the futures. Going to bounce a little. Had a rough week last week. Savita was like, it's happening for me. It's happening for me. Joining us now with more on the market, Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. When we do, okay, we got to 7,800. At 7,800 on S&P, you're like, oh, damn. What are we going to do? Do I need to do anything with my... Are you still at 7,100?
We are at 7,100.
Okay, so you're wondering, okay, 10%, it's not the end of the world. But then it gets all of a sudden down to 7,600 and it looks lower. You still think this is going to be borne out before the end of the year, that the market...
A bigger dip? Yeah. I mean, well, there's a couple of reasons we could see it. And look, I'm a little more optimistic than I was, a few months ago, because what we've seen is multiple compression in a lot of these frothier areas of the market.
Because earnings have gone up?
Earnings have gone up, prices have come down, and in a way, I feel like it's a healthier reset, especially for tech, for semis, software, hardware, like that whole complex. We've seen earnings come in at a very healthy clip. Cash flow is actually pretty healthy, and multiples have come down.
Kind of a rolling correction in some of the
it's a correction.
With the prices.
And the PE has come down for a good reason, which is earnings going higher. So I think that there are pockets of the market that now look a lot more rational than they did at the beginning of the year.
When will we get your 2027? I mean, what does next year look like to you?
Next year is interesting. So I think, but the one thing I was going to say is we're heading into this sort of seasonally turbulent period.
Yeah.
And I think
September 1st.
The risk is just being in the index and being complacent. You know what I love as a protection against downside in the S&P? Large cap value. And there's a bunch of tech in it. It's not just boring old economy stocks like energy and financials. Tech is large cap value now. And that's why I like tech. That's why I like a lot of these areas of the market that have gotten a little bit more rational. So, I think the risk is missing the upside, but the risk is also being too heavily invested in heading into a seasonally weak period. The way to navigate that is just park in large value stocks, set it, forget it, come back later, and you're going to be doing fine. In fact, what's surprising is even though it's felt like we've been in this very mega cap tech-led market for the last 5 years, if you look at large cap value versus large cap growth, they've performed neck and neck for the last 3 years, 2 years, 1 year. I mean, it's been a very surprising stealth outperformer relative to the rest of the pack.
All right. So when will you give us a target for 2020?
Second question. So 2027. So we all kind of, come out with this around November. And
what are you leaning towards?
I mean, I think it's going to be a good year. What I worry about, I don't think we're seeing any signs.
But if you do 10% for next year, you'll only get to where we are right now, right?
Well, okay. So when we do our year end, our year ahead, we think about where the market is currently, what the fair value is. Even today, some of our models that are based on returns are suggesting a higher year-end target than where we are today. I just think that now is not the time to buy the index and close your eyes. I think there are.
I would always like to be like that if I was a sell-side strategist. I would just that would be my permanent.
Buy the index and close your eyes.
Nope. Pretend that I always have a 10% drop in my average, in my forecasts, and then we even had Brian on, and he goes, "Well, they can just raise it at the end of the year if they're wrong about the 7,100." He did. He also was talking about some of your economists are looking for 3 or 4 rate hikes.
Yes.
And I go, really? And he goes, well, if that's wrong, then we don't get them. Then we'll say 1 or 2.
Well, forecasting is hard, and year-end targets are kind of silly numbers.
Especially about the future. Right?
But look, I think that there is still a decent chance. I mean, look, you get a 10% correction effectively once a year on average.
That's what I said. I'd always have that. If I was a sell side where it really didn't matter, where I didn't have any skin in the game, I would always have my target would be 10% below.
Well, I think
it's hard to say 80. Like you're not going to ever say 8,200 for me. I'm never going to hear that from you. I don't think.
Well, don't be surprised. I mean, we've been very bullish. Like 3 years ago, I was more bullish than I'd ever been. And that was a point at which everyone was forecasting recessions. And I think this is a market environment where sentiment has already caught up with the market. Back 3 years ago, nobody liked equities.
So you think right now,
you
think it's complacency?
Think we're heading into a recession?
No, but do you think people are complacent right now? Because I think most people. I think most people think that the market's totally overvalued. Every day I see Market Watch, and they write these articles.
It's not a valuation thing, though. It's really a supply-demand sentiment. You've got a lot more supply coming online, less buybacks. Buybacks have supported a lot of that buying in the S&P 500. Now companies are spending on CapEx, which is great for the future, and I'm bullish for the future. But I think we might be in a period, like kind of an air pocket, when it comes to show me the money from some of these hyperscalers. So that's what I worry about. But I do think that there has been a healthy reset in a lot of these frothier areas of the market.
Yeah, I mean, we got to 7,800 really fast.
Don't be surprised.
There are people at 7,800.
I'm at 9,000, and
That's why I want you to call me.
So I'm telling you, we are models based. It's not just okay. I think that the safe bet is a 10% correction, models based. Right. And our models are saying
maybe get some different models.
Supply, demand. Okay. Well, I mean, so far they've been pretty good.
All right, Davida, thank you.
Okay. Coming up, what credit card borrowing and delinquencies tell us about the health of the consumer. We're going to break down the latest data next. Do not go anywhere. Squawk Box coming right back after this.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to that high-level information and help explain to every single person out there watching why what's happening in these complex markets matters for their lives today and in the future. That's what drives me. I love being part of this.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
Combat sports icon Ronda Rousey. She's conquered the UFC, dominated the WWE, and now she's sounding off on both.
It's extremely oversaturated right now. There's too many fights.
San Francisco 49ers owner Jed York. He sat down with us to explain how he turned the team around and the critical lesson he learned. Plus, influencer Jesse Rydell, also known as Jesser, explains his simple ingredient for online success. This is CNBC Sport on the Record.
The AI boom is usually told as a Silicon Valley story, but some of the biggest winners are thousands of miles away in South Korea. And their windfall is now spilling into an unexpected place, the housing market.
Before we saw this massive rally this year, people just like to invest in the housing market because there is no alternative for savings and investment.
From January to April 2026, home buyers used about 3.7 trillion won, or roughly $2.4 billion, from stocks and bond sales to fund purchases.
The government wanted to boost the stock market so that people could move away from homes into the stock market, but people are coming back to the property market with the money that they earned in the stock market. And it's also sort of this vicious cycle.
The danger is not that one stock market sell-off would immediately crash home prices. It's that the same wealth channel pushing stock gains into housing depends on confidence.
Treasury Secretary Scott Bessent telling CNBC that the K-shaped economy is over, arguing that lower wage workers are finally catching up. Sharon Epperson is here with some new data on the consumer. Good morning.
Good morning, Andrew. The K-shaped economy has become shorthand for an economy where higher income Americans pulled further ahead in their wealth, spending, and financial security, while many lower income households struggled to keep up. Treasury Secretary Bessent says the economy looks more like a C as the gap between income groups begins to close. Bank of America Institute data shows after-tax wage growth for lower-income households, the yellow line there, accelerated in July, surpassing higher-income households, that's the orange line, for the first time since December 2024. Spending growth also converged last month as lower-income households' total and discretionary credit and debit card spending grew, while middle-income households slightly lagged. Some economists say that doesn't mean lower-income consumers are truly gaining ground, though. Many Americans at all income levels are still under pressure.
But it's not just lower income families. It's median income families, higher and upper median income families, but also people that have strong means that are dialing back some of their spending and being more cautious with how they spend, where they spend their money.
A new report from J.D. Power finds concerns about gas prices are easing, while worries over housing costs are close to becoming the second largest source of financial stress for consumers. Housing costs remain a particular pressure point for younger Gen Z consumers. And some economists say age and life stage, more than any letter of the alphabet, may be a more useful way to understand who is feeling the most economic pressure in the months ahead. For strategies to help improve your financial health, sign up for my Money 101 newsletter using the QR code right there on your screen, or go to cnbc.com/money101.
Okay, so a couple of questions. There's been an alphabet soup really to describe the economy, K, C, all of this. We've had all of it. Is there a new shape?
Well, the new shape is whether if we continue to see lower income groups spending growth and we see higher income consumers spending growth go down, we could see an X. That's what one economist said.
But we don't want an X.
You want
everything up and to the right if you can.
Exactly. That's what you want.
And so when you look at that chart, the good news is those other two lines aren't coming down, but they're slowing.
Right.
And by the way, if that's what you're after, and this is maybe, that chart's almost, would you put that chart in the category of an inequality chart?
Well, yeah, of course. I mean, we are definitely seeing inequality, but we're seeing an erosion of growth, as one economist put it, across the board. And what's going to be the telltale sign now is whether or not we see that convergence or whether we see this X shape take place, where if there is, perchance, a correction in the market where a lot of higher income households have seen their growth coming from the stock market, then that's when we could see a decline in spending from higher income while lower income wage workers start to grow.
Right. Sharon, thank you.
Sure.
It's fascinating.
Sure.
All right, when we come back, investing in modern warfare. The Pentagon pouring billions into U.S. drone manufacturing. We will talk about this push and the role of AI with Department of Defense Chief Technology Officer Emil Michael. First, though, let's get the AccuWeather forecast with meteorologist Bernie Rayno.
It's a terrific Tuesday across much of the Midwest and into the Northeast and Mid-Atlantic, although there can be a spotty shower or afternoon thunderstorm from Boston toward Burlington. Just hot in Texas, hot and dry in Atlanta, spotty thunderstorms in Miami. The West Coast is hot in the interior, even 95 degrees in Los Angeles today. Not many travel delays. I would watch Florida. That's it. AccuWeather for Business delivers proven superior accuracy with often earlier site-specific warnings that reduce false alarms and costly disruptions so your business stays best prepared. Visit business.accuweather.com.
Listen to CNBC on the move with the CNBC app.
A lot of strong numbers this morning.
Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection. Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC Plus.
The Pentagon is ramping up investment in American drone manufacturers, aiming to reduce reliance on Chinese components and get combat-ready drones to troops faster. Joining us right now to discuss the modernization of warfare, AI on the battlefield, and more is Emil Michael. He is the Department of War's Chief Technology Officer. And Emil, thank you for being with us today.
Good to see you, Becky.
Let's talk a little bit about drone technology. We know that this is kind of the next wave of what to expect in modern warfare. We've seen it not only with what's been happening in Iran, but also what was happening in Ukraine and Russia before that. Explain to us where things stand right now.
Where things stand is what we've learned from particularly the Ukraine-Russia conflict is that conflicts around ground territory increasingly becoming robot-on-robot warfare. The front lines are dominated by robots, in this case drones. And we're learning the utility of that in that these drones can be cheap to manufacture, cheap to produce, and can protect troops, frankly, from the gravest harms of being troop-on-troop warfare. And those drones now extend to on-sea, undersea, in air. What you saw the other day, I think, in the Strait of Hormuz was a Saronic boat that helped save 2 Apache helicopters who were down. So you're seeing the expansion of what autonomous systems can do in warfare.
I know that the United States has long been pushing innovation. You've been doing that yourself, too. You all recently had the DARPA Lift Challenge, where you were looking for the most efficient, effective drones that were the best performers in these things. But some people say the real issue now is not so much innovation, but really making sure that we have the industrial capacity to produce all of the drones that we may need. And I think that's where you are stepping in with your latest announcement on this. Why don't you explain how you're kind of getting at that supply chain issue and how we make sure we can manufacture these drones here in America at the rate we need?
Yeah, that's right. I would say we haven't been at it this long. Only this administration took it seriously in the last year and a half. And what we've done is we've tried to stimulate and begun to stimulate the domestic production of the components and the all-up systems for these drone manufacturers in the last year and a half. And we've done things like loaned $800 million to Performance Drone Works, who's going to make components that are otherwise only available from China or from other adversaries. And we're doing that across the domestic supply chain to make sure that they're building drones here. Even a Ukraine drone company called UDD, we're using some of their technology. So long as they build here in America, they're building a plant in Ohio. And the idea is to have a robust domestic supply chain. So if we need it, we could do surge capacity. And then we're taking these all-up rounds that these companies are building, and we're putting them through the DARPA Lift Challenge, or Drone Dominance, which has $1.1 billion, and gates companies and gives them objective ratings on how their product is performing. and pays them based on that performance and then gives them orders, really. And we hope to continue that program until we have several winners with big orders from the Pentagon so that they can rely on domestic supply chains and build an arsenal of autonomous systems that we need in this country.
Explain the reasoning behind the DARPA Lift Challenge. And I'll put it in this context. Yesterday, we had a venture capitalist here who also happens to be a veteran. He follows the military very closely, Alex Harstrick. And he said that part of the problem he sees right now in robotics is that China is making the financing for these companies much, much easier. And that in some ways he's a little worried about how they may get ahead of the United States at some point because of that. He said what he'd love to see is DARPA doing challenges like that for not only robotics but AI, but it sounds exactly like what you are doing right now with drones. His point is that it's important for venture capitalists to be able to say, here are standards that have been set by the government, and if we see whether a company can perform to those standards or not, it gives us a better idea of where to invest.
Yeah, that's exactly what we've done. I mean, what was happening before was a disparate system where you had to knock on 100 doors at the Pentagon, and you got rated differently depending on how your product performed, and therefore you didn't get a singular demand signal from the Department of War where you could say, if I do well and it's objective, then I'm going to get an order that fulfills my investors' needs, frankly. And we want investors to crowd capital around these companies. So both in the DARPA Lift Challenge, where their contest was effectively a 4-to-1 ratio of weight that the drone could carry versus the weight of the drone, and in drone dominance, where we have objective measures and we compete these companies at the same time in the same place against one another, that gives the signal to those venture capitalists that you had on yesterday to say, these are the companies that are winning, that are doing well, that are innovating fast. And without that, I understand you're going to have a disparate investment industry. There's a disparate government investment industry, because remember, we have the Office of Strategic Capital, which has $200 billion to do low-cost loans to these companies, and a disparate ordering of those systems, which really is what these companies want. They want orders. They want revenue. They want to win. And so we provided all three in this administration.
Is this something that you would consider moving into robotics, moving into AI? Are there plans for that at this point?
Robotics, for certain, we're doing the same thing. AI is, as you know, artificial general intelligence has a lot of different purposes, not just for robotics or for drones, but for warfighting, because you're doing battlefield management, and just for efficiency purposes like you would in any enterprise, and for intelligence purposes, how do you synthesize intelligence, because we collect a lot of it. So AI is going to be less competed against one another in any narrow sense, but really in a broad sense. But for robotics, absolutely, that's the next big thing, and you'll see us invest from the Office of Strategic Capital in robotics companies and the components that go into robots, because we won't and can't fall behind China on that.
Hey, Emil, I have a question just about Defense Department costs and the like. For a very long time, a lot of the new tech companies that were getting into the defense space suggested that we could bring down the costs of our Defense Department over time by investing in these new technologies, getting rid of these long contracts with the primes and everything else. And it feels like now that a lot of those new tech companies have emerged and gotten contracts with the Defense Department, that angle, meaning we're actually going to lower costs and we should be pushing for a smaller budget rather than a bigger one, have shifted. Obviously, now the department is looking at a budget that may be close to double. How do you think about that?
Yeah, it's the right question. And the reason is we're still using a lot of the weapon systems that we developed during the Cold War. And as this new type of warfare has really come upon us in the last 5 years, we've thought about what we need for the modern battlefield. And you need right now both. But I think eventually you're going to see what I call a mix shift. You're going to see the shift of dollars from what we call exquisite systems that were developed during the Cold War to more modern, mass attritable, autonomous systems driven by AI. And we're right in the center of that shift now. So you'll see a big budget ask from President Trump this year for $1.5 trillion. But that's a one-time ask that then reverts to the normal baseline. And ideally what we'll see over the long term is that an arsenal that's more modern is actually easier, cheaper to maintain because we'll have the same capabilities. But right now, when you don't have everything in one side or everything in the other, you're going to have one moment where that has to converge. And we think this next year is the year you'll have the biggest number you'll see.
Emil Michael is the Chief Technology Officer at the Pentagon. And Emil, thank you for joining us today.
Thank you for having me.
Sure what to attribute it to. The markets are adding to gains handily. It's got maybe something to do with oil. Oil at this point, suddenly ICE Brent is below 90. It was up in the mid-90s. WTI looked like it was headed for 90. And I don't know whether it has anything to do with the Bessent moves yesterday. But the 10-year also, 10-year was what, it looked like it was going to get to 3/4, and now it's down to 466. I think earlier, in fact, like late, overnight, I think it was much higher. It was, and so I don't know, but now we've got the Dow up about 280 points. S&P, the NASDAQ is strong as well. We're going to talk Canada, and maybe we can ask this gentleman about Lake America when Squawk Box comes right back, formerly Lake Ontario.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
This is not just good content, this is good business.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
I'm with Becky. This is the greatest show on earth.
Squawk Box, streaming on CNBC+. Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
I built a legacy on the court, and now it's the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have two small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
Coming up, an AI company that helps data centers dynamically adjust electricity consumption to avoid strain on the power grid. We're going to talk to the founder and CEO of a startup, Emerald AI. You don't want to miss this. It's fascinating. Squawk Box, come right back.
from London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4?
We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
It's becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented.
This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
When Amanda Lacaze took over Lynas Rare Earths, the company was on the brink of collapse.
I put my hand up because the people in the business deserved someone to give it their very best shot.
12 years later, she's leaving behind the world's largest rare earths producer outside China. Can one company really challenge China's dominance?
I'm confident. We've got good people in Australia, we've got good people in Malaysia. Not only can we compete with anyone, we can win.
Find out more on Managing Asia.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Powerline, streaming on CNBC+.
I personally risked everything to make Hyrox happen for me. For whatever reason, I went all in, literally. And I didn't have a plan B.
Moritz Forster had already reached the top of his sport. Olympic gold in Beijing, Olympic gold again in London, then bronze in Rio. But after he left field hockey, he was searching for something most athletes never get back, a second arena. The idea became Hyrox, a standardized indoor fitness race built for the millions of people who train in gyms but did not have a sport of their own.
In 2026, we currently sold 1 million tickets, with roughly another 500,000, 600,000 to be sold till the end of the year. And we're operating 34 countries.
The format is simple and unforgiving. The same race, the same order, anywhere in the world.
If we would change the format, it would just not be Hyrox anymore.
Andrew Ross Sorkin. Among today's top stories, the White House unveiling a new global sanctions plan against Iran called Operation Economic Outcast. Treasury Secretary Scott Bessent calling it a final warning to countries, including China, to cut business ties with Iran or risk losing access to the dollar-based financial system. Billionaire investor Stan Druckenmiller, a mentor to Scott Bessent, is questioning the Treasury's recent bond market actions. In a Wall Street Journal editorial or op-ed piece, Druckenmiller writes, governments defending prices against fundamentals always lose. And Alabama's Attorney General is opening an investigation into OpenAI after its models hacked Hugging Face last month. The probe looks to see if OpenAI violated the state's consumer protection laws or poses an ongoing risk to its citizens.
Checking the futures again, and we did before we went to break. You can see there some nice gains this morning in both, in all of the averages on a percentage basis. Crude oil may be partially responsible. Both Brent and ICE down about 3%, $3 each of them. And then Treasuries, the 10-year, looking a little bit more manageable, 30-year as well, 466 now. On the 10-year. Bitcoin was above 80,000 for a while overnight. I think it's down in the low 79s at this point, but it's had a big run in the past week or so. It may have bottomed at 58,000, could be a trading range, obviously, but it has moved from 58 to 80 or 79 pretty quickly. All right, we're going to go to the guests next, Andrew. You ready?
We have a great
Are you going to be okay without Dom?
We'll miss Dom. We'll get back to him in just a little bit. But new this morning, we got some news to tell you about. Artificial intelligence startup Emerald AI has announced it's raised $150 million in a Series A funding round. Its valuation has now hit unicorn status. The company is backed by some big names, including NVIDIA, GE Vernova, and individuals, including John Doerr and Tom Steyer. Joining us right now is Emerald AI's founder and CEO, Varun Sivaram. Good morning to you.
Good morning, Andrew.
This is the energy side of the AI complex. We keep talking about sort of data centers and what's going on. But for those who don't know, and it's hard to understand some of this, explain exactly what you guys do.
Thanks, Andrew. Emerald AI transforms AI data centers into flexible grid allies, capable of reducing their power demand when the grid is stressed out. We solve three problems all at the same time. The race for power and AI, as the United States tries to maintain its lead against China in the AI race. We get data centers connected faster because they're flexible. We keep rates down. We control affordability of energy for communities. And we keep the grid more reliable and protected against blackouts.
Just explain how you do this. So this is a software-based system?
Exactly. Emerald AI is a software control system to help an AI data center control its power when the grid's stressed out. Let's say it's a hot summer day in Phoenix, Arizona, and the grid says, hey, I need some support. An AI data center now can be a responsive ally by reducing its power in that moment. We've showcased a 25% reduction for 3 hours.
But how do you do that if all three of us are still prompting the models at the same rate we were 3 hours ago?
Exactly. So there's three ways you can achieve this flexibility. The first is temporal flexibility. Maybe there's some stuff happening at that data center, fine-tuning models, for example, that can be slowed down or paused. We, for example, can reduce the clock frequency of the NVIDIA GPUs running at that facility. The second thing you can do is you can move AI workloads. Let's say, Andrew, you and Becky, as you mentioned, are asking ChatGPT questions at some rate. You expect answers back. Well, we can move AI work, and we've done this. We've showcased between Virginia and Chicago when the Virginia grid was tight. We moved queries from one location to another at the speed of light. And so you basically don't notice the difference. But that Virginia data center now can provide some relief back to the grid. And the third way is you might have a resource on site, a battery, let's say, and you can use that battery to reduce the grid draw. You do these three things together, temporal, spatial, and resource flexibility, and that data center becomes a responsive grid ally.
Let me ask you this. We keep talking about a number of companies who've come on in the past couple of weeks, and we were talking about the Open Router deal last week, where there's a lot of folks who are putting in prompts, effectively token maxing, using a lot of energy on prompts and questions that they shouldn't be. So people using, Fable to ask it the weather. Is probably a bad use of all of this. And so you now have these Open Router, Ramp, other companies that are effectively picking which model is being used per prompt. How effective is that, and how related is that project to what you're trying to do?
So, of course, Andrew, efficiency is important. We want to be energy efficient in how we use AI. But at the end of the day, we're not going to efficiency our way out of this issue, right? Between now and 2028, the demand for AI in America is 70 gigawatts, and we can only plug in 30 gigawatts of data centers onto the grid. At the same time, China just built over 500 gigawatts of new power capacity last year, 10 times what we did. We're not going to outbuild our way out of this supply-demand gap, but we can outsmart it. What Emerald AI does is makes the AI data centers flexible. We should continue to use lots of power for AI, whether it's low token models, high token models.
Who are your customers?
We make data centers flexible and get them larger and faster power connections. So data centers are our customers. In addition,
so is that hyperscalers are hiring you?
So we work with some of the world's biggest companies. We work with some of the our customers include global data center operator platforms, AI firms, and we also work with power utilities, because power utilities want more flexible data centers that are going to come onto their grid, but they're not going to trigger very expensive grid upgrades.
But where the software resides, where?
In the data center.
It lives inside the data center. So when you say you work with an energy company, that's what I was trying to understand. It's not that you can put your software, at the energy company. You have to put it inside.
I'll give you an example. So because we make these data centers flexible, they become allies, friends to the grid. The grid's really like this. So Silicon Valley Power, utility in the heart of Silicon Valley, has worked with Emerald, partnered with us, to roll out a flexible load interconnection program. That means they've got 60 data centers in their territory. If you want more power, you don't have to wait 10 or 12 years anymore. You can get it overnight if you're willing to be flexible. And one way to do that is to use Emerald AI software in that data center.
Who are you competing with?
Look, I think we're creating a new category here.
I'm sure, but who else is doing anything like this?
I will say that Google has been a long-term pioneer in this field. I don't consider them a competitor. They're a leader, a visionary, and they have, for their own data centers, made them flexible.
Let me ask you a different question, because NVIDIA is a big investor in your company. There is a massive question in the marketplace right now about what's described as circular financing, right? All of the various companies that they are putting money in. They're putting money into the LLMs, they're putting money into some of the data centers themselves, they're putting money into companies like yours, and whether all of those things, we heard that they may put money into Perplexity, yesterday. Sometimes it's described now as the central bank of AI. Whether you think that's good or bad, and whether you think there is a circular financing element to this, because the more I think about it, the more I think to myself, if the data centers are buying your product, if NVIDIA is effectively giving you money so that you can work, then you also have the data centers giving you money. They are buying the NVIDIA chip. I mean, the whole thing is just one big circle, and the question is that a problem or not?
Ultimately, this AI boom depends on durable, real demand for tokens of artificial intelligence. I happen to believe that there is real external durable demand for this, and what Emerald does is unlock the power grid so that we can get those data centers connected. Look, we're delighted with our NVIDIA partnership and super grateful. NVIDIA, as you know, has this new announcement with their $500 billion platform for a new asset class, these AI factories or AI data centers. Emerald software integrates deeply with that to make them flexible. We can unlock 100 gigawatts on the grid today.
By the way, just finally, since you mentioned the asset class idea, we keep debating it and talking to people about it. Some people who think it's an absolute asset class, other people who are more skeptical. What is your sense, not just over the next 5 years, because over the next 5 years, it is clear that we are going to have a shortage, I think, of chips, which will make the value of older chips more valuable. The question is, when and if we ever get to a place where we can get enough new chips online, what it does to the value of the older chips.
I want to be clear, Andrew. I don't think chips are going to be the bottleneck between now and 2030. It's power. And the reason this is important is, again, the supply-demand gap for us, that 50 gigawatts by 2030 in power, determines whether the United States can build enough data centers to keep up.
I'm reading this now. You're right. 10 times the amount of power added in China. And you know what? They're doing 500 gigawatts of coal, and it's all permitted. It's all ready. They've got all the permits. Everything is ready to go. So they can do things over there we can't do here.
And to be clear, Joe, we should be building a lot more energy. I'm a big fan. But alongside it, let's unlock this 100 gigawatts we've got ready today on our existing power grid. From flexibility, we unlock
That's 100 gigawatts.
And I'll give you the proof point. You know, not only have we done these 5 demonstrations around the world, London, Portland, Phoenix, we also are now deployed at full multi-megawatt data center scale. And later this year, we'll launch a 100-megawatt, multi-billion-dollar AI factory with NVIDIA and Digital Realty that's flexible.
To me, this sounds like cutting Medicare by looking for fraud and waste. It sounds good, but you can really do it. 100 gigawatts just from what you...
It sounds too good to be true, right? But this is not a gimmick. There actually is 100 gigawatts. Academic research shows us 100 gigawatts of available capacity if we can unlock it by making the data centers act in a different way. Traditionally, the grids and communities work for data centers. This is a way to have data centers work for grids and communities. Because, by the way, in addition to unlocking all that power and competing with China, you actually keep rates affordable by avoiding having to expensively overbuild the power grid.
Does it throttle any of the information or the queries that we're looking for in it?
Precisely. So as we were talking about with Andrew, if you say it's a hot summer day, or I'll give you another example. In London, where we did a demo, we all watched the World Cup. At halftime of the soccer game, the football game, they all turned their tea kettles on. A gigawatt of load spikes on the grid. We worked with the Nebius AI factory with NVIDIA chips, and National Grid said, hey, please reduce your power at halftime when the tea kettles go on. We reduce power. Now, your question is, does that throttle work? It can. You can throttle chips or workloads, slow them down, only the ones that the customer is okay with slowing down, or you can move some to other locations, or you can run local batteries or other energy resources. Doing them all three in an orchestrated way.
Does it mean that I'm not going to get my answer as quickly?
We want to make sure, Becky, that you never notice the difference. There are so many different workloads with different performance characteristics that the ones that you're okay, the fine-tuning run you expected tomorrow, the training run you expected next week, those are the ones that get slowed down. But the thing that you want right now, Becky, your mission-critical AI workload does not get throttled. We published this research in one of the world's top scientific journals, Nature Energy, saying we can assure the performance of mission-critical customer workloads while precisely meeting what the grid needs, which could be, lightning strikes and there's an equipment malfunction and the grid needs some relief. We responded within 30 seconds in London in that demo.
It's kind of like my Nest. I have a Nest product for the house that does the temperature, and it tries to be more efficient, but it is warmer during certain parts of the day because it's trying to save energy. Thank you. It's fascinating. We'll talk more about it, I'm sure.
Thank you, Andrew.
Coming up next, the federal government making a push to recruit top tech talent. We're going to speak to the Office of Personnel Management Director Scott Bessent on Washington's efforts. And later, Zach Witkoff, co-founder and CEO of World Liberty Financial, on the company's bank charter and what it means to the future of stablecoin services. Do not go anywhere. Squawk Box, come right back.
When world-class racing meets the best in science, nothing is left to chance. At this level, everything and everyone has to perform at their best. Ecolab helps protect it all, from people to performance, ready for whatever the race demands. This is what the best looks like. Driving innovation and building a high-performance future that's better for people, planet, and business. The best of us, winning the right way.
Halftime Report, weekdays streaming on CNBC Plus.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
Our next guest is helping lead the U.S. government's effort to recruit top tech talent. Joining us now, Office of Personnel Management Director Scott Cooper. His department, along with the White House, the OMB, and other agencies, launched TechForce in December. That's a government-wide effort to recruit top technologists, and the program's now expanding with a goal to hire about 1,000 employees for temporary 2-year tech jobs. And I'll tell you, Scott, welcome. It's good to see you on set.
Good to see you.
What I initially thought was, oh no, another job training program that doesn't work. But you're not doing that. You are actually trying to get the best and the brightest to initially help the government.
That's right.
Not the government help them.
That's exactly right. Yeah, we're trying to do two things. So one is, as the name implies, we've got some kind of just talent gaps in government, right? So for us to do modernization, we need people who understand modern software engineering and AI and all this other stuff. So that's part of it. The other kind of more meta point is, if you look at the demographics of the workforce, only 7% of federal employees are under the age of 30, and close to half are over the age of 50. So we have this pending major demographic problem, which is we're not replacing, as people retire in government, we're not actually bringing in new talent. So we're trying to launch a much broader effort, TechForce being one pillar of it, to figure out how do we get early career people to decide coming to government, even if just for a 2 or 3 year period is fine. We don't need people to come for 40 years. Come for a little bit of time, do some great work, and then look, if you want to go to the private sector, that's great too. We're happy to do that. So TechForce kind of incorporates all that. People come in for 2 years, they work on great projects. We're partnering with about 40 different technology companies.
The best. Biggest
exactly, all the big companies. And then at the end of the period, we're going to do this big job fair where if people want to go to the private sector, that's great.
And then they know all these, some of the companies know these people already. So it is for the government initially, but it is sort of a place to cut your teeth and
I think that's right.
Get
yeah.
experience and get a great job in the private sector.
That's right. Like if we could, like my dream would be like you could think of the federal government as kind of like the finishing school for every early career person, right? So I've joked with my friends at McKinsey and Goldman, which is, look, if we could put the consultancies and the investment bank analyst programs out of business, let those people come to the government for 2 years, and then they can go back and go to McKinsey and Goldman and places like that. Like the world, I think, would be a much better place if we could harness that talent for some period of time.
And this sort of flies in the face of what has been happening with the federal government. There was a net loss of 271,000 employees, and then people complain about you can't get rid of any program that you've designed in the last 20 years, pandemic or otherwise, has to stay. You can never get rid of it. So it's very difficult to get rid of. There's a lot of carping, but
it is difficult.
This is the opposite.
Yeah, the way I've been describing it is
talking 1,000 total.
Yeah. I mean, this doesn't make a difference. Yeah. The way I've been talking about it is, look, we are kind of reshaping the government, which is actually the numbers even a little bit higher. So there's been about 300,000 net exits from the government since the beginning of the Trump administration. So we're about 2.3 million. We're down to about 2 million right now. And on top of that, there are places where we do need to hire. Tech is clearly an area where we need to hire. We need to get the right people in. But that's all part about actually making the government both efficient and also making sure we've got the talent that we need.
I have a language question for you.
Oh,
no. Who's in charge of talent. No. So on one end, this administration, as have others, have been very critical of just anybody who's a government worker.
Yep.
There's a sense if you're a government worker, you have to be not that talented and that the government's incapable of doing anything, therefore you're not talented, all of that. On the other end, right, and we sort of disparage government workers, to be honest with you, or some people do. I would say some people even in this administration disparage the idea of being a government worker. At the same time, you're in charge of trying to attract talented people to do such things. And so how do you think about the language that the government should use?
Yeah. So I will speak for myself, which is what I have said, is I've never disparaged the government workers. I think they are caught in a bad system. So, yes, there's clearly people, like any organization of 2 million people, there's clearly people who are not doing their job, who we do need to make it easier to hold them accountable. And we're doing that. So we've passed a bunch of policies. At the same time, though, here's the fundamental problem is the entire government culture is one of compliance and legal oversight. It's impossible to innovate. It's impossible to do anything. And so, yes, what happens is we plod along. And by the way, little stuff like promotions, they're gated by tenure in the seat. That's the most silly thing in the world. So we're eliminating that. So we're getting rid of tenure as a basis for promotion, and we're trying to actually get merit as a promotion, opportunity. So one of the problems, by the way, why we have so few, I think, early career people is because no one wants to come into that environment where if you're not destined to be there for 40 years, it's not an interesting place to be. So we're eliminating college degree requirements for all jobs. We're eliminating tenure-based requirements. So the canonical example to me is we should be able to hire some killer engineer who maybe didn't go to college, but who can perform at the level of a top federal employee. We should pay that person at the most senior level if they can do the job. Today, under the rules, you can't do that. And so we're changing all those rules.
That's what I was going to say very quickly. Yeah. The pay, how does it match up to what they get in the private sector? And are you the beneficiary?
Yeah.
Are you the beneficiary of a tough job market to some extent?
Yeah, but look, as you all well know, particularly for the engineering jobs, there's plenty of engineering jobs out there. No, but what we can't, so look, the pay is always going to be worse in federal government. That's fine. And that's why also, by the way, I don't need people to come give 40 years of their life if they want to go make money in the private sector. Right. But what we can do, though, is this leveling thing, right? Which is before, if you didn't have a college degree or if you didn't have 5 years of work experience, we would bring you in at what's called a GS5, which is a super low level. I don't know, we pay them $50,000, $60,000 a year. We're never going to get good people. But if you're awesome and you can perform at the level of a GS15, in Tech Force, we're paying people $160,000, $170,000 a year. The best ones can certainly make more if they go to the Valley, but that's competitive if we level them appropriately for what their skills are. So that's the kind of stuff that we have to do.
Yeah.
I know we have to go, but I have one other question, which is you're a former Andreessen Horowitz man.
I am.
A lot of people in the Valley last week, I think, were surprised, as I was, that the Department of Justice was going to investigate Andreessen for this idea of these overlapping board memberships. Yes. Yeah. Mark has been very supportive of the president. Ben's been very supportive of the president. You're obvious. And so by the way, that unto itself should not be a reason the Department of Justice investigates or doesn't investigate anybody. Yeah, but I think a lot of people said, oh, goodness, this is interesting.
Yeah.
What do you think of it?
So I know absolutely nothing about the inner workings of it, just to be totally clear. The idea, though, of overlapping board seats, that is not, there's nothing nefarious about that. And in fact, actually, even in the two that were named in that suit, one was Ben Horowitz, one was Martin Casado, right? And so, venture firms do this all the time.
But venture firms have done this forever, and so it was interesting that they went at Andreessen first.
Yeah.
And what you think that is about.
The honest answer is I really don't know. I mean, obviously, I'm not in the DOJ, and nor am I part of Andreessen Horowitz, but to me, it's a non-issue. Look, we invest in a bunch of stuff. My former partners. What often happens is companies pivot over time, right? So, famously, this is a public story, but as you probably know, we invested in Instagram before it was actually called Instagram.
Right.
And we had another company that was actually in the picture sharing space, and Instagram pivoted into that space. And so, yes, like by that definition, we had two conflicting things. And look, you deal with it. You put up Chinese walls from a communication perspective. You kind of make sure you don't have But
you think this is going to change the Valley? I mean, this whole idea, because there are people who are on lots of boards. That's part of the whole venture world.
Look, my personal view, again, without knowing anything about it, is, look, I think this is a non-issue, quite frankly. So, I mean, we'll see. Maybe I'm wrong about that, but I don't think this materially changes anything in the Valley.
Thanks.
Hey, thanks for having me. I really appreciate it.
Up next, Ontario Premier Doug Ford saying everything is on the table, including a restriction on electricity to millions of Americans. We'll speak to Canada's top trade negotiator about the cross-border collapse. Squawk Box will be right back.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC+.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budgets are. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall things. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you, and you need to be on this learning curve forever.
No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli. Closing Bell Overtime. CNBC.
Welcome back to Squawk Box. The trade fight between the U.S. and Canada heating up, including a social media post this morning from President Trump threatening to rename Lake Ontario Lake America. Joining us right now is Dominic LeBlanc, who's a Canadian minister responsible for Canada-U.S. trade, intergovernmental affairs, and One Canadian Economy. Good morning to you.
Hi, good morning.
We could start with the Truth Social post. What's your reaction to that?
So we've decided as a federal government months ago not to respond to sort of the daily social media post of either the president or his cabinet secretaries and so on. We're focused on doing what we can in Canada to build our economy and to
Welcome to China in Focus. I'm Tiffany Meyer. Our top story, China in the crosshairs as Trump ramps up pressure on Iran, with Treasury Secretary Bessent warning no one can escape U.S. sanctions. China depends heavily on U.S. plasma for a critical medical treatment, giving America a potential source of trade leverage amid rising tensions. Taiwan indicting former employees of NVIDIA and Supermicro for allegedly smuggling AI servers to China. Details on the push to prevent the technology from flowing into China. A Tesla feature now under fire. The company's largest ever recall is raising new questions about a feature designed to make electric cars look sleek. And a red carpet event in California, a documentary celebrating Shenyang performers' resilience amid attacks from the Chinese Communist Party. The Trump administration dramatically widening its economic pressure campaign against Iran, launching Operation Economic Outcast and putting Tehran's global enablers on notice. Treasury Secretary Scott Bessent pressed on whether Chinese banks could be next in the crosshair for helping turn Iranian oil into cash. NTD's White House correspondent Mario Tsu has the details.
In that dramatic escalation today, Treasury Secretary Scott Bessent is saying that he's unleashing what he calls an economic D-Day on Iran and people helping Iran, entities and companies. A new campaign, he says, to cut off Iran's economic lifelines around the globe. Now, this is called Operation Economic Outcast, and the Treasury says that it will target networks Iran uses to sell oil, move money, and evade sanctions. That includes through digital assets, gold, aviation, shipping, and technology. The Treasury says that the U.S. is giving countries a very short window to cut off these ties, warning that anyone who continues to help Tehran stay afloat could be kicked out of the U.S. dollar system. Take a listen.
The final refuge of this regime is a mistaken conclusion of nations that still finance the Iranian threat in the hopes of evading it. It is no longer acceptable to operate in the gray spaces of this conflict. Countries cannot claim they are blind to enabling this activity. We are going to hold everyone accountable, and this is economic asphyxiation of this regime.
Now, Carrie, this is coming as $1 US worth approximately 2 million Iranian rial, a historic low for the country's currency. And as President Trump declares as much on Truth Social, saying, quote, Iran is completely collapsing. We're winning against everyone, including Iran, whose country is an economic and military death spiral. Now, President Trump has warned China specifically against helping Iran, with the Chinese regime historically buying around 90% of Iranian crude. And today, when pressed specifically on Chinese banks and their involvement in this, Bessent said that no one is above U.S. sanctions, warning that anyone helping turn Iranian oil into money will be targeted, including Beijing. Take a look.
That no one is above the reach of U.S. sanctions. We know who they are. They know who they are. So when the hammer of U.S. Treasury actions falls upon them, they will have no one to blame but themselves.
U.S. sanctions on Iran aren't just hurting Tehran, they're also putting pressure on the countries buying its oil. So who's taking the biggest hit?
The US is threatening Iran with economic D-Day, with sanctions targeting Tehran's main trading partners. So who are they? China is the biggest buyer of Iranian oil, an estimated 1.38 million barrels per day in 2025. In April, the US Treasury imposed sanctions on a Chinese independent refinery for buying billions of dollars worth of Iranian oil. It also warned Chinese banks of secondary sanctions if they facilitated the trade of Iranian oil. But over the past decade, Beijing has created a ring-fenced system of refiners. They process mainly Iranian oil and do not have much US exposure. China has said it, quote, firmly opposes illegal unilateral sanctions. The UAE has long been one of Iran's economic lifelines and was among Tehran's largest trading partners before the war. It provided 30% of Iran's imports, worth an overall $21 billion in 2024, according to the World Trade Organization's latest figures, as well as 13% of exports. But the UAE recently suspended all financial and economic transactions with Iran until further notice. It cited a military escalation by Tehran with a missile threat. Turkey, which gets 13% of its gas from Iran, has expressed no willingness to change its significant economic ties with Tehran. Iraq pays Iran around $4 to $5 billion a year for natural gas. Two Iraqi energy officials said any new US sanctions could create significant challenges for Baghdad in maintaining payments for Iranian energy. And India's trade with Iran once stood at $17 billion. It was cut by more than two-thirds in 2020 when the US pressed on with sanctions against Tehran, and has fallen further ever since.
China's plasma reliance runs deep. The country is facing a medical supply problem tied closely to its biggest geopolitical rival, the United States. It consumes more human albumin than anywhere else, but relies heavily on American plasma to make it. A 2024 study found that more than 60% of China's human albumin is imported, and much of that imported supply relies on plasma collected in the U.S. Blood plasma is the liquid part of your blood. It carries important nutrients and proteins, and doctors use donated plasma to help patients stop serious bleeding and treat certain blood disorders. The U.S. supplies roughly 70% of the world's plasma, helped by a large network of collection centers and paid donors. Meanwhile, China has struggled to collect enough plasma domestically because of strict regulations. Those rules date back to a devastating HIV outbreak in China during the 1990s. Unsafe plasma collection practices infected tens of thousands of people, prompting Beijing to impose tighter controls. Today, China is estimated to face a yearly plasma shortage of around 6,000 tons. Beijing is trying to open more collection centers and develop alternative sources. But closing the gap will take time, leaving China dependent on American supplies for now. And as U.S.-China trade tensions continue, that dependence could become trade leverage for Washington. The issue also highlights a broader challenge for Beijing, reducing its reliance on foreign supplies, similar to its efforts to restrict rare earth mineral exports. Taiwan indicting 9 people Monday for allegedly illegally exporting AI servers to China. That includes former employees of NVIDIA and Supermicro. The U.S. has imposed export controls on advanced NVIDIA chips, trying to prevent China from accessing them. As the world's largest producer of advanced AI chips, Taiwan is under pressure to ramp up enforcement. Prosecutors say the accused made false claims to gain approval for the purchase of over 100 AI servers from Supermicro with advanced NVIDIA chips. They allegedly shipped more than 70 AI servers to China through Hong Kong and Indonesia, all while being aware of the export regulations. Supermicro said it's working with Taiwan authorities to protect its technology. Tesla is at the center of China's largest ever auto recall. It involves a feature that helped define the sleek look of many electric cars: hidden door handles. Chinese regulators say the handles can be difficult to find and operate after a crash or power failure. Tesla recalling nearly 3 million China-made and imported vehicles on Friday, its largest recall in any market. 8 Chinese automakers are also recalling about 1.3 million vehicles over similar concerns. The list includes Xiaomi, Geely, and several other Chinese electric vehicle makers. Tesla says it will add warning labels showing where the emergency releases are located. It will also issue a software update designed to lower the windows automatically after a crash. The concerns come after cases in China where occupants and rescuers reportedly struggled to open vehicle doors. China has already moved to ban fully retractable door handles on new cars beginning next year. Under rules taking effect in 2027, new vehicles must have mechanical door releases on both sides of the doors. That could mark a major shift away from the sleek hidden handles Tesla helped popularize. A documentary about resilience amid a campaign of attacks from Beijing. The red carpet event for the film Unbroken, the untold story of Shenyun in California, brings together locals who have stood by Shenyun dancers and performers for 2 decades. NTD's David Lamb reports.
The red carpet event for the investigative film Unbroken, the untold story of Shenyun, brought artists back to the San Francisco Bay Area.
It feels great to be back in my hometown because I was actually born in Hong Kong, but I was raised here since I was 8. So
I really miss actually Chinatown. I miss dim sum because usually we're having class in the morning, but dim sum opens in the morning and it's like an evening lunch food.
This is the first documentary about Shenyun Performing Arts, a dance company based in New York that advertises China before communism and a return to traditional Chinese culture. The film Unbroken explores how art and faith endure when faced against a global disinformation campaign pushed by the Chinese Communist Party.
And it's very meaningful, and I think it's in today's society this is something that's very needed, and I think they're a huge asset to the community.
I think a lot of people, they've seen the posters, they know that we're about classical Chinese dance, but they don't understand what motivates us. And I think this movie really brings to light some of the human rights abuses that are going on in China and the fact that this is really motivating us.
With bomb threats and all of that, I have never had to endure anything like that, but it takes a lot of courage just to stand strong for what's right and not to give up.
Local leaders and viewers resonated with the award-winning film.
It's very informative. This is my first time really learning about these issues. It's just, it's always important to try and, get your own message out.
I think the film is fantastic documentary based on the truth and the evidence.
China, the second economy in the world, is afraid of a group of performers and using bomb threats and all this crazy stuff that they've been doing.
Although the company and the theaters it performs at have received threats of violence, including bomb threats, no actual incidents have ever occurred. Shenyun was established in New York in 2006, and the transnational repression it faces has larger implications.
But it's really a bigger message because anyone could be targeted. It's really not just about Shenyun alone. It's really an attack on our freedoms now.
Go and watch the Unbroken movie because it gives you a very good insight of who we are behind the scenes.
So if you liked what you saw in the film in terms of the colors and the dancing and the character of the performers, seeing that all come to life in person is really totally different. It's a once-in-a-lifetime experience that everybody should really treat themselves to.
Shenyun just completed its 20th anniversary season, and tickets for the 2027 tour are available. The company will come back to San Francisco in December. In San Francisco, David Lamb, NTD News.
Falun Gong practitioners taking to the streets of New York City over the weekend, celebrating their spiritual practice while also calling attention to a decades-long persecution in China. NTD's Nico Bani brings us more from the parade.
Here in Brooklyn, New York City, the colors and the music may be what catches your eye, but for the practitioners marching down 8th Avenue behind me, there's a much deeper message as they say this is a way to raise awareness of a persecution that's happening in China. Falun Gong, also known as Falun Dafa, is a traditional Chinese spiritual practice rooted in truthfulness, compassion, and forbearance. Falun Gong spread widely in China in the early 90s, and by 1999, an estimated 100 million people were practicing. The Chinese Communist Party, viewing the practice's popularity as a threat to its power, launched a brutal persecution to eradicate it. Now, practitioners march in parades all over the world to spread the word. Leading the parade is the New York Tianguo Marching Band, founded in 2005 and made up entirely of Falun Gong practitioners. The volunteer musicians say their mission is to share the beauty of the practice through music.
I started doing this particular Brooklyn parade about 6 years ago. I think it's important for people to see that we are still here.
For those who have fled the CCP's persecution, the message is extremely personal, and that impact doesn't stop at China's borders.
There are still people being persecuted in China, so I just want to call for them, shout loud for them, and hope this could give the pressure to China and stop the persecution in China.
They also export that persecution to Western countries like the United States, where they're going after Falun Gong practitioners, democracy activists, all those kind of people, on foreign shores as well. So it does affect Americans, and they shouldn't stand for it.
As spectators line the streets to watch, practitioners say they hope one message sticks with them. Falun Gong is good. Nikubani, NTD News, New York.
Coming up, U.S. sanctions on Iran tightening. China, its biggest oil importer, could hold the key to keeping Tehran afloat. What does Washington expect, and how is Beijing responding? Retired Marine Colonel Grant Newsham and Kelly Sloan, energy policy consultant, weigh in. More on that after the break here on China in Focus. Welcome back to China in Focus. I'm Tiffany Meyer. As the U.S. ratcheting up economic pressure on Iran, it's publicly pressing China to help. Reuters reporting blockade efforts already tightening supply of Iranian oil for Chinese buyers and driving up prices. Reuters citing trade sources saying offers of Iranian crude to China for September and October delivery have declined. Some barrels that would typically sell at a discount now being offered at a premium. Kepler data cited by Reuters showing Iranian oil in floating storage has fallen from about 105 million barrels before the blockade was reimposed to about 80 million now. 2025 Kepler data saying China buys more than 80% of Iran's shipped oil. Treasury Secretary Scott Bessent signaling the U.S. wants China to join its economic D-Day pressure campaign, saying China should, quote, get with the program and support the U.S. campaign to isolate Iran, noting Beijing gets half of its energy from the Gulf. China has said it rejects unilateral sanctions and says sanctions will not solve the conflict. To discuss, I spoke with retired Marine Colonel and former U.S. diplomat Grant Newsham and Kelly Sloan, energy policy consultant. The Trump administration says that economic D-Day may prevent the need for escalating military action. Is this a good thing for energy markets?
Well, it can be. In terms of China, it's going to depend on two things. First of all, whether China can replace that source of oil, which it may be able to from Russia. And the second question is whether the United States will actually follow through on actions against China, keeping in mind that China still has a stranglehold pretty much on the world's supply of critical minerals, which are becoming even more critical as we need more of them to replenish some of the weaponry that we've used up in Iran. So depending how those two questions get answered is going to depend a lot on how this all plays out. Now, it is true, and this is going to hurt Iran more than it is China. And to that extent, the blockade and the president's strategy currently is working to the extent that about 80% of the traffic that is going through the Strait of Hormuz is being controlled by the U.S. It's U.S. dictated traffic. The Iranian economy is in a shambles. They're facing about 90% inflation right now. Every segment of their energy industry owes each other tremendous sums of money. They're looking at potential rationing of their domestic supply of oil. They're already instituting rolling blackouts. You're going to start seeing gas lines and that kind of thing. So in terms of hurting Iran, yes, this is working. But again, and for how it's going to impact China, that's going to depend on first of all, whether China can replace that source, and second, whether China will use, as it has in the past, their control of critical minerals as kind of a sort of Damocles over the United States.
And Grant, when it comes to countries giving Iran a lifeline, the Chinese Communist Party has long helped sanction regimes like Iran, North Korea bypass the international economic system. How big of a role does China have in sustaining the Iranian regime?
Well, China's role is immense in keeping Iran afloat, and it has been for a long time. China has viewed Iran as its really main proxy in the Middle East, and it doesn't really have to provide all that much support to keep the regime going, even these days. And it is shipping in dual-use technologies that are used in drones, for example, the chemicals that you use for missile fuel. The support is, as I said, what keeps them going. And in China, it's in China's interests. And this is the kind of regime that will shoot 40, 50,000 of its own people if they complain. So the kind of hardships that would bring down, say, a sort of a normal country, say Switzerland, with a place like Iran, it doesn't have quite the same effect. But the Chinese have always been willing to support countries that they see as really in a position to cause the United States and the free nations a lot of trouble and to serve as a huge distraction, which Iran certainly is and has been for a long time.
And Kelly, China is the biggest buyer of Iranian oil by far, but Iran is not the biggest supplier of energy to China. Now, if Iranian oil is off the table for China long term, how significant would it be for China?
Not terribly significant, as you said. They do have other sources, and Russia is probably their chief source. Where that'll come into play is if Russia becomes almost their sole source, and that gives Russia a lot of control over pricing. And of course, Russia needs a lot of money right now too to replenish their munitions and to finance their war in Ukraine and to circumvent the Western sanctions on their economy. So what you could see is if China needs to rely more on Russia for oil, Russia could use that to their own advantage to manipulate the market there. China will be trying to find other markets as well. We know that they are increasing their footprint in Africa, for instance. We know they're trying to increase their presence in the South China Sea, the Indian Ocean. So they are going to try and find other markets, but it will hurt them. But it's not going to hurt them as much as Iran has a lot more to lose in this scenario than China does.
And Grant, President Trump has more than once thanked China, perhaps with tongue-in-cheek, for not getting involved or helping Iran. How much sway could China have over Iran if it actually wanted to apply pressure?
It would probably be decisive if China wanted to finish it all or just withhold support. Same goes with China's support for North Korea. It could end the place in an afternoon. So China's role is very important. And it's not just in really not buying Iranian oil, but as I said, it is the things that are coming out of China into Iran that are being used to really lash out at the United States. U.S. forces have killed Americans, not least the targeting data, which the Chinese provided via their satellite constellation, but also allows the Iranians to hit the Gulf states as well. So if China wanted to stop, it would, but it really doesn't see why it should and hasn't been given a reason to do so. They're not going to cooperate voluntarily, as Secretary Bessent suggested, and he probably knows that they're not either. But the United States doesn't seem yet to have been willing to put the sorts of pressure on China that would give them a choice saying, well, do we want to put up with what we're getting hit with, or do we want to keep Iran afloat? For some reason, we haven't gone after them. And the critical mineral stranglehold, which Kelly mentioned, that is indeed something that is really a problem for the Trump administration. But there's things we can do. We still have a good hand to play. We haven't done it. A couple things you could do is you delist every Chinese company on our exchanges. You deregister Chinese companies that are authorized to do business in the United States. You remove the top 6 Chinese financial institutions from the US dollar system. Those are things you could do that would get their attention, but we've not shown any willingness or inclination to do it yet, and they're not going to do it voluntarily.
That's all for today's China in Focus. I'm Tiffany Meyer. If you have any feedback on the show or have something you'd like to see us cover, send us an email at chinainfocus@ntd.com. We'd love to hear from you. For On the Clock original news coverage, visit us at ntd.com or download our NTD app. Thanks for watching. See you tomorrow.
Today, we are launching Operation Economic
Rain falls gently on a Delta town tonight. Street lights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet. room. Like tired flowers trying hard to bloom, and every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pinewood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar, street lights shimmer from passing cars, bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. tap softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light, old six-string crying by the motel sign, like a broken prayer lost somewhere in River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and feel every road I ride?
Okay, guys, I hope you have a great day, and I will see you tomorrow on Captain Forex.
still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane. Trying hard to wash away the pain, but every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before chase still leaves your shadow in this empty place.
y a du monde à la messe, comme on dirait chez nous. Bonjour tout le monde. Queen, good morning. Yes, we're still in the morning. Je m'appelle Mona Forti, je suis la députée d'Ottawa Vanier-Gloucester et également très fière de vous accueillir ici comme coprésidente du caucus de la région de la capitale nationale et de pouvoir jouer le rôle de maîtresse de cérémonie ce matin. Before we begin, I would like to acknowledge that we are gathered today on the traditional and unceded territory of the Algonquin Anishinaabe people. We recognize and honor the enduring presence, cultures, and contributions of the Indigenous peoples, and we are grateful to be able to gather on this territory today. Alors aujourd'hui, nous sommes réunis pour faire le point sur la réponse du Canada aux tarifs imposés par les États-Unis et sur les mesures mises en place pour soutenir les travailleuses et les travailleurs, les entreprises, ainsi que nos communautés touchées par ce différend commercial. Alors que nous continuons à naviguer dans un contexte commercial toujours en évolution, notre gouvernement demeure déterminé à protéger les emplois, à soutenir nos entreprises et à renforcer la résilience de notre économie. We are here today to share how Team Canada is strong and united, and we will share how we are supporting Canadian workers, businesses and industry, and protect jobs, create some in this evolving economic during these difficult commercial trade times. I do want to recognize all of you that are here today participating to this important announcement. I do want to thank the whole team of Ideal Roofing ici. Merci pour l'accueil, Philippe, et toute ton équipe, et surtout pour nous mettre nous partager vraiment ce qui se passe pour vous comme entreprise, parce que c'est vous qu'on écoute aujourd'hui, donc merci. And I do want to say I have my colleagues here are each going to present share their announcements as we are gathered today. You see François-Philippe Champagne, the Minister of Finance. We have Mélanie Joly, Minister of Industry. We have Patty Hadju, who is right here, and also Evan Solomon. They all have great long titles, so I will present them later. But it's really important for you to know that we are all here with also Giovanna Mingarelli, and I will go straight to the point because we have many ministers sharing their news today. And to start, we will start with mon ami François-Philippe Champagne, ministre des Finances. Alors à ton tour, François-Philippe. On va droit au but. Et vous avez tous un verre d'eau avec votre nom.
Bonjour tout le monde. Bon matin. Hello everyone. Merci Mona de l'introduction. Ladies and gentlemen, Canadians who are watching from coast to coast. I just want to start with saluer d'abord ma collègue, la ministre Joly. Merci Madame la ministre. Évidemment, on sera au rendez-vous. C'est ça le message qu'on vous envoie ce matin avec la ministre Joly, le ministère de l'Économie, le ministère de l'Industrie ici au Canada. Ma collègue Patty Hadju, qui évidemment va représenter tout le secteur des travailleurs. Puis j'en profite ce matin de remercier les différents leaders syndicaux qui sont avec nous ce matin. Merci de votre présence. This is Team Canada, this is best. We need our workers, we need our unions, and I want to say special thanks also to all the workers behind us. You made us proud. We're stood up for you, we're going to stand up for you, we're going to stand up for industry, we're going to stand up for business, and we're going to stand for Ideal Roofing. That's the message. That is the message this morning to all of you. Je veux saluer évidemment mon collègue, le ministre Solomon, qui a joué un rôle important aussi dans la réponse qu'on va donner. Et I want to say thank you to all my colleagues which are joining. I won't name them because, as Mona said, there are many, many colleagues who are joining. But I think what Canadians can see this morning is that we stand united. We stand united in our response. We stand united in our resolve. We stand united in fighting for Canada. Et je veux évidemment remercier les gens d'Ideal Roofing de nous accueillir aujourd'hui. Philippe en particulier, très fier avec ton père. Imaginez un peu une entreprise qui a été fondée il y a près de 100 ans dans une ancienne gare ici à Ottawa. Vous entendez même encore le son. et qui est maintenant à sa 4e génération de dirigeants. Donc, Philippe dirige l'entreprise et qui emploie 350 personnes à Ottawa, à Toronto, à Moncton. C'est une belle histoire de réussite franco-ontarienne dont nous pouvons tous et toutes être très fiers. You are a true Canadian success story, and a big round of applause to you and the 350 workers. You're supplying roofing across the country, and I saw employees who started when you were very young, they told me. You were very young when they started. But now you're leading the company, and we're going to support you as we go forward. And when we talk about protecting the Canadian economy, we're talking about people like you, people who are watching at home as well. People who get up every morning, plug in, work hard, and support their families and communities. Le Canada traverse aujourd'hui un conflit commercial que nous n'avons pas choisi, mais auquel nous devons faire face avec détermination et engagement. This is an unprecedented challenge imposed on Canada. But Canada will meet the moment. Canadians will meet the moment. We will meet the moment together. And as the Prime Minister has said, we will support our workers, our businesses, and our industry with whatever it takes for as long as it takes. That is the essence of the message this morning, and that's why we are united with you, and that's why we want to present what we have to offer to Canadians. That's why we'll present the outline of our Canada Strong Responses Plan with targeted countermeasures and a substantive support package for workers and businesses totaling $7.5 billion. Because when Canadians stand together, nothing can stop us. Over the past several months, as you have seen, our government has worked intensely and in good faith to reach a mutually beneficial trade agreement with the United States of America. Minister LeBlanc, our Chief Trade Negotiator, Janice Charette, our negotiating team, and the Prime Minister worked tirelessly on behalf of all Canadians. But ultimately, the terms proposed by the U.S. administration were uneconomic, unfair, and ultimately unacceptable. They asked too much of Canada and offered too little in return. Accepting them would have harmed our workers, people that you see here today, weaken our industries, and compromise principles fundamental to our nation. So we stood up for our workers, we stood up for our businesses, we stood up for Canada. Nous n'avons pas choisi ce conflit commercial, mais lorsque notre intégration économique est utilisée comme levier exploité, plutôt que comme fondement d'un partenariat gagnant-gagnant, nous devons nous tenir debout et défendre nos intérêts, défendre nos travailleurs, défendre nos entreprises et défendre notre souveraineté économique. Jamais nous n'accepterons qu'un autre pays nous dicte la voie à suivre. Notre avenir nous appartient en tant que Canadiens. C'est l'essence même d'être maître chez nous. On August 22nd, the United States of America imposed tariffs on 50% on approximately $28 billion in Canadian goods. Those tariffs will have real consequences for Canadian workers, businesses, and communities across our nation. Canada must respond, and today we are, in a proportionate, targeted, and strategic way. Today I'm announcing that Canada will match the United States tariffs dollar for dollar, rate for rate. Effective September 8, Canada will impose counter-tariffs of up to 15, 25, or 50% on $27.6 billion in imports from the United States of America. For each product, our tariff would match the American tariff on the same type of Canadian good. Notre objectif est de protéger les travailleurs, les producteurs et les manufacturiers canadiens, comme on voit ici ce matin, tout en plaçant les produits fabriqués ici dans une meilleure position concurrentielle sur le marché canadien. Un peu l'essence de ce qu'on discutait avec Philippe ce matin, de donner une chance à nos entrepreneurs, nos bâtisseurs canadiens de pouvoir être compétitifs sur le marché canadien. Notre réplique visera notamment des produits dans les secteurs de l'acier et de l'aluminium, des appareils électroménagers, de l'équipement agricole, des pâtes et papiers et de l'électronique. Our existing counter-tariffs, including those on automobiles, will remain in place. Canada's remission framework will also remain available to mitigate unintended consequences for Canadian businesses. Canada's counter-tariffs are designed primarily to provide protection for Canadian industry impacted by U.S. tariffs and allow them to compete against U.S. products in the Canadian market. It's all about fairness, it's all about level playing field, it's all about supporting Canadian workers and Canadian businesses. Il est bon de se rappeler que le plus grand pouvoir que l'on a, tous et toutes, c'est notre propre pouvoir d'achat. Je le disais hier, dans nos épiceries, nos quincailleries, aux entreprises et à tous les autres gouvernements, on peut choisir d'acheter canadien. Et on doit choisir d'acheter canadien. Counter tariffs are only one part of our response. We must also provide businesses with liquidity and, most importantly, keep Canadians working. My colleagues, Minister Joly, Minister Haidu, and Minister Solomon will present the new and very substantive measures under their respective programs. And I think workers, families, and communities around the nation will see that we're going to stand by you, as we have always done. As Minister of Finance, I will make changes to the large enterprise tariff loan facility to make it more flexible, more responsive, and better able to support major employers affected by tariffs across the country. And I will work closely with my colleagues, Minister Joly, in making sure that we do that as swiftly and efficiently as possible. In fact, our approach is guided by three principles that we have discussed among ministers, that we are committed: rapidity, simplicity, and agility. Because businesses facing immediate pressure need programs they can actually access quickly and efficiently. That is the feedback we receive. That is the commitment that we're all making to you today. Canada can act because we enter this period from a position of strength. And I want Canadians to have confidence. We have the lowest net debt to GDP ratio in the G7, the second fastest growing economy in the G7, and a AAA credit rating. Et la discipline budgétaire dont nous avons fait preuve nous donne aujourd'hui la capacité d'appuyer les travailleurs et les entreprises aussi longtemps qu'il le faudra. So in conclusion, when the United States of America asked too much and offered too little, we made a choice. We chose Canada. Nous avons choisi de défendre nos travailleurs, nos entreprises, notre culture, nos langues officielles et notre capacité à décider de notre propre avenir. So now, let's continue to build Canada strong, because we are the true North, strong and free. Merci tout le monde.
Merci François-Philippe pour ton leadership. Merci pour évidemment mettre la table au prochain chapitre qu'on va entendre aujourd'hui. Et oui, tu as raison, nous sommes maîtres chez nous. We will stand up for Canada. We are standing up for Canada. And I would like now to invite Minister Mélanie Joly to present her chapter of today's announcement. Merci.
Thank you so much. Merci François-Philippe d'avoir présenté ça. Merci pour ton travail aussi pour justement nous aider à être capable de mettre en place cette réponse au tarif qui est si importante. We live in a much more complicated and dangerous world, and of course we take act of the U.S. decision. But to be frank, we've been on the front lines before, and when tariffs were imposed the first time, Canada acted quickly. We stood up for Canadian workers and businesses, and we supported industries on the front lines, and we strengthened our economy so that Canada could weather the uncertainty. We were there then, and we are here now. And so I know that many business leaders, small entrepreneurs, workers across the country are anxious right now and concerned. We've been there, and we will be there. We will protect your business, we will protect your jobs. Donc je sais qu'il y a beaucoup de préoccupations, d'anxiété présentement de la part des petites entreprises, des entrepreneurs qui sont tout à coup affectés par les nouveaux tarifs annoncés par le président Trump. On était là par le passé, on l'est maintenant. Aujourd'hui, on va être là pour vous. On va être là pour vous aider. D'ailleurs, on était là pour Philippe et Claude, parce que dans le fond, vous avez été affectés par la première tranche de tarifs, et puis vous avez été capable de garder votre gang extraordinaire ici, et donc, on va continuer à vous aider. Au cours de la fin de semaine, j'ai réuni mes collègues ministres responsables des agences de développement régional pour préparer le plan de match. Et j'ai donc travaillé avec Evan, j'ai travaillé avec Patty et plusieurs autres de mes collègues. J'ai également été en contact avec certains de mes homologues provinciaux, notamment j'ai eu de longues conversations avec Bernard Brinville, le ministre de l'Économie du Québec. Nous devons agir avec urgence pour protéger les travailleurs, les entreprises et les industries stratégiques du Canada. I will be heading later today to Alberta, British Columbia, and Ontario to meet with business leaders and workers directly affected by these tariffs, hear what they need from government, and make sure that our support is reaching those who need it the most. We will be agile and flexible, and we will continue to adapt as we go. We will not accept a bad deal that asks too much of Canada and offers too little in return. And of course, as François just announced, we will respond to the U.S. tariffs dollar for dollar. My job in the context of this crisis is to present the support measures for industries affected by these tariffs. And so our government is introducing a $7.5 billion package of new enhanced measures. So this package includes a lot of support through different agencies. So If you're a small business right now, you have to contact either your regional development agency or the BDC, which you're potentially already working with. Small businesses, through the regional development agencies, will have access to $3 million of non-repayable loans, so basically grants for $3 million, and up to $2 million of interest-free loans. And the businesses that will be able to have access are around those that will have $1 million in revenues. That entire support through the regional development agencies, that may be ACOA in Atlantic Canada, DEC in Quebec, FedDev in Ontario, which Evan is in charge of, FedNor in Northern Ontario, which Patty is in charge of, PrairieScan, which our colleague Eleanor is in charge of, and PacificCan also in BC, which Gregor Robertson is in charge of, and CanNor, which our colleague Rebecca Chartrand is in charge of, will all be ready to help you. Now, the other way we'll be able to help a lot of our small businesses is through the BDC, which will have $500 million to support through interest-free loans that will be between $250,000 to up to $5 million. And there will be no repayment, no capital actually to pay back to the BDC for the next 36 months. So after the Trump administration. And so what businesses will need to show is they only need to show that their cash flow will be impacted by the tariffs. So the cash flow forecast is clear that basically they'll be impacted by the tariffs. And finally, for bigger businesses, so medium and big businesses, we will work through the Strategic Response Fund, so through the Canada Strong Diversification Fund, to help businesses. And we are now putting $2 billion to support these medium-sized and big businesses. Donc, notre objectif présentement, c'est d'aider les petites et moyennes entreprises et également d'aider les plus grandes entreprises. Pour les petites entreprises, ça va être via DEC au Québec, donc l'Agence de développement économique régional. Il va y avoir du soutien non remboursable jusqu'à 3 millions de dollars qui va être offert aux entreprises affectées par les tarifs et 2 millions de dollars aussi de liquidité, donc de prêts sans intérêt. Il va y avoir également un programme via la BDC. La BDC va pouvoir offrir des prêts sans intérêt et il n'y a aucun capital qui va être nécessaire à rembourser pour les prochains 36 mois, donc après l'administration Trump. Et ce que les entreprises vont devoir démontrer essentiellement, c'est que leurs prédictions de liquidité vont être affectées par les tarifs. Et finalement, nous allons avoir également le fonds de réponse stratégique, 2 milliards de dollars pour aider les grandes entreprises affectées par les nouveaux tarifs. Et on va aller rapidement, on va être très agile et notre objectif est de pouvoir justement vraiment être capable de répondre à la demande. Lors de la première tranche de soutien, nous avons aidé environ 1000 entreprises. Nous avons protégé 36 000 emplois, mais nous savons que la demande est plus grande parce que les tarifs affectent plusieurs différentes industries. Under the first chapter of the trade war, we were able to support around 1,000 businesses across the country and protect 36,000 jobs. Right now, we know that there are many new sectors affected and, of course, many new businesses and jobs to be protected. The lesson from the first round of tariffs was clear. We cannot control the decisions made in Washington, but we can control what we build here at home. And we are already seeing Canadian companies step up like never before. These companies are showing us what Canada can do when we bet on ourselves. Voici comment nous gagnerons, en renforçant notre économie chez nous, en produisant davantage ce dont nous avons besoin et en facilitant l'achat canadien, l'embauche canadienne et la construction canadienne. Because economic sovereignty means having the capacity to produce, invest, and grow in Canada. Building at home is not a plan B, it is plan A. So, for many of you watching us right now, you may ask yourself, what can I do? What can I do to help? This morning I had the chance to talk with many associations of retailers to really have them on board to make sure that at your grocers, at your local shop, that you understand what are the Canadian products. And I have their support to make sure that's the case. And we will push them to make sure that that's the case, because that's really how you can help. If you see a Canadian product, please support it. Because what is really important from this new chapter of the trade war is that actually when you choose a Canadian product, you're not only putting pressure on the US. Right now, you're protecting jobs. Because the new companies that are affected by the tariffs are actually those that you may see at the grocery store or at your local Canadian Tire. That's what you can do. And that's how we can launch this movement of resistance to what is happening to us. Et c'est pour ça que c'est si important présentement d'acheter canadien. Parce que les nouveaux tarifs ne sont pas juste sur l'acier, l'aluminium et l'automobile, ce qui faisait déjà mal, mais ils sont sur des compagnies qui peuvent être à l'épicerie ou également dans les différents marchés ou les différentes boutiques où vous allez. Parce que les nouveaux tarifs sont sur des secteurs justement comme les boissons, comme l'alimentation, l'alimentaire, comme sur les produits forestiers, incluant sur les bâtons d'hockey, etc. Donc, vous avez un pouvoir sur la situation. Et donc, j'ai parlé ce matin avec le Conseil québécois du détail, justement pour que ça soit clair à l'épicerie, dans nos différents magasins, qu'est-ce qui est québécois, qu'est-ce qui est canadien. And so for the rest, we'll continue also to pivot to work with new allies and also with our trading partners, because we need to position Canada as a partner of choice of investment, trade, and security. We'll continue to make sure that our businesses have access to more markets, more investments, and more opportunities for Canadians. So we're choosing our own course. We cannot wait for Washington to decide our future. We're strengthening our economy and building a more sovereign Canada. Merci.
Merci Mélanie. Et moi, ce que j'entends, c'est agile, rapide et flexible, qui est super important aujourd'hui. It's really important to say that those regional economic development agencies and the BDC are strategic instruments that will help us go through the next phase, but also build on those economic regional agencies that understand what's happening coast to coast to coast. And now to talk about the next chapter of this announcement, I would like to introduce Patty Hadju, Minister of Jobs and Families and Minister responsible for the Federal Economic Development Agency for Northern Ontario. Merci beaucoup, Patty, d'être ici aujourd'hui.
I'm going to use the water. Merci Philippe et toute l'équipe chez Ideal. Votre travail, vos efforts, c'est très important pour toute l'économie et aussi pour les employés que vous avez maintenant. I'm really pleased to be here at Ideal, and I also want to acknowledge that this is a unionized shop and in fact represented by the United Steelworkers, and Kevon Stewart is here somewhere and his team. Thank you so much for And there are many other union representatives here today. I'm not going to list you all, but it's important that you're here because what you do is fight for good quality jobs every single day. And what you also know is that the success of your members, the success of the workers that you represent is dependent on the success of the business. And these two things are intertwined. As the Minister of Labour, I can tell you, I've seen that dance, and it's an important dance. But it is very important that everyone remembers that in order for workers to succeed, companies have to succeed. And these two things fit together. And so I'm really happy that you're here today representing the workers from across the country that are building Canada strong, that are doing big things across this country, that are actually the backbone of a very important plank of how we are going to not just withstand these tariffs, but grow through them and actually be the masters of our own destiny, as the Prime Minister says. In fact, I was with the operating engineers just yesterday in Kananaskis, and we got a greeting from the President of the International Union of Operating Engineers. And the President, President Downey, said not only are they supportive of what Canada is doing, but they're supportive particularly of the Liberal government and of Mark Carney in stepping up for workers all across this country. And they sent a message, which is don't give up, which is to continue to fight for your economy, for your sovereignty, and build the big things that are actually going to drive us forward. And so I just want to once again thank the union members because you've been with us since the beginning. You've been side by side as we announced the Major Projects Office, as we talked about Build Canada Strong, as we've developed the number of different supports that are going into creating the ports, the roadways, all the things. We're building all the things. And it's not the first time, by the way, as Melanie and Francois Philippe have talked about, that we've faced these unjust tariffs and economic attacks. In fact, I'm from Northern Ontario, and I can tell you that we've seen this in softwood lumber and in pulp and paper over many, many years. And so this is an experience that workers are familiar with, and it's why there's so much worry and anxiety across Canada, because people have felt the impact of these things before. Yes, not on the same scale, at the same speed that we've seen, but certainly in pockets of industry that have faced unjust tariffs, faced economic warfare, and that has a direct impact on livelihoods, on families, and indeed deeply on communities. Employers, just like Ideal here, have worked tirelessly, you've just heard, 100 years, 4 generations of work to build up businesses that our communities actually count on to drive the economy of local communities as well. And now they are facing uncertain paths forward. And so all of that worry and anxiety makes it really difficult to plan for the future. It has an effect of sort of freezing people in place. Should I make that investment? Should I buy that new house? Should I take that vacation? Should I add on to my business? Should I add a product line? And that is the challenge, is it can freeze our economy, it can freeze the ambition of our businesses, and it can freeze the autonomy of our individual Canadians. And that's why we're here today, because we're going to make sure that doesn't happen. Together, we're going to put into place these measures. We're going to build on measures to make sure that people have the confidence to take the steps they need to grow their business, to get those new skills, to be ambitious in their own personal lives and the business life that they're involved in. And this growth is actually dependent deeply on a skilled and talented source of labor. And that's why we've acted so urgently as we've seen these tariffs. Canadians have been supported and trained through the new workforce tariff response agreement with provinces and territories. All of them have signed now. And this is an additional investment of $570 million. It's helping 66,000 tariff-affected workers upskill or retrain as the market demands evolve. And as the unjust tariffs began to hit, the federal government introduced a number of temporary worker support measures that would provide that income stability for affected workers. And this support has helped thousands of Canadians who face job losses or slowdowns. To help employers keep their workers, even when business was slow, we made the work sharing program easier to access. Keeping skilled workers during slow times means that businesses can retain the talent, and it helps workers weather tough times for their employers. In 2025, our measures have averted about 25,000 layoffs. We also introduced the Worker Retention Grant, which helps provide employers a top-up pay to their workers, which helps them maintain closer to normal income levels as they take that training during non-worker time. You can see what we're trying to do is make sure that when a company has that time to pivot to new products, to new markets, to new processes, they don't lose all the talent that they spent years developing. It can be another hit to a business's growth if they can't keep that talent in place. We also improved job bank, adding training finders to make it easier to find training programs that meet the needs of workers and businesses. And for those workers who lost their jobs entirely, we introduced significant temporary measures to the EI program so that workers could get EI benefits efficiently, and those measures have helped. But the imposition of new tariffs means that additional threats to our workers, businesses, and communities are significant, and we need to continue to do more. Tout accord qui limite notre souveraineté, compromet notre autonomie, sape notre culture et notre langue, affaiblit nos secteurs clés ou nous empêche de développer nos relations commerciales n'est pas un bon accord. So we will double down to ensure workers and businesses can weather this storm. Canada will invest an additional $3.5 billion over 4 years to provide the stability that our economy and our people need during this time. So for workers, we'll extend those 3 EI temporary measures already in place by up to 1 year. The 1-week EI waiting period will continue to be waived so that claimants can receive benefits the minute they lose their job. Workers will continue to be able to access EI benefits immediately without exhausting any severance pay. That's vacation pay, any time accrued, so that support starts quickly and all severance money stays with the worker. 20 additional weeks of regular benefits will continue to be available for long-tenured workers so that workers who need more time to find new employment have the access to additional weeks of income support. And the best news for workers is when they stay in their workplace, even during slower times, it's good news for their employers. So we're going to enhance the worker retention and retraining program to go even further than the existing measures to help employers keep their workers even in periods of reduced operations. Employers will be able to reduce employees' work schedules to as little as 2 days per week, while workers receive EI benefits to help replace a portion of their lost earnings on days not worked. When the employer arranges for training activities and the off days, the income replacement will be 70% of total earnings as opposed to 55% of insurable earnings under the previous work sharing program. And the program will include a new $1,000 training dollar bonus per employee, and this will be delivered with regional development agencies so that those small and medium-sized enterprises can get the help that they need very quickly. And we'll make it easier for employers to access the program by reducing red tape and administration burdens. These new supports are designed to be strong and flexible, and they're built on what we heard from industry through the first round of work sharing programs. And I want to thank everyone, including Forest Products of Canada, who I spoke with last night, about how to make this program actually fly for employers. This is about keeping that talent in place, giving workers the support they need so they can focus on supporting their employer to grow new products and to grow new markets. For workers, it's also a sign that we know a job is more than a paycheck. It's a purpose, it's a career. And the more people that can keep their jobs, their current jobs, the healthier and more productive our communities remain. But for those that lose their jobs, even with those supports for employers, we're going to make it even easier to get employment insurance. We're going to amend the reasons for separation rule, which will end the penalization of access to EI benefits for workers who recently chose to change jobs. De plus, nous suspendons ce qu'on appelle la règle relative au motif de cessation d'emploi, mettant ainsi fin à la pénalisation effective en matière d'accès aux allocations chômage pour les salariés qui ont récemment choisi de changer d'emploi. You shouldn't be penalized accessing employment insurance if you left the job recently to get a different job. And so we're going to make sure that you can access EI if, in fact, you've lost your new job.
And we'll make sure that Job Bank has the best information available about what jobs are out there, including on major projects, in defense investments, or through community investments. And we'll work to make sure that job seekers are more easily connected to this valuable service. So you can see from the package of measures that Melanie and François-Philippe and I have spoken about today that we're not taking these attacks on our economy lying down. Because Canadians are fighters who stand up for their businesses and for their families and for their communities. And so we're making sure that the tools that we need to pivot to new markets, to change products or services and come out stronger than ever are there now and for as long as it takes to weather this storm. Because Canadians know how to navigate storms. They know, just like unions, that by standing up together, sticking up for each other and finding new paths, we actually can get through anything. And these measures today will serve as the tools for the next part of our fight to build Canada strong. Thank you very much.
Merci, Patty. Thank you, Patty. And this chapter is really important because workers are key to our economy, and the response and the package that you just unpacked here is really important. And I know workers are very curious and will have to go and check how they will be supported. But you just laid out a lot in such little time, but you demonstrated that working with industry and finding ways to support workers is our response. And thank you for that. Alors maintenant, pour pouvoir entendre un peu plus ce qui se passe via, entre autres, le soutien d'une agence économique régionale, je vais inviter le ministre Evan Sullivan. Evan Sullivan, Minister of Artificial Intelligence, Digital Innovation, and also Minister responsible for the Federal Economic Development Agency of Southern Ontario, to come in and share his chapter on today's announcement.
Merci, Mona. Bonjour à toutes et à tous. Merci, Minister Champagne, Jolie, Haidu, Giovanna, great to see you here. Lots of great colleagues. Et merci à Claude et Philippe et à toute l'équipe ici d'Ideal Roofing de nous accueillir aujourd'hui. Quelle entreprise formidable ici, une vraie championne canadienne, franco-ontarienne. C'est vraiment une grande compagnie. Merveilleux. Thank you. Some of the employees I've met 34 years, some a year. We're here to ensure that a company founded almost 100 years ago is here for the next 100 years, like many companies. This is FedDev territory, and we are glad to partner. Look, as my colleagues have said today, the message today is about protecting workers. Incredible men and women behind us right now. Businesses, and building a more resilient country. We didn't ask for this trade conflict, but we're ready for it. As the Prime Minister said, we're always ready to make a good deal, but we won't sign a bad deal. We won't now, we won't ever. Prime Minister said that we're already giving ourselves more than anyone can take away, and we are just getting started. We have a plan, and you heard the outlines of it today, to protect our workers and to build this country stronger. So that's the message today. We're not going to bend, we're not going to break, we're going to build. And that's what we're doing. We're going to make sure Canadian workers, Canadian businesses keep building. And that's why we're here today, and that's what we've been doing since we were elected as the new government. And as the Minister responsible for federal economic development here in Southern Ontario, every day I get to talk to businesses and I travel the province to meet entrepreneurs and manufacturers and workers who are building this country strong. And I speak to owners who in this context want to protect their workers and their communities. And I know I just want to welcome, as Patty did, our partners in this. The people you see in front of us are our partners, and I want to thank them. The automakers, the trade unions, Chamber of Commerce, steelworkers, Carpenters Regional Council, thank you. We're with you, we're working with the workers, as Patty said, as Mel said, as François-Philippe said, we are here. Thank you for your support. And whether it's in Windsor, or Waterloo, or Vaughan, or Hamilton, or London, or in Ottawa, Toronto, or right here at Ideal Roofing, we see the same thing from our workers and our businesses. Canadians want to adapt, they want to innovate, and they want to build. I was in Lindsay and Peterborough last week. I was at Mariposa Dairy, over 200 people. Like Ideal Roofing, family started, family run, pillar of the community there. Armada Tool Works, family run, also great company, employing more than 200 people. They're creating good jobs, they're innovating, they're exporting, and they're building their communities, and they're leaning in to the future. They're not backing down. And that's important, because as we know, businesses like Ideal Roofing, like across Ontario and the country, are facing real uncertain times. But the businesses like Ideal Roofing, Canadian businesses, aren't standing still. They're focused on what comes next. And that's what today is all about. Our response is about investing in Canadians, in builders and innovators and businesses that will make the country more resilient and stronger as we emerge from this crisis. And that's why our government is investing another $1.5 billion through the Regional Tariff Response Initiative, delivered through our regional development agencies to help small, medium-sized businesses. We say that, but these are communities. These are people. These are moms and dads who are coaching hockey. Make sure they have those jobs, manage the tariff-related pressures, and continue investing in the future. And they're partners. And I always say that the regional development agencies are like the forward operating base of the federal government. They are close to the ground. They work incredibly closely with businesses. They know the communities. They know the chambers of commerce. They know the leaders. They know the ground up. And that's why they are such a critical part of our response. When uncertainty hits, relationships matter. And we know that businesses need more than words of encouragement. They need investment. They need partnerships. And they need confidence. And that's what the plan that the finance minister, industry minister, ESTC for Patty, that's what we've outlined today. And let me just say that Ideal Roofing is maybe the best example. Depuis presque une siècle ici, Ideal Roofing contribue à bâtir la connectivité canadienne à l'économie de notre pays. Founded right here in Ottawa, 1929. Tough year. The company now employs 350 people. As you see, manufactures metal roofing and siding, steel built here in Canada, supporting Canadians to build houses across this country, and that's what we're doing as a government. And like so many manufacturers, Ideal Roofing's felt the impact of tariffs, the trade uncertainty. They export. We got the best businesses in the world here. We're exporting around the world. We want to continue that. The easiest thing would have been to pull back and wait, to pause, to let the uncertainty freeze growth. Instead, Ideal Roofing, like so many companies, have chosen to invest, to get on the front foot. They're choosing to build. And that's why I was so proud that with $700,000 of investment through the Regional Tariff Response Initiative, through FedDev, Ideal Roofing is now investing in new advanced manufacturing equipment, and we just saw it when we toured. There'll be more in other factories around the country to strengthen the company's productivity and competitiveness. Claude and Philippe, his team, I'd say your family, but I'm sure you've been here so long, you're like family already, are making sure that not only they get through the crisis, but they're going to be stronger when we come out of it. And that's exactly what the rest of the country's going to do. It's the kind of company we want to support. That's why we're proud to be here. It's how Canada succeeds. We invest, we innovate, we build, we fight. And I've seen that at Mariposa Dairy and Armada Tool Works, or Comoldco in Guelph, the mold makers, the auto sector, the parts makers, tool and die makers, determined and ready to compete. So to the team, to the workers at Ideal, thank you for continuing to do this. Thank you for giving us a real example. Lead, invest, persevere, grow. And to the other innovators in Southern Ontario, FedDev is with you, the government's with you. As Francois Philippe said, it is going to be simple, agile, flexible. We are here to partner and make this work pragmatically. We'll get through it. We got a plan. This government was elected knowing that the world was changing. It's changing. We're ready. We've got the fiscal firepower, and we've got the plan. We're in a fight today, but know this, the companies like Ideal, with the support and the innovation, will get through it stronger. So I want to thank you very much, merci beaucoup, and thank you for hosting us here at such a great company.
Merci, Evan. Thank you, Evan, for sharing this important message in this, let's say, final chapter of this announcement, but I'm sure other chapters will come up as we go. I do want to say one thing. I think we heard a very loud message today. Today, we buy Canadian. On achète canadien. Ça va être important de soutenir nos entreprises, nos travailleurs, nos familles. Et je vous invite à aller faire un geste concret aujourd'hui quand vous allez acheter votre prochain produit. Il faut qu'il soit canadien. Let's make it Canadian. Alors sur ce, je vais... I can see the media ready to go to the next chapter of question and answers. Je vais demander à Audrey d'animer la session de questions-réponses avec les médias. Merci.
Nous allons maintenant passer à la période de questions. Pour les 25 prochaines minutes, veuillez mentionner votre nom, votre média et préciser à qui s'adresse votre question. Ce sera une question et une question suivie. We'll now move to question for the next 25 minutes. Please state your name, your media, and who the question is for. It will be one question and one follow-up.
Yeah, hi, Mr. Ryan Hamilton, Toronto Star. I hope you'll stick around for many questions from my colleagues today. But to start with, today you are bringing in retaliatory tariffs. You are not bringing in any export levies on Canadian energy or Canadian potash, two areas that are critical to the U.S. economy. I'm wondering why you're not using those levers now, and if you might use them in the future.
Let me start. We have always said from the get-go that we would be strategic, proportionate, and that we would respond in a way that serves Canada's best interest. What you see today is impose a number of tariffs, and we have been consulting broadly. I think you heard that from Minister Joly as well, and we have done that for a long time. Sadly, we have been in this trade conflict for quite some time, so we know the products that needs to be tariffed. We have been consulting, for example, with the steel industry. We've been consulting with Agri-Québec. We have been consulting with manufacturers across the nation. And what is different, and what you have heard today, is that the new tariff imposed by the U.S. administration is going to be disproportionately affecting small and medium-sized businesses. That's why we're here today, and that's why we have decided to put I would say, a very substantial support package. We're talking about $7.5 billion to support workers and to support industry. But you have to get back to first principle. This is about protecting the Canadian industry impacted by U.S. tariff, and I've said it yesterday, this is about the level playing field. We want to make sure that companies like the one we're here this morning can be selling and be competitive in the Canadian market. That's what's driving our response today. That's what's going to drive our response for the days and the weeks and the months ahead.
I think when we're looking at, first, the Prime Minister has said that everything was on the table yesterday, and at the same time, this is, we think for now, the most strategic approach. Because when we're looking at the counter tariffs, we're looking first at protecting the businesses that are affected here, because if they were exporting to the U.S., we need to make sure that the competitors don't have access to the Canadian market in a better way than their own, products. And that's why the retailers need to show that the product is from Canada. For second, we're also targeting products that will target states in the U.S. And so we're being wise and strategic to put political pressure. And that's why we think it's the right thing to do right now, and that's why I think this approach is just the perfect one for now. What?
Yesterday, Ontario Premier Doug Ford called the president a loser. He called him the king of bankruptcies and used some other colorful language to describe the president. I'm wondering if you think that hurt the relationship, and if anyone in the federal government asked him to tone it down.
Listen, we have seen this for a long time. Minister Joly and I have been both foreign ministers of Canada. We have been engaging with the U.S. administration for a long, long time. And one thing I've learned is not to comment on every remarks that is being made on either side of the border. My job, our job here this morning, is to fight for Canada, is to fight for our workers, is to fight for industries, is to bring the support to make sure that we give them a bridge when we have more stability in our economy and certainly in specific sectors that are affected by the U.S. tariff. That's what Canadians are expecting from us. They're expecting each and every one of us and the Prime Minister to stand up for Canada. That's why we did in our trade negotiation, to pivot, to make sure that we support the workers behind, the families, the communities across our nation. And at the same time, and I think that's been mentioned by my colleague, Plan A has always been to build Canada, to remove interprovincial trade barrier, to make sure that we diversify. I'm going to be hosting the Finance Minister of India just tomorrow, 5th largest economy in the world, 1.4 billion people that want to trade with Canada, and at the same time to make sure that we do big things in this country. This country is a nation that does big things. Just think about Churchill Falls we did recently. That's another James Bay. A whole generation of people have dreamed about that. 20,000 jobs. You're talking about 70 billion of investment. Look at what the Prime Minister announced yesterday with my colleagues, Mr. Joly and others, about shipbuilding. We're investing in Canada. We're investing in Canadians. We are building our country strong. That's the response that Canada needs to have. Sir.
Hi.
There's a bit of passion in that. I could see that in your eyes.
Cormac McSweeney with City News. The Prime Minister briefed opposition leaders today on the state of talks and these measures here. But Conservative leader Pierre Poilievre is out again demanding that the government release the draft text of the deal that was on the table that you walked away from, saying Canadians have a right to see what you walked away from. Also demanding a recall of Parliament as soon as possible so that this can be debated. And he's calling for more tax relief. He's got a list of different tax measures he wants you to take action on. So can you respond, will you release the draft text? Why or why not? Will you recall Parliament? Why or why not? And could there be more tax relief on the way?
Very smart way. You have 3 questions in one. I'm just looking at your colleagues. They're learning. The first thing, listen, this is probably the most publicly advertised, negotiation of a trade agreement I could recall. You've seen a number of media briefings. Minister LeBlanc has been out there with Janice Charette, our trade negotiator, briefing journalists, briefing Canadians at every step of the way, the Prime Minister as well. I can remember one trade negotiation which got more coverage than the one we're going through now. So in terms of transparency, I think Canadians have been able to follow that even on a daily basis. When it comes to recalling Parliament, listen, our job is to do the important work that Canadians elected us to do, is to put the measures in place, make sure we can solve. We're consulting broadly with Canadians. I had the Finance Ministers meeting yesterday. The Prime Minister talked to the Premier, Minister Joly, Minister Salma, Mr. Aidu. We're crisscrossing the country, engaging. You saw the union leaders in front of us We're talking to every Canadian, every stakeholders, because this is our moment. This is a moment to stand up, and we're willing to listen to whomever may have ideas in the opposition to say, how can we perfect what we're putting forward. This is a Team Canada moment. And the last thing in terms of tax measure, listen, we already have probably the most competitive set of measures in the G7, but we're always looking at ways to support workers, to support businesses, especially small and medium-sized businesses, as we're looking at this particular period. I was talking to the Confederation of Small Businesses, we've been talking to Chamber of Commerce across the country, as we're doing pre-budget consultation, and I can assure you that the voice of businesses, the voice of workers, the voice of small businesses in particular is well heard, and I can assure you that Canada will remain the most competitive country in the G7 for making investments. Madam Jolie? Okay.
Well, thanks for the question. And if the Conservative Party
like muddy southern water after endless rain. Every dream fades slow, like smoke beneath the moon. Still singing these blues to an old forgotten tune. Dust blows softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blue, like an old black river. Nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blue.
to manipulate the long end of the curve and interest rates. You guys know from watching my videos last week, we talked about him trying to do these treasury buybacks and doubling down, and how the interest rates on the 10-year went down by, what was it, 7 basis points very quickly. And then the very next day, they're right back where they were before. And this time it's no different. The market is going to go where the market is going to go. And it's completely absurd that one of these central planners could think that they can come in and somehow, through their financial engineering, really control, especially the bond market, for heaven's sakes. Like, if you want to be able to control a penny stock, okay, maybe we're talking about the treasury market. Good luck with that. It ain't going to happen. And if they needed any evidence, just look at the Japanese yen and the dollar. I mean, Bessent tried to get involved with that the other day. How'd that go for you? We'll look at a chart of the yen and the dollar. But you guys can guess where it's going, right back to 164. So first and foremost, let's go over what the new proposed plan is, because obviously the buyback that he announced last week didn't do anything. So here's the insanity. Here's the full retard when it comes to just central planning and financial engineering from Mr. Scott Bessent himself. Let's see, we got the screen share. Yes, we do. So Bessent comes out this morning, according to CNBC, and says that he's could tap the $1 trillion TGA to fund bond buybacks and to really implement this yield curve control. Now, this is not to say that I think yields are going up or down or whatever, but this is to say that Scott Bessent is not going to determine if rates are going up or down. That's going to be the market, and that's going to be growth and inflation expectations. It ain't going to be the central bankers, the Treasury. It's not going to be the central planners. Nada. It's going to be where the market wants rates to go based on growth and inflation expectations. That's it. Not debt and deficits, not manipulation, not financial engineering, not hopes, dreams, and narratives from Bessent himself. So, but look, if you don't believe me, just look at their tactics and just ask yourself, does this make sense? Here's what I'm talking about. So for those of you who might not have seen my whiteboard videos, because I've outlined what the TGA is a million times, but it's basically an account on the Fed's balance sheet. So it's the Treasury's checking account, let's say. So what happens is, let's just go over to it. I'll come right back to this CNBC article. Is this is their checking account. So when they get money in from taxes or selling treasuries or whatever it is, it goes into this account. And then just like your checking account, when you get your paycheck, you deposit it, even though you earned the paycheck and they didn't earn any of this money. But you deposit your paycheck into the account, and then over the next month, you go ahead and pay your expenses from that checking account. This is the exact same thing. It's just a liability of the Federal Reserve, and your checking account is a liability of Bank of America or Wells Fargo. So, by the way, this is not a savings account. This is not money that the Treasury has that is just like a sovereign wealth fund. That's not what this is. This is a checking account that just sits there, and the money is already earmarked. It's already been spent, right? Just like when you deposit your paycheck at the beginning of the month, the majority of that paycheck has already been spent. It's just you got to write the checks to pay your rent or pay your kid's school or buy food or whatever it is throughout the rest of the month, right? It's already earmarked. So it's up to $1 trillion right now. And so what he's saying is that, I'm going to go ahead and take some of this trillion to buy the long end of the curve to try to bring down rates. Let's just say on the 10-year Treasury yield, to try to bring down mortgage rates, to basically make Trump and the Republicans look good going into the midterms to the degree to which I can, right? And then he's kind of touting this as though it's like genius or something. This is stupidity on a level that's hard to even describe. Because what he's doing with the Treasury buybacks, let's just go back to last week, is he's just selling bonds at the front end of the curve, let's say 3-month treasuries, to go ahead and fund the purchases at the long end of the curve. It's not rocket science. And then the market just gives him the finger. It's like, ha, 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 ha. Yeah, rates will go down for 5 minutes, and then they'll just go right back to where they were before. And I can assure you that rates are going to do the exact same thing here. But I don't want to get too far off topic, because let's go back to kind of the mechanics. So the easiest way that I can describe this, let's go back to that example where you deposit your paycheck for, let's say your paycheck, we'll just keep it at $1,000, okay? And at the beginning of the month, and throughout the rest of the month, you're going to spend that $1,000. It's already earmarked, like we said. You got to pay $300 for rent. You got to pay your car note, $200. I know these aren't realistic numbers. We're just using them for the sake of the example. So what Scott Bessent is saying is like, oh, we just got paid. We just got the $1,000 paycheck. So let's take this paycheck and then let's just take the $1,000 and spend it on a vacation. And then when we have the bills due that $1,000 was meant for, then we'll just go ahead and we'll just charge this to our credit card, as though that's some sort of genius plan. You see, so my point here is, let's just assume that you take 500 billion of this and buy the long end of the curve. Okay, what are you going to have to do in 2 weeks? You're going to have to issue another 500 billion in debt, treasuries, to go ahead and put back in the TGA, because all this money is basically already been spent. It just hasn't gone out of the account yet. So this is just this is stupidity. It's not even insanity. It's basic, like it's just, I don't know, childish. I mean, what I said today on social media, on Twitter, it's like a financial version of that movie Idiocracy.